And now, with sound investing, here's Paul Merriman.
Well, this is a really exciting podcast for me. I don't know if any of you noticed that I have changed my attire slightly. I pulled out a shirt that a grandfather would probably use and when cuddling a new grandchild. And of course, I am obviously here to brag about my beautiful, by the way, 9-pound granddaughter, the first granddaughter in our family, which in and of itself was remarkable. And so that then that makes me go to the table and sit and start to ponder what my wife and I are going to do for this grandchild in terms of some sort of a life-changing event. And since she's too young, I'm speaking of the grandchild, too young to go traveling or to go shopping, we've decided to do what we have done for all of the grandchildren, and that is to put away a little dough, a little money that that would be used later in life. And so today, Daryl and I are going to spend some time before we get into the Q&A talking about the approach that that my wife and I are using. And of course, Daryl never fails me if I say, is there any way we could build a table around this? Of course, Daryl will build a table around it and make the whole process meaningful to people who might want to do something similar. Now, I'll tell you right now, this one is not going to be a long conversation because we have so many questions to get to. This is going to be a relatively brief discussion about this process. And then another time in the near future, Daryl and I are going to sit down and we're going to show you more than the little bit you're going to see today. We'll show you some other information that I really think you will find interesting if you're considering doing the same. Now, I want to mention right up front that you could do this literally with any amount of money. You could do it with $1,000. I'm doing it with 10,000 because that is what I've done for each of the other grandchildren. And so, and in fact, my wife asked the question why there's no adjustment for inflation, but I'm holding on to the idea that they should all get $10,000. But the idea is that it's not to do anything special right now. It's not to spoil them. It's not to do anything about their normal life for a long time. The idea is to put away some money for the future. And this time I've done it in a very different fashion than I have in the past. And Daryl, would you do me a favor? Would you pull up the table and the set of assumptions so that we can walk our listeners and our viewers through this. And we have to keep in mind that we do have listeners that will not be able to see that table, but here it is, fund for a granddaughter. By the way, I think this would probably work for a grandson as well, but
probably.
But this is what we're working on right now. And so the $10,000 is on the table. Walk us through a way to have this $10,000 be a wonderful source of retirement for our granddaughter. Could you do that, Daryl?
Sure. So Paul asked me to do this or take a look at this. I don't know, it was probably a couple of weeks ago now. And so we've worked through it over the last couple of weeks, and I think I finally got what he originally intended to do, modeled. So we start off with $10,000 at age 0, and it goes into a taxable investment account. And then that account grows at whatever rate it grows at. This simulation of what we're going to talk about today assumes 12% per year, and that's before taxes. And then at age 21, we chose 21 primarily because that gives 20 years for the account to grow and it'll be no great surprise that for the taxable account is in small cap value. And so over a 20-year period, I didn't mean to let that out. Was that wrong?
No. Wait a minute now. Remember, we decided on the combination of the S&P 500
Actually,
and small cap
right.
value.
Actually, what we really decided on was that it's going to earn 12% a year.
That's right.
And the reason why that is not too out of line is because a 50-50 account like that will probably make 12% over 21 years. Anyway, the Roth account is the same in terms of returns. Contributions are made starting at age 21. They're made each year until the granddaughter retires at 65, and then she takes 5% of the balance each start of each year to do with whatever she needs to do with it, to retire on, to live on, to do whatever. And the plan ends then at age 95.
And I think may I just insert a comment here?
Yeah.
Daryl, and when we get together and we talk about this at more length, we will talk about all the things that can go wrong. And the first one is it might not make 12% a year. That one would be actually easy, that you could find a 20-year period. It does. The two of them don't compound at 12% a year. And of course, we also don't know what the regulations, tax regulations on Roth IRAs will be in the future. So, this is just to get a sense of the impact of having money and time on your side. It's the same case we make for 21-year-olds who are starting to work and earn money and trying to get them to save some. But go right ahead, Daryl.
So there are some modeling assumptions that I had to make in setting up this spreadsheet. And so the withdrawals are taken from the taxable account the first of each year. Over the course of the year, the taxable account will generate dividends. We've chosen to consider them all as being taxable. So they're all ordinary dividends. It's all taxed at the dividend tax rate, whatever your current marginal taxable rate is. All withdrawals, in other words, the $8,000 a year for the Roth accounts, are considered to be 100% capital gains. You pay taxes at the capital gains rate on every penny of it. Those are both simplifying assumptions, and they're probably a little conservative. The withdrawals to pay those taxes on the dividends and the capital gains are taken at the end of the year. In the Roth IRA, the contributions are made the first day of the year or first of the year, when same time as the withdrawals are taken from the taxable account. The withdrawals for the retirement period are taken the first of the year, and the entire amount is taken at one time that first of the year.
Great.
So, as you might expect, there are a lot of things to consider when you put this simulation together. So these are the scenario inputs. One key thing here is Paul wanted to use an $8,000 contribution because this first contribution isn't going to happen for 20 years. And so by then the IRA amount will likely grow above that. The model has the ability to inflate the Roth contribution also, and it has the ability to add Roth catch-up contributions too, but we don't do that during this simulation we're going to show today. And the rest of these are pretty clear. For converting back to real numbers, we use an inflation rate of 3%. And then these are the tax rates. The capital gains is 15%, the dividends make 2%, and the ordinary dividend tax rate is 24%. So what does this all look like then? So these are the numbers.
And by the way,
So
Daryl,
you
I assume we'll have a link in the notes for this podcast that will take them to the tables themselves that you're going to be showing.
Yeah, I think we'll have these charts. Yeah, a link to the charts. Yeah, and the tables. We can put the tables out there too.
Great.
So this is the spreadsheet, snapshot of the spreadsheet. This is the early time, and this is primarily when when the taxable account is growing. It starts with $10,000 a year. You generate some gains. Some of that is dividends, and then you pay some taxes on the dividends on that for the first 20 years. Then you end up at age 21 with about $99,000. You take out $8,000 to begin funding the Roth IRA. And then what the remaining generates some dividends that you then pay taxes on at the end of the year. And you also take a withdrawal out to pay taxes, capital gains taxes, on the $8,000 you took out to fund the IRA at the beginning.
Can I just
and then that continues.
Insert something there, Daryl, and that is that in theory, my daughter and her husband could pay all the taxes on behalf of the grandchild. But as this thing grows, the taxes become a more serious consideration, because when you go out 65 years and you're growing, certainly we don't have to worry about that in this amount of money that's in the Roth. But we decided to model this where, in essence, the taxes will be paid out of the proceeds of the original $10,000 investment.
Right. And you'll see how the taxes grow here in the next couple of charts. It's interesting that, this is just interesting aside, that the taxes remain pretty constant. They're about $1,900 a year. So then if you look at the later years, as you begin to approach retirement, the IRA contributions continue. There's an option to up them by the catch-up amount at age 50, but we don't do that here. You continue paying taxes on the withdrawals, pay taxes on the dividends, and making contributions to the Roth IRA to the point to where by the time she's ready to start taking withdrawals, the IRA has grown to almost $11 million. And you still have about 1.2 million left in the taxable account that will continue to grow. So she's reached retirement now, and her first withdrawal, these are nominal dollars, is about $540,000 in nominal 65 years from now is dollars. So in retirement, let's move over to the Roth first here. We start talking with about 10.8 or 10.9, $11 million, starts $540,000. And that amount continued at 5% of the initial portfolio value for the year. She continues to draw out, and the final withdrawal the last year is almost $3.3 million, nominal dollars. And the account balance at that point is almost $70 million. Meanwhile, the taxable account, which you've left alone over here, except for taking withdrawals to pay taxes on the dividends, has grown to $31 million at age 95. So, in summary, I guess, now if we look at it here, you can see that the sum of the two ending account balances is almost $101,000.
$101 million.
1 million.
Oh, $100 million. Sorry, $101 million. It's only off by 3 orders of magnitude. And the total distributions that the granddaughter took out over that last 30 some odd years was $46 million, nominal dollars again, for a total benefit of $147 million. Okay, so the daughter dies in 2117. What's a loaf of bread going to cost in 2117? Well, nobody knows, right? But if we looked at the 3% annual inflation rate that we assume, and we go and we apply that to the withdrawals that she has taken during her retirement and the balances that are left at the end, you can see that her first withdrawal in terms of dollars for the year that she was born is almost $80,000.
And may I I think this is important, because some people think that what we are doing is going to ruin her life, that it isn't fair, that she should be made to work harder so she'll have enough. But $80,000 is, while it's a lot of money today to retire with, it's not like it's unheard of that people live relatively normal lifestyles and have $80,000 a year in income to do it with. So
that's right. And it's sort of, and you know, you can live on $80,000 a year today. And if you've worked and you have Social Security, that may add a few more tens of thousands of dollars onto that, maybe, depending on the kind of job you had. And you may have had a 401k that you've contributed to. So you can end up living an okay retirement, living a very good retirement, actually, at that point. The last withdrawal in terms of base dollars is almost $200,000 when she's 95, assuming that she lives that long at the end of the point. The other thing is that that means she'll have taken out about $4 million during, sorry?
So it sounds like quite a party, doesn't it?
Yeah, she'll be okay, I think. She would have taken out almost $4 million and have a little over $4 million left in her account in today's dollars to pass on to her heirs for a total benefit of $8 million. So for a $10,000 investment by Gramps, that's not too bad.
Well, and it really is obviously dependent upon a lot of things going right. It would be easy for parents and grandparents to make a list of all the things, all the reasons it won't work. But Chris, and thank you, Daryl. I think that's great. That makes it very, very clear the steps that need to be taken. We'll talk in more depth when we get together, including showing you other tables that are based on 8% and 10% and other considerations. But Chris, you're a thoughtful guy about these kind of things. You got lots of kids and have plans for kids and grandkids. What are your thoughts when you see this?
Well, it begs a question for me of, is it better to set something like this up for your newborn grandchild, or is it better to help her along the way, or is it better to help her later? And I think that that's a question that has both a financial part and a parenting stewardship part. And so the financial part, we've talked a little bit about pros and cons of different approaches, and I'm not sure. I think there's probably enough uncertainty in future tax law and investment returns and everything else that you could probably come up with advantages for either side, giving at the beginning or giving in the middle or giving later. I think that it's probably debatable on a financial level. I think in terms of the parenting concerns, though, those are harder to answer even than the unanswerable financial side, because you don't know anything about the child. You don't know if this child is going to be inclined to spend every penny that they get access to whenever they get access to it. You don't know if they're going to be frugal and a saver. I do really love the fact that in setting this up, you're helping both your child and your grandchild know that they're loved, they're cared for, they're appreciated from early in life, and that you're setting up an excuse to have some really good conversations along the way about how investing is an important part of becoming financially secure. And that you're going to have an opportunity to talk about how these different asset classes performed and what it is to own equities. And of course, you're not going to do that until they're at least 2 or 3. So I really kudos and props to you for doing it. I wonder what holds people back. Like, why some people would do it and why some people wouldn't. But, I touched on a few of the reasons, and you did too. This whole concern about maybe spoiling the kid or not giving them the chance to feel like they made it on their own from scratch, right? So there's some subtle pros and cons, but I don't think anybody's ever going to question whether you did this out of good intent, and that I hope it has a very positive effect.
Well, and go ahead, Daryl. I'm sorry.
There's one other thing about this, and I don't know if we mentioned it or not, but in Paul's vision of this, the taxable account is set up in his daughter's name.
Right.
And so depending on what life scenarios present themselves, the daughter has the ability to parent the granddaughter.
Yes.
With the money that's in the taxable account, because, by the time the granddaughter is old enough, let's say older, grandpa may not be as involved in her life anymore for any number of reasons. I don't mean to put this on a downer, Paul, but
no. I'm very excited. I'm 79. I have no idea how many years I have to live. I will unlikely, both my wife and I will leave some money to family. It may not be much, but there'll be some. And so this is a piece that hopefully it will teach some lessons. For example, one of the reasons why we are using a combination of the S&P 500 and small cap value, I would actually be pleased if by the time that this account has been open for 18 years, that it will have shown some good times and some bad, and sometimes the S&P 500 will do well while the small cap won't, and vice versa. And by the time that she finally knows about this account and starts putting the money away into that Roth IRA, she'll actually have been able to see real money doing real things, whether it's good or bad. And hopefully, and in a minute, I got a question for Chris that's come in. I'm hoping that combination of the S&P 500 and small cap value is something she could live with for the rest of her life. That's my hope. And so if we start it that way from day one, I think there's some value in that, even though we all would believe that all small cap value would be better, right? In terms of return, anybody want to disagree with that?
History says over 20 years, it would very likely be right. Yeah.
Well, thanks. I really appreciate you putting this together for the folks. Now, I've got a whole bunch of questions that have come in, and so the first one, and by chance, if one of you have the H1 table available, I think that'll be a good thing to use. But this question is about the being able to compare the different combinations of asset classes. And for people who don't know, we have 8 beautiful portfolios. I say that in the sense that in the past they've done well, and they expose you to different levels of risk. And then we also compare the returns of those 8 combinations with the S&P 500. So the question is, how do you know the best combination of asset classes in terms of risk and return? We know the one that made the most money. That part is obvious because it has the biggest compound rate of return, and the value of $10,000 over that 52-year period in the study is the highest. But that may be because the one that got the highest return was really risky and might not be appropriate for people. But Chris, can you and Daryl, can you put up the that table if you've got it?
Yeah, I've got a version of it here is prepared for a different conversation, but it'll work for this. So
okay, great.
Let me see if I can find it here. There we go. So this is the table H1 that shows the difference of the, I guess there are 9 worldwide, or 9, most of them have some part of worldwide in it. Portfolios, the sound investing portfolios, 50-50 US international. We'll talk about the green stuff in a minute, but this is basically the performance.
So Chris, could you spend a few minutes and give us some guidance as to how you would look at it in terms of trying to compare the risk and return of these different portfolios?
Sure, yeah, and I think it's going to be a personalized thing that we'll come back to that in a minute. But at an objective level, there are two measures of return per unit of risk that are fairly standard in the industry. One is the Sharpe ratio, and the other is the Sortino ratio, which Daryl has so conveniently calculated across the board here, not just for the total duration of 70 to 21 that he's got represented, but also for the individual decades. I would generally look at the 70 to 21 if I'm trying to characterize a portfolio, just, the full history, because it tells us the most information. And the difference between those two is that the Sharpe ratio looks at the return per volatility, per standard deviation, if you want to get technical or use the technical term. And the Sortino ratio looks at the return per downside risk, which is the risk that most of us care more about. Most of us are, we're sensitive to the decline. I don't really care about upside volatility. If the return is really varying a lot, but it's always positive, I'll be very happy, and most investors would be. So if we look across the chart here and we look at the Sortino ratio, which is that return per downside volatility, what we see is that the S&P 500 itself had this Sortino metric is 0.88. A higher number is better, a lower number is worse. The worldwide ultimate buy and hold was 0.92. The worldwide 4 fund is almost exactly the same at 0.93. The US 4 fund was a little bit higher at 1.02. Would that be repeated in the future? I don't know. Worldwide all value.
See how it varies by the decades, and they bounce all over the place. So
exactly. So if you look at that much variability in the past, you probably wouldn't bank on that subtle difference being available in the future.
I agree with that.
So, continuing across the worldwide all value was 0.92. The US all value was 1.14. The worldwide all small cap value is 1.05. And the US all small cap value is 1.23. And the US 2 fund, that's the S&P 500 and small cap value, is 1.03. So they're all reasonably high. If you were to, compare to just the S&P 500 at 0.88, they're all better. And that's what we're looking for, is a higher return per unit of risk. But coming back to the first comment I made about personalization, the way these numbers are calculated is by looking at every data point available. So if you have annual data, you do an annual calculation. If you have monthly data, you do a monthly calculation. If you have daily data, you do a daily calculation. If you can invest like Rip Van Winkle and look less often, you will see smaller drawdowns, statistically speaking, over the same period of time. So if you're willing to look away for 5 years or 10 years, you should care more about the historical compound annual rate of return and less about the volatility day to day. And so I think as a personal investor, the better your behavior in terms of being able to look away, the more volatility you could tolerate. And the less important this return per unit of risk metric is. If you're going to look at it every day, the return per unit of risk metric could matter a lot, and you might actually be best served by like a Larry Swedroe barbell of short-term bonds and small cap value. A lot of short-term bonds and a meaningful chunk of small cap value, because that's going to have a very consistent delivery performance and quite a high Sortino ratio. Paul?
You said if we can ignore the downside and just think long term about the upside, and so when I look at the Sharpe ratio, which is about volatility on both the up and the downside, correct?
Yes.
Okay. So if I don't care about the downside, it suggests that the the two fund strategy that has a 0.67 Sharpe ratio, the one that my granddaughter is hopefully going to use, is basically what? Tied with the US all value in terms of the
Yeah, I would look at that differently, Paul.
All
I would
right.
say that they're all basically, I would say they're all basically the same. There's not any difference. There's not any meaningful difference, in my opinion, between 0.61 and 0.67.
Yeah, the smallest one, the S&P 500 is, I agree with Daryl. It's a little bit lower, but I don't know that it's statistically significant.
Remember, what these measure is the return you get for the risk you take. And so what that means to me, since they're all about the same, what that means is you essentially get the return for that you should expect for the risk that you take, no matter which one of these portfolios you invest in.
Yeah, I like what Larry Swedroe says about these different asset classes, and that's that you would expect in an efficient market that as the return goes up, the risk goes up, that the two go hand in hand. And that is generally what we see for individual assets as well as portfolios. And that's probably what that relatively narrow range is telling us, is
Right.
exactly what Daryl just said. Yeah.
So tell me what I'm missing then, or tell me if this is just data mining, which as somebody who's been around market timing for 50 years knows how easy it is to data mine. When I look at the number of down years and the average loss and the sum of all the losses, the S&P 500, the sum of all the losses for the period between 1970 and 2021 is 141.1%. And when I look at the two fund strategy, a strategy that made 12.7 instead of 11, the sum of the down years was 130.1. It actually had fewer losses, lower losses than the S&P 500. So is that actually more meaningful than the Sharpe ratio or the Sortino? Because that's the bad stuff that people had to deal with that portfolio. But the upside was obviously much higher with the two fund strategy than the S&P 500. Is that just data mining because it only represents 52 years of data?
Yeah, rather than looking at the sum of the down year losses, I think I would rather look at the number of down years and then look at the average down year loss. And I realize that you multiply them together and you get the sum, but the number of down years is the number of times you're going to feel bad. And the average down year loss is a measure of how bad you're going to feel when you do feel bad. So I think if you want to go back and look at the US 4 fund, it had 11 down years. The S&P 500 had 10. So it had one more down year. Okay. But when it was down, it was what? 2.5% or so less down. So is that a good thing? Yeah, probably so.
Yeah.
Is it going to make a difference? Is anybody going to notice? Yeah, maybe. If you're really looking at the numbers, you might notice it. So that would be the downside of the equation. But I think that's partly reflected in the, as Chris was mentioning, in the compound annual growth rate.
So we have not found the perfect, easy solution, but we have concluded that all of these generally have a premium for the risk that you've taken, and that somehow you have to figure out by some quantitative way what was the more risky of the bunch. And maybe the answer is 52 years is not enough time. And Daryl, do you think by the end of next year we will be able to see this kind of an evaluation with US asset classes only, because we can go all the way back to 1928. Would that be the point at which we might be able to dig over a long enough period of time that we might be able to conclude, yes, there is one that is better than the rest? Is that a good?
I don't think you'll ever solve that argument. I don't remember who said it, but somebody said that you were looking at 1,000 years worth of data and it didn't show anything, and I don't remember who this person was, but they said, well, you're not very patient then, are you?
Oh.
and I think that's the problem when you start looking at statistical data, is that you have to understand that you're only looking at a very small sample set of the entire possible universe of samples that you could have. And so this is the argument between empirical data and fundamental analysis, and there's a happy medium somewhere. But
Paul, I want to go back to the what I think is the heart of the question from the listener, and that's how I can understand the desire at a personal level to characterize the risk and reward expectations of the strategy that you're pursuing. And I would say step one, figure out what risks are most important to you. Is it running out of money? Is it seeing a deep drawdown? Is it not tracking the market? Is it, there's a lot of different ways risk shows up that can matter to an individual investor. And I think that that's really where this individual should start trying to answer the question, is figuring out what matters most to them. And then they can go to the tables that Daryl's created. They can go to Portfolio Visualizer. They can go to a lot of different places and dive deep on the risk metric that matters most to them. The one caveat there is, like, when you go to Portfolio Visualizer, be careful if you're testing assets that have a short return history. Right. That's going to give you noisy data. But as long as you have long return history, like if you're testing the asset classes at Portfolio Visualizer, you can get some really good and interesting insights. So I think that it really is a personal question. What is the highest return per unit of risk for one person won't be the highest return per unit of risk for someone else.
Terrific. Okay, let's go on to the question from Jim. He's in his 40s. He's got $700,000 invested. By the way, I think this young fellow is also an engineer, as you two are by background, and he got convinced he should have bonds in his portfolio by an advisor at his age, and he's decided that he doesn't want to have bonds in his portfolio at age 40. And so now he's got to get out of the bonds and get into stocks. And the question is, how would you recommend, and none of us are financial planners, but we have lots of experience between us. What would you recommend? Would you just get out of bonds and get into stocks if that's what he wants to be? Or would you dollar cost average in? This is an opportunity to do that over a reasonable period of time. The market has been reasonably low. Should that be part of the consideration? What say you, Chris?
If he's comfortable just making the trade, the kind of an efficient market hypothesis would say go ahead, you would. The higher return expectations are generally for stocks over bonds, and so the sooner you would make that change, the higher your return would be, statistically and historically. Your mileage may vary. Nobody knows the future. If you're uncomfortable with that, you can dollar cost average in. And then the other thing that's likely to creep in is some timing questions, right? Somebody's going to wonder about, well, interest rates are likely to X in the near future. So yeah, I would avoid putting too much time and thought into the timing questions, because in my own experience, they're just crippling.
Yeah.
They don't let me move forward. They usually just lead to more questions and more uncertainty and lack of action. Yeah. Daryl?
Yeah, I agree with what you say, Chris. I think if you're talking about wanting to move out of bonds into stocks, you have to say, well, why am I doing that? Well, you think stock is a better place to be. If that's what you think, then that means you think bonds are not such a good place to be. So why would you stay in them?
All right. All right.
Age 40 is where we start to see both target date funds and our own glide paths bring in some bonds, though. So he may not want to go to zero. He might want to figure out, well, what's a reasonable amount to be starting ramping up as I'm, going to be ramping towards retirement. So, yeah.
And is it fair to say, I've been thinking about next year a lot recently, that this whole glide path discussion should be a major effort in 2023 for us? Because I find very few people, except people in target date funds, have an actual glide path in mind. I mean, the target date fund knows it for the next 50 years. In fact, the next 80 years, they've got it all figured out. But the individual investor typically does not have that figured out. And so then it becomes kind of dependent upon the direction of the market. And after the market goes down, people say, well, maybe it is time for me to get a little more conservative and add some bonds. So I hope that we get a chance to do some good work in that area next year. Another question about 2 funds versus 10. I know, Chris, you've addressed this in the past, but this question comes up. They've read your book, 2 Funds for Life. The book is just filled with great information about how to build a portfolio with a combination of a target date fund and a small cap value. And then, of course, that's not one of the strategies that's represented in the table we just looked at. And one of the reasons it's not represented in that table is because it's not a static strategy. It is a strategy that changes with time. But how would you counsel somebody in this decision? 10 funds, and he's comfortable with 10 funds, he says, but versus the 2 fund strategy.
Is he's asking about 2 funds for life specifically?
Yeah.
This is probably one of my greatest personal frustrations in the work that we do at the foundation, is that we haven't figured out a way for the 2 fund for life strategies and the other sound investing portfolio strategies to be compared side by side. It's in an apples to apples way. And it is because the cash flows matter. And so you need to have a lifetime allocation combined with a lifetime cash flow set of assumptions to do the comparison. And those vary. It depends on where you are and what you're doing. And so I think, first of all, the book has a fair amount of information in it that might be helpful, especially, I was just looking at it. I think it's chapter 9. Hold on a sec. It's chapter 12, actually. Does some of these comparisons, so that could be helpful. But it really comes down to some behavioral choices, too. Do you want to have your glide path managed automatically, or do you want to manage your own glide path? Do you want to control how much you have in bonds and equities yourself, or do you want to turn that over to a fund? And you may want to think about legacy issues about whether you want to do it personally and whether the person inheriting your accounts when you're gone wants to do it personally. There's this added complexity there. In general, the longer your more equities, the higher your expected return and the higher your volatility, and the more it's on you to behave well. So there are people who are equities their whole life and they get very good returns as long as they're disciplined in how they do it and they don't bail out of the market at the wrong times and panic sell and those kinds of things. But they have to have extraordinary behavior. It's a tough question to answer with an apples to apples numbers analysis.
But if we thought in terms of just the 10 funds versus the 2 funds without consideration for the fixed income, just assume that it really is about that you were going to use the same glide path in terms of fixed income. The implication of a portfolio that is early on so heavily concentrated, and if you use the 2 funds for life where you take 1.5 times your age or whatever that formula might be, it's going to have a lot of small cap value early on in that person's life, as opposed to the 2 funds, the 10 funds. You're not going to have the heavy concentration of small cap value when you're younger, but by the time you're 40, you're going to have 40% of your portfolio, well, more than 40% of your equity portfolio in small cap value. So I would think, just intuitively, that you're going to get a better rate of return with the 2 fund strategy if you were using the same fixed income exposure up until maybe the last 10 years, or maybe it's 20 years before retirement. I mean, there's some crossover point there where the amount of small cap value you have in the portfolio is not impacting the portfolio as much as it did earlier when you had a lot of small cap value.
Well, the thing that's interesting about that concentrated position in the early years is that you don't have much money. So if you look at the lifetime dollar return, not the compound rate of return per year, but you look at the lifetime impact on your spending power or your total dollars, you're absolutely right that your allocation nearing retirement and into retirement is far more important than your allocation in the early years. And so to the extent that you can have a higher allocation to small cap value in those later years, it's going to have a bigger difference on your total long-term expected return, expected, not guaranteed, not promised, because the dollar amounts are so much bigger. But the 2 fund with the S&P 500 and small cap value is half in large, half in small, half in growth, half in value, or blend and value. The same thing for the 10 fund. So those are both, since they're half in small and half in value, they do have a higher percent tilted that way than, say, the most aggressive one in my 2 fund for life book, where you have 30% of your portfolio in small cap value. Although that 30%, given that you're into a target date fund that has a small equity position, is probably comparable to the half and half again. So yeah, I would imagine in retirement those aren't that different. And like I said in my book, I actually run a number of those scenarios, and you can compare them.
Okay, that's great. Thanks. Okay, here from Steve. This is I don't mean to pick on you here, Chris, but this one, Steve is complaining. Went to M1 and they irritated him because he wasn't getting answers to whatever his complaint. I asked him for what the complaints were, and I have not received those complaints. But have you had complaints about M1? And if so, what are they typically about?
I haven't had many complaints about M1, but I think it's fair to say that M1 Finance is an online brokerage that is going to be light touch in terms of customer support. There's no retail facility. There's no door you can walk in to get help. If you're not doing exactly what they have automated on their website, I would not be surprised if you ended up getting frustrated because they have to run a lean, mean, automated machine, and so I'm not surprised that somebody would have a frustrating experience there. What I will say is that for my own experience using them, which is all automated trades and automated maintenance of my Pi, I actually have 2 Pis there, I think. It's been delightful. It just runs. It just keeps on ticking and going in the background, and I never interact with them. They never interact with me. It does exactly what it's supposed to do, and at the end of the year, I can get a tax statement. It works. So I think as long as you're doing what they do, what their mainstream usages are, you probably won't be too frustrated. But if you go beyond that, or if you're looking for a lot of customer support, I wouldn't be surprised you get frustrated. Just, they can't afford to do that.
And by the way, I have heard some complaints about the transfer of retirement accounts there. I can tell you, I can get complaints about almost every firm in the industry when it comes to the transfer of IRA accounts. That is very, very difficult area. One, I think, is because the companies that are moving this money around, they got to do the right thing, and they do. They cross every T and dot every I. They will not take a risk. On top of the fact that a lot of the industry is having to hire people who aren't experienced and have had some real difficult times losing folks because there's other opportunities out there, evidently. Okay, let's see. Russell here writes about AVLV. Now, I'm not going to talk necessarily about Russell and AVLV at Avantis. By the way, is it Avantis or Avantis? I've heard a lot of people say Avantis. Do you know, Chris?
I don't know.
Okay.
I say Avantis because I was trained in a European language, and it looks like a European word.
Okay.
and I know their CEO is European too, right? Eduardo. So that's why I say it that way. Yeah.
All right. Well, here's the basic question. You are going to be looking at whether to replace particular ETFs. And if I'm not mistaken, AVLV is a large cap value ETF, correct?
Yes.
And the fund that you have selected as the best in class ETF is RPV. RPV has had an amazing track record this year. And of course, what people are going to need to understand, if you decide to go with AVLV, it could even be that RPV had a better year in 2022 than AVLV, right?
Sure. Yeah.
I mean, you're not.
I don't choose funds based on recent performance or expected short-term performance. I choose funds based on their expected long-term performance and exposure to the factors that our portfolios are built on, or the market attributes that our portfolios are built on, of size and value, plus any bonuses I can get thrown in there at low cost. I want efficient funds that do all of that. Probably the most important thing that I try to tell everybody who asks a question like this, though, is that the differences are small. If I switch, first of all, I hesitate to switch funds because I don't want to whipsaw people. So if I end up with a new fund that is just tiny fractionally better than the old fund, I probably won't change it. And if I do change it, even though I've decided, okay, that difference is significant enough that it warranted a change, these funds, in terms of their exposure, get more and more the same with every year because there's competition, and competition tends to weed out the failures in the market. It weeds out those that can't compete, and it makes those that can compete more and more the same. And so it's fantastic that DFA has brought out funds. The DFA funds, they're not actually that different from the Avantis funds, because the Avantis funds were created by people that came from DFA, right? They are different, but it's not an earth-shattering difference, and it's not necessarily superior. So when people are asking these questions, I usually tell them I'll be running the analysis again next year. I'll let you know what the answers are, but I wouldn't let it stop you from investing. Get going.
All right, that's great. Thank you. And Daryl, here's a good one for you. Small cap value had a great long-term return, but more people are aware of them now, and many index funds are built specifically with small cap value companies. What impact do you think the public awareness will have on the future of returns? And what can you give us about small cap value that should give us a sense, and this is kind of addressing another question in here, that we should continue to get the same kinds of better returns from small cap value versus the S&P 500, for example?
Wow. I think this is my personal opinion based on what I've seen looking at the data. And I think if you go back and you look at when the small and value factors were discovered by back in the early 90s, somewhere in the mid early 90s by Fama and French, and then you look at the outperformance of small cap value versus total market since then, it has narrowed. So why is that? I don't know why that is, but one could surmise that it's because it's becoming more exploited, maybe. What was the second part of that question?
I want to follow up on that though, Daryl. You have done a study that shows, the telltale study that shows that the difference between the S&P 500 and small cap value has had 15 to 20 year periods. I think
Right.
there have been 3 periods where small cap value was way behind the performance and then cracked back up.
Wasn't behind, it was even with.
Well, no, what I mean is, no, it was behind at one point and then came back up to being even. In other words, that for a 15 to 20 year period, small cap value was performing at a lesser growth rate than the S&P 500, and after maybe 15 or 16, 17 years, they're even. They've been dueling it out for 17 years, and finally you got the same return from both investments. But there were periods back in the 20s, in the 30s, where small cap value way underperformed the S&P 500. And then, of course, they will have these periods of amazing outperformance for relatively short periods of time. So, I mean, we don't know whether we're going through one of those long periods of underperformance and then hopefully outperformance. In fact, what we know the last few years is small cap value has been doing better than the S&P 500. So maybe this is the start of something that will go on for a longer period of time. There we go.
No, here's the relative performance chart. Yeah. And so yeah, it's typically been kind of bursty when things happen. They wait for a long time and then they kind of come in great waves, if you will. And then from about the mid 2000s, after the early 2000s, there was a large burst in small cap value, and since then it's been all things considered relatively flat. This ends a couple of years ago, almost 3 years ago now, I guess. So, but and it has done better recently, but I'm not sure it's back up to even yet. I'll have to update these charts. So but if you go through and you look at the difference between the compound rates of return over the periods of time since the mid 90s through now is actually it's actually smaller than it was before. If you look at the slope of the line from here to here, it's less steep than it is from here to here.
Okay.
So it's not as dramatic as it has been. Whether that's because it's been discovered, I don't know. I'm not a fundamental analyst. I don't have the chops to do that. So I don't know whether there's something in the fundamentals that says that the value premium is going away.
But it looks to me like from about 1948 through about 1965, really, it just moved sideways.
Right.
The returns were virtually the
same.
The same.
Right.
And
so that's why it doesn't bother me. That's why it doesn't bother me over longer periods of time to be in small cap value instead of the S&P 500. Because if you're a buy and hold longer term investor, you rarely, it happens, but you rarely underperform over those periods of time, the S&P 500. So
in fact, I think you had something on that in terms
I do, and I can't find it right
now.
now.
Okay, no problem. No problem. Let's talk about a question that came in that says, how do you think returns using your worldwide diversification will compare to a globally diversified total world ETF like Vanguard has? I mean, some people, I think, consider that representation because it has small cap in it. Not very much, but it does have small cap and it does have value. What do we have that we could say would be a fair comparison of that? And if it's not obvious to you, I've got an idea, but what would you use to compare those numbers?
Yeah, I think that the gist of it is he's comparing a total world market to our ultimate buy and hold, right? And the total world market fund is, unless it's a tilted fund, one that tilts towards small in value, it's going to hold. It is going to have small and it's going to have large, but the small is going to be offset by the large, and the growth is going to offset the value, so that all you get is market return. Now, that's not a bad thing. Market return's a good thing, but what we do in our portfolio is bring in exposure to small and exposure to value, and that should have a higher expected return and a higher expected return per unit of risk. Yeah.
Got it. Okay. And what do you got here, Daryl?
So this is a no-nonsense portfolio. It's kind of a tabular quilt chart, but it's over the last 50 years or so of what we had for the no-nonsense portfolios a while back. And so this is decadal performance, for example, and the total world is in here. It's right here.
Oh, yeah. So
total world. And then there's somewhere in here, there's a total US. Here's total US. So you can see that they don't necessarily have the same return.
Okay.
In the 70s, the world market had a 9.8 and the US had a 6.0. In the 80s, the world market had a 20 and the total US was a total US. It had a 16.7. In the 90s, the world market had an 11 and the total US had 18. Mm-hmm. So, and if you look at small cap value, is there a small cap value one in here? I don't remember.
Hey, look at the 2000 to 2009, the total market was a break even, and
right.
And the worldwide was 1.1, made
right
1% more.
Right. And then in the next year, the total world, or the next decade, was about 12 and the total US was 15.
Yeah, this is great. We ought to have this up on our site and a link to it for people to take. I think it's very good, because I get a lot of questions about, is it really worthwhile having the international? And of course, when we look back at the 70s and we look at the 2000, those two really bad decades overall, at least historically, the broader diversification actually paid a premium.
So in 4 of the 5 decades, the worldwide 4-fund Merriman portfolio, which is similar to the Ultimate Buy and Hold, outperformed the total world market.
Yeah,
And
that's what
I
I
think
was
that's
gonna
consistent
say.
with what we said before.
Ah, yes.
Yeah.
It's
Yes.
only the last
Yeah,
decade.
if you wanted to do a worldwide portfolio, yeah, if you wanted to do a worldwide portfolio, buy the corners of the box. So I guess that's not really the corners, but
Well, it's
So
only the last decade, 2010 to 21, where the total world market outperformed the worldwide 4-fund, and the difference there was 11.7% for the total world market versus 10.9 for the worldwide 4-fund. But in the previous decades, the outperformance of the worldwide 4-fund was substantially more. Yeah.
yeah.
And let me,
here's
for people who are listening to this and can't see these numbers, in the 70s, the worldwide 4-fund was 13.9, and the total worldwide was 9.8. And then in the 80s, the worldwide 4-fund was 23%, and the total world was 20.3%. And in the 90s, the worldwide 4-fund was 12.2, and the total worldwide was 11. And then in the 2000 through 2009, the total worldwide, the 4-fund worldwide was 7.2, and the total worldwide was 1.1. And then finally, the 4-fund strategy was 10.9 from 10 until 21. And for the total worldwide, it was 11.7. So it only, am I right? It only had one period that
Yeah, just that last
Yeah.
10 the 10 years, 2010 to 21.
all right.
now remember what the worldwide 4-fund has 25% U.S. large cap, 25% U.S. small cap value, 25% international large value, and 25% international small cap.
And I think the point to be made about that 4-fund strategy is what you're doing is you are exposing people to the same percentages of large blend, large value, small blend, small value, but you're doing it with different funds than you would with the all US 4-fund. But I mean, what the academics would say is that you're getting your small cap value, you're getting your small cap blend, whether it's from the US or international, it's helping. All right, let me move along here. It says, Chris, why do you recommend different ETFs for taxable and tax deferred accounts?
Tax efficiency.
Hey, that's a good idea.
Yeah. So, well, tax efficiency, and also, related to tax efficiency, yield might be a secondary characteristic. But the biggest difference is in the funds, though. If you look at those portfolios, the overall portfolios, is that the taxable portfolios have different bonds in them. The tax deferred portfolios, the bonds can generate yields at normal rates, and they can be taxable yields, and it doesn't matter because they're in a tax deferred account. But if you look at the taxable portfolios, we use tax advantaged or tax like municipal bond funds. in those to try and lower the tax burden in the taxable account.
So I've got one more short topic for you guys, because we still get questions about helping people with their 401k. And a lot of folks who follow our work may not realize that we actually at one point had analyzed, I think it was 100 or more than 100 401k plans for people. But that was when we had analyzed the recommendations based on trying to create the ultimate buy and hold for everybody, which of course, Chris, when he came to work with us, said, we got to make this simpler for people. And then my famous meeting, famous for me, but with John Bogle, where he chastises me for making things so complex. And so we've made it simpler. And today, if we went back and we kind of started over and we're trying to figure out how can we help people with their 401k? Well, it might be they have small cap value in the S&P 500, and they could use that strategy. They may have all 4 funds of the U.S. Only 4 fund strategy. And so I guess my question is, and I'm sure you guys have thought about this from time to time, is, and Chris, I know you've done some work in this area about trying to figure out a way to give people some specific recommendations, but in a general way, I guess, is what we'd be looking for, because we'd like to be able to give some sort of advice that could help everybody with their 401k next year. So what are your thoughts, Chris? You've done it before, so what do you think?
I think that a lot of our listeners would be able to come close on their own to figuring it out, and many of them probably already feel comfortable. It comes down to what are the key attributes of the portfolio that you're trying to create. What are the attributes that matter most to you? And then how do you achieve them with what you got? You're cooking, right? You got a few ingredients here on the table and they're not the ones in the recipe. How do you, well, like, what's the substitute for pepper? So I think there's an intuition about it that's pretty good. If you're trying to, if your first priority is U.S. international mix, your first priority should probably be equities and bonds. And for young investors, it's going to be mostly equities. But for older investors, that's going to be your first fork in the road. Second fork in the road is probably going to be value versus total market, and then maybe size versus total market, and then U.S. versus international. And so you have to look at the ingredients you got and figure out how do you best approximate the recipe that appeals to you the most. And you just said something that I hadn't really thought of, and that's that we've given people more recipes, and those recipes we know historically have had relatively similar performance. So I think that enables people. What I would really like to get to, though, and you and I talked about this on the phone the other day, is an evergreen piece that kind of captures some of these thoughts that we can let live on the website, that can coach people through solving this problem for themselves. And I think we should try and I've taken a cut at it 3 or 4 times, and we haven't been happy enough with what I produced to put it up there yet. So hopefully next year we'll get there and get something up.
Good. That's great. And Daryl, your biggest challenge for next year, out of curiosity, do you have anything hot on your plate?
I'm sure I do. You never fail to make sure that I do. So,
I'm sorry, I shouldn't.
I'm just not sure what they are right now.
Okay.
I know we're going to do the ultimate buy and hold in the beginning of the year, but beyond that, I'm not quite sure. Let me check my board here.
Well, you know something, what we know we do the first part of the year is update those tables that people depend on us for, the fine tuning, the distributions, all of those, and that by the way, that work is so valuable. I spoke to 144 engineering students at Rutgers last night,
Hmm.
And they've asked each one of those students to share what they learned. What was the big takeaway from the presentation? And I hope the big takeaway is the people at Merriman have a lot of tables.
Yeah.
Anyway, I really appreciate you guys. You're so much help to the people that follow our work, and you create so much of the real blood and guts of what they need to know. So thank you both, and as always, we'll see you next month for a Q&A, and we have a couple of other things coming out shortly that we have recorded. So we got I think some good lessons coming up here for the last part of the year. Thanks for watching. Thanks for listening. And I'll give you thanks now for all the people you're going to suggest come check out our work. We appreciate it when you spread the word. Thanks very much.
Paul Merriman with Sound Investing. Sound Investing, soundinvesting.com, and paulmerriman.com are produced and exclusively owned by Paul Merriman, who is solely responsible for their content. For more information, free articles, mutual fund recommendations, and more, visit paulmerriman.com.
Hi, I'm Paul Merriman, and I'm a retired investment advisor. I retired in 2012, sold my investment advisory firm, and devoted my retirement to giving financial education to people of all ages, high school kids, university students, retired people. All of the work of my Financial Education Foundation is about helping people make more on their investments. I find typically that what people are looking for, particularly young people, is some way to retire early. And I think this information can help. I also find that people want to retire at the normal age, 65, 70, and have more money to spend. I think this information will help. And a lot of us not only want to enjoy our money in retirement, but we'd like to leave a legacy. Again, that is the focus of the work that I do. And today, I want to focus on the Target Date Fund, what I consider to be the #1 retirement investment, and maybe, just maybe, the best investment most people will ever make. I want to talk briefly about 3 different products, investment products, that I would say are the 3 best ever invented. The first one would be mutual funds. We all know what a mutual fund is. And then the second one would be an index fund. That was a major, major change. And then finally, the cream of the crop becomes, I think, the Target Date Fund. So let's talk about the first of these 3 great products. In 1924, Massachusetts Investors Trust created and introduced the first mutual fund. And that mutual fund gave investors something they never had before. They gave particularly smaller investors, I'm not talking about their height, I'm talking about the size of their pocketbook, the ability to invest in a broadly diversified portfolio like the wealthy could get through some trust in a bank. And they gave them the ability to have diversification amongst many stocks, professionally chosen rather than having a phone call from a stockbroker with a great pick. And they had this, as I say, the low minimum and one-day liquidity. This is one of the beautiful things about mutual funds. Unlike a lot of other investments that give good long-term returns, they're not easy to get out of once you get in them. But mutual funds, one day. And that was a big deal. Now, that liquidity can hurt people too, because that makes it too easy for them to fire the fund and take their money back because they're afraid of the market. Well, we're going to be addressing that fear in just a few minutes. And today, what do we have? We have these great big mutual fund families with mutual funds specializing in large companies and small companies and growth and value and U.S. international REITs, emerging markets, tax-exempt bonds, taxable bonds, high-yield bonds. I mean, it goes on. And if that's not enough, there are places you can go where they have mutual fund marketplaces where you can get access to many different fund families under one umbrella. Pretty amazing what has happened since 1924. All right, let's go to the second great invention, if you will, a product that I think had a huge and continues to have a huge impact on investors, and that's the index fund. 1976, John Bogle comes out with what was called Bogle's Folly. It was almost a complete failure. I mean, literally almost did not become a product because they expected to raise about $150 million. Instead, they raised $11 million. And literally, the trustees were thinking about simply giving the money back because obviously there was no use for this particular product. Well, we know with time, the public started to understand that not did you get just diversification, you got massive diversification, and you got it at a very, very low cost. Since then, the academics have done the studies, and the academics have determined that of all the variables that lead to better rates of return, it's low expenses. So the index did that. And today, literally, you not only can get index funds with low fees, you can get them with no fees. No commission to buy, no commission to sell, and literally no operational expenses being charged to the investors. What a change. When I think back to 1966, when I came into this industry, and load funds were charging 8.5%, and there were no index funds. You know, in some ways, things have never been better. And the thing that a lot of us like about the index fund is they are more tax efficient and they give higher expected returns. What more could we want? Now let me talk about those returns. I've given you a page of information here about a study by a Dr. Bessembinder. He did a study looking at every public company since 1926. Recorded their annual returns, recorded their annual dividends, so you could see all of the money that those companies made. Now, you're going to find this hard to believe, but this is what they say happened when they looked at all those numbers. 1 out of 25 companies made enough money to have a real impact on the return of stocks, less than 4%. If you looked at the other 96%, the average return was virtually the same as Treasury bills. You could have had the same return without taking any risk. But if you were able to buy the whole market, which we are today through index funds, you would have gotten the 10% compound rate of return. So the academics tell us today, if you want to be assured of getting the great return that the market has given, of course, we don't know what the future will bring, that's completely unknown, but we do have 90 plus years of evidence of how the market has done through depressions and wars and inflation and deflation, etc. It looks like that 9-10% return is what we, I guess, could expect over a very long period of time. So, the index fund gives you access to all of the companies, so you are likely to make that return. If you try to find the manager who's going to pick the 4%, they'll all try. But the odds are, and I'll show you this in just a few minutes, that they will in fact fail. So now we come to target date funds. Why do I think they're the best investment product of all time. Well, let me talk about the kinds of people that need help. There are a lot of people who study the stock market, who study the mutual fund industry. They're real students. They know about the levels of losses during the bad times. They know how difficult it is to predict the future and all the things that have to do with successful investing for the long term. But most people don't have a clue. And even some of those people who think they're experts don't have a clue if you listen to them for a while. So here's what I like about a target date fund. For the average person, starting an IRA, starting a 401k, the target date fund asks one thing only. What year do you think you're going to retire? I know the 20-year-old first-time worker, he doesn't know when he's going to retire, but he's got to think. Do you want to work till you're 65? You want to work till you're 60? You'd be surprised how many young people at the university level only want to work till they're 50. But they have some intuitive sense. And once you have some intuitive sense of when you're likely to retire, you can buy the mutual fund, the target date fund, that is built to take care of your money for the rest of your life. Not just to retirement, but through retirement until the day you die. And taken care of professionally. By the way, they do it in 5-year increments. So there's a 2015 and a 2020 and a 2025, all the way out to 2065. We even have a portfolio that we've concocted that goes out to 2085. Why? For a newborn child. Why not get them started with a target date strategy from the time they're born? All right. The target date fund has all the advantages of the mutual fund. Professional stock picking, low minimums, all the things we would look for in a good investment in a mutual fund, but they take it one step further. And that step is that they also professionally manage the asset allocation, the balance between stocks and bonds. And in doing that, they are addressing, in the early years, the reality that young people should have a lot of equities, if not all equities, which a lot of young people don't want to do. 30% of millennials believe that cash is the right place to have investments that you want to count on over 10 years. I mean, that is a disaster waiting to happen for most people. So that professional inside of a target date fund is going to expose you to this diversified portfolio, probably all equity or 90% equity. And then as you get older, they start moving to fixed income. Now here's something you got to understand about target date funds. They're just like other mutual funds. It's easy for the manager to have their idea, or the team, or the committee, as to what the glide path should be for the rest of your life. What's the glide path? The glide path is, okay, at 20 and 25 and 30, maybe you're going to be mostly or all in equities, and then when you're 40, you start getting more money in bonds. In fact, you can see that here on this slide. I got two major target date funds here for you to look at. One is the Vanguard Target Date 2060. The other is BlackRock. BlackRock doesn't have any fixed income for the first years in their portfolio. Vanguard does. I would prefer myself BlackRock over Vanguard for that. Notice how in the very later years of their life, BlackRock has about 40% in equity, while the people at Vanguard have much less in, about 25% in equity. Well, I'd probably favor 25% in the latter years of one's life, because built into a portfolio that's got 40% equity is a loss of about 20 to 25% of the value of your portfolio. Too much for most people. So you should know about the glide path. And where you find that glide path is at the bottom of the portfolio page on Morningstar free service. Look at the portfolio page, and down at the bottom, you'll see the glide path of every target date fund. So why do I consider the target date fund the investor's best friend? Well, first of all, let me tell you about what my experience is with investors. When I was an investment advisor, I dealt with a lot of retired people. And when I did workshops for the public, I spoke to a lot of retired people. And the greatest security they felt in their life came from getting a pension payout every month. They never had to worry about whether the stock was going up or down, the stock market. They only had to think that, is the company still solvent, or wherever that money is, maybe with an insurance company, are they solvent and able to pay me that monthly income that I get from the pension fund? Now, we all know that there are very few pension funds left. But when they were there, people loved them. And here's what happened. The company, the corporation, said, hey, we could pay these people more money, but let's create a benefit where they stay with the company, and we're going to take part of what they would have otherwise we could have paid them, and we're going to put that into a pool where it will be professionally managed, so that when they get to retirement, there'll be money there to, in essence, create the cash flow they need for their pension. Now, what I think is interesting here is that that's the way it was. The employee didn't have any choice about the money going into that pool. The employee didn't have any choice about how the money was going to be invested. They only had the hope that when the time came, the company would be able to meet their obligation. The target date fund is as close as we get to the pension. Because in the target date fund, you have to make the commitment. Now, the company may match the early dollars, but you have to put in some to get that. And you have to put in more if you're going to get where you're trying to go in terms of retirement. And you are going to have somebody, if not you, decide how to invest it, and that's what the target date fund does. It does, in essence, what the trustees used to do in the pension, or still do for some. And the beauty is, you stay out of all of the emotional challenges that you might put yourself into as an investor. Chasing performance, being scared out of the market, being afraid of what's going to happen tomorrow. Oh my God, do you know who just got elected president? I mean, it's almost like every president I've ever known. I used to have a client, somebody would call and say, get me out of the market. I don't want to be in the market as long as Clinton's president, as long as Obama's president. I mean, there are emotions we have about what we trust and what we don't trust. And you don't get into those with a target date fund. And on top of that, you don't chase fads. You're not likely to time the market. What does everybody say about timing? Oh, you shouldn't do that. You'll make less money if you try to time the market. If you try to time the market, you're likely to get out of the market in 2008 or early in 2009. And a lot of people did. Still sitting on the sideline trying to figure out when to get back in. They may not realize it, but they probably just cost themselves $1 million in many cases because they did market timing. And one of the things that is actually good, not bad, investors like to be part of the herd. They really do. I know when I was in the industry and you'd have a big decline, as long as everybody went down together, most people were okay. If they didn't go up with the market and instead they were someplace where they didn't get a chance to make money, they were mad as hell. But they didn't mind it as long as kind of everybody was struggling together. And there is no bigger herd of investors than with target date funds. And I really do believe you're going to get much higher rates of return with the target date fund. But they got problems. They got things I don't like about them. They have things that I believe truly are going to cost investors a lot of money. Do you know that if a person put $5,000 away for 40 years, each year, $200,000, if they got an 8% compound rate of return, and then they retired and they got a lower rate of return, let's say 6, and they took out 4% a year, they would take out a certain amount of money and have money left over to others. But if they could raise that return from 8 to 8.5 during the years that the market they're putting money at risk, and then make 6.5 instead of 6 when they're in retirement, the difference in what they will have over their lifetime, what they will spend and what they'll leave to others, is almost $2 million. That's what I don't like about target date funds. They do things to investors that I think do cost 0.5%. In fact, I think that they likely cost them 1%. Now, I want to talk about those, then I'm going to tell you what I think we should do about it. First of all, I've already brought up the point about bonds, that having bonds in the portfolio early, that's costing people money in terms of return that should be taking the risk of an all-equity portfolio when they're in their 20s and their 30s. 10% in bonds over time reduces the return of the portfolio by 0.5%. So there it is, right there, for the first 20 years. You got 10% in bonds when you shouldn't have 10% in bonds because you're young and you should be willing to take that risk. It's costing you that magic 0.5%. But let me show you bonds. Let me show you how poorly bonds produce. Now I'm thinking about these 30% of millennials saying cash is where you should be. This particular chart goes back to 1928. From 1928 to 2018, it looks at short-term bonds, intermediate-term bonds, and long-term bonds, all governments. And what do we see? We see the compound rate of return of T-bills, short-term, is about 3.3%. And a $100 investment in 1928 over the 91 years would have grown to about 2,000. Go to the long-term bond. Instead of 3.3, it's 5.4. It is more volatile than the short-term bond, more risky on a short-term basis. But look, it grew that $100 to 12,000. Now that's a big difference. But what if? What if we had your money, instead of in bonds, we had it in stocks? How would you have done? Well, over that 91-year period, the S&P 500, that what they call large cap blend, that asset class compounded at 9.7. If you were in small cap value, the riskiest of these 4 asset classes, the compound rate of return was 13.1. What happened to $100? Did it grow to be worth, what did I say, about $2,000 or $12,000? No. It grew to be worth, in the case of the S&P 500, over $450,000, and in the case of small cap value, over $7 million. Now, I'm not in the business anymore. All I am is a teacher. That's it. I love teaching. I think I may do more good work in my retirement just teaching than managing money for people, because there are so many people that need to see this information. So when young people say that they think that they're better off in the long term in bonds or cash than they are in equities, well, let's look at the 40-year return of the equities. The 40-year return, the average 40-year return, was about 10.9% for large cap blend, the S&P 500, and was over 16. This was the average 40-year return. You can see the worst and the best compound rates of return from 1928 to 2018. And anybody who could conclude that for the long term it is safer to be in fixed income than it is in equity don't understand the impact of inflation, because inflation would take most of the money that you would have made in those bonds. I'm not saying bonds are bad. bonds are good at the right time, when it is time to get defensive, and that is in the latter years of your working period. When you start getting closer and closer to retirement, you need to have what I guess we would consider to be more confidence. You can't be taking high risk when you're 55 and 60. Also, the target date funds are not particularly good for taxable accounts. Now, that's not a big deal for a lot of people, because most of their investments are going to be in IRAs or 401ks. But here's a killer. And remember, I talked about that 0.5% and that 0.5%, or the 1%, 0.5%, and what that does over a lifetime to you? Well, there are actively managed portfolios in the target date fund universe. And guess what they're charging? In many cases, they're charging over 1% a year for active management. Now, by the way, if those active managers could be counted on to make more than the indexes, starting at 1% more approximately, because you can get the index-based target date funds for 1/10 of 1% or 15 1/100ths of 1% versus more than 1%. If those active managers could be counted on doing better, absolutely would be worth it. But there is no evidence. In fact, the evidence is just the opposite. The evidence is, according to the Standard & Poor's semi-annual report, they do this twice a year, every 6 months. They look at every mutual fund in the U.S. By the way, they do it internationally too. If you just do a search for SPIVA, S-P-I-V-A report, you'll be able to find the huge, it's pages and pages and pages of information that would make you believe active management is not in your best interest. But here's a bottom line number we know. We know that if we look at all of the large cap U.S. funds, and we look at 1 year of performance, this was as of mid-year 2018. We look at 1 year's performance, we see that about 37% of the funds, actively managed funds, were able to do better than the index itself. Most funds, even at the 1 year time frame, in fact, in the case of small caps, it's even worse, because 73% were not able to beat the index. But when we get out to 15 years, and we're talking about 15 years, we're talking about 40 years in many cases. When we look out 15 years, the research shows, and this is not somebody who's trying to sell indexes or trying to sell active management, they're just trying to report the facts. But when you go out 15 years, in the case of small cap, a little more than 2% of the managers are able to beat the index itself. Mid caps, not quite 5%. Large caps, not quite 8%, are able to beat. Less than 1 out of 10 in each case. So if you had to place a bet, if you were going to Vegas and you were going to place a bet on active management or passive indexing, what do you think would be the smart thing to do? Now, I don't know what odds they'd be putting on it, because if you happen to pick one, the active manager who did better than the index, then maybe you get a big payoff because it's so uncommon. But the odds are, if what you're talking about is your own personal bottom line, how much money do I have at retirement? How much money can I take out of that money in retirement? How much am I going to leave to others? If you want the probabilities on your side, you know where you're going to get them. And that is in the index approach. And not only that, but an index approach within the target date fund. Other problems. You know something, the target date fund doesn't know what else is going on in your life. They don't know if you just won the lottery, your parents just died and left you billions. They don't know this kind of stuff. So it just assumes that in essence, you're one of the masses. Now, there's nothing wrong with being one of the masses when you're being taken care of, but the target date fund does not take that into consideration. And if I had my way, I'd have 3 levels of risk at Vanguard. I'm a big Vanguard fan. I would have 3 levels of risk in the target date fund. I'd want to have a level that would really respond to those 30% of millennials that are scared to death of anything but cash. I'd say, okay, give them a conservative strategy, something they're more likely to stay the course with. Have a moderate level, and have an aggressive level for the people who understand, but they don't want to have to fool with it themselves. They want somebody else to do it. It's not a sin to have somebody else manage your money. I know a lot about investing. I have someone who manages my money and my wife's. Not because I don't know how to do it, but it's not what I want to do with my life. I'd rather be here teaching by far. So it is my sense that we need multiple levels. And also target date funds have the same exposure to equities at all different levels, age levels. How can that be? How could a 91-year-old at Vanguard have the same? Now, they have less in equities than a 21-year-old. That part is true. But the equities they do have at 91 are the same equities as they do have at 21. That's not right. There's too much evidence. It's not a sales pitch. There's 90 years worth of documented evidence that some asset classes do better than others. Yes, the S&P 500 is a wonderful asset class. But there's mid-cap, there's small cap, there's value. And so I would want a young investor to have a more diversified portfolio. That, by the way, when you mix them together, this is the beauty. When you mix a portfolio of some big and some small and value and growth and U.S. and international and REITs and emerging markets, turns out, I've written about this, the ultimate buy and hold strategy is about that. It turns out the risk is virtually the same as the risk for the S&P 500, but the return is higher. And then the biggest crime of all, from what I know about the past, is they don't have much in value and small. And value and small have been big winners. Just ask Warren Buffett about large cap value. Made him a very, very wealthy man. Now what he tells people to do with their own money is put it in the S&P 500. I just want to grab him by the neck. Not that the S&P 500 is bad. It's just that you would think he would teach that maybe some of their money should be invested kind of like he did. So what can we do to overcome the weaknesses of the target date funds? Well, here quickly are some suggestions. One is, if there's too much in bonds, you could build your own target date fund. Remember, the first 20 years at Vanguard is basically in the equity portion, 70% U.S. Total market and 30% total international market. You could just buy those two funds, put them together, 70-30, but take the bonds out. It wouldn't be a target date fund, but at age 40, when they start adding more fixed income to the portfolio and you didn't want to do it, you would then simply convert your total market U.S. and total market international into a target date fund at age 40 and let them start adding the fixed income. Not inappropriate. Too much in bonds? Well, you could buy a target date fund and then buy a second fund, and the second fund, equity fund, added to the target date fund would reduce the overall percentage of bonds. That would have a positive impact. Too little in small cap. Well, what you could do is you could buy the target date fund and you could put a small cap fund with it. Call it 2 funds now instead of 1. but easy to do. It'd take you 10 minutes a year to do this. And you would simply put some small cap with the larger cap that's in the target date fund. Too little value, same thing. All you have to do is add a value fund to the portfolio. Now, it starts to get better. I mean, it turns out that you could actually add small cap value to the portfolio. When you add small cap value as your second fund, you are picking up small, that has a history of a premium, and you're picking up value. It's interesting because large cap and small cap value tend to go up and down together. Not always, but most of the time. But the small cap value goes up more, this won't be a surprise, and down more. The large cap value doesn't go up as much and doesn't go down as much. So depending on your aggressiveness, you could determine, in fact, we show performance of having 3 funds, having the target date fund, and then also some small cap and some large cap value. Now there are other things you can do. Other things you can do is go to your trustees and say, please, we think it's great that some company has sold you the idea that their target date fund is going to be better because you pick better stocks than an index can pick. Because an index fund, they'll say, owns all the bad ones too. Who wants to know they're going to own all the bad ones? Well, folks, that's the way an index fund works. But it's a great sales pitch to fight it. But you want to do something right for the employees. Simple. Just add a lineup of index base. I don't care if it's Vanguard or BlackRock or Fidelity. Add a lineup so that those of us who believe that indexes are going to give us maybe 1% more per year, and we've worked hard, this is our money, and we appreciate the match that you've given, and if you really want to hold our feet to the fire, then you can say you could only put the match in the more expensive actively managed. I don't think you're going to say that, are you? Because you're going to see what is probably in the best interest, and at some point you're going to realize you were probably sold a bill of goods when you ended up with those actively managed target date funds. And I believe the same thing about just index funds in general. I see a lot of 401k plans. In fact, my foundation analyzes 401k plans. Don't get paid a penny for it. None of the work that we do we get paid anything. It's all about trying to get good information to people. And we see more and more index funds popping up in 401k plans. We're also seeing more and more value funds popping up in these portfolios. Chris Pedersen is not only one of the nicest people I've ever met, but Chris Pedersen is one of the smartest people that I've met, where I'm in a position to kind of judge that level of intelligence. And we were talking about all the problems with target date funds because they don't have the right exposure to some asset classes that we think are just natural to have in the portfolio. Chris came up with an approach and a study that it just was so simple and so obviously right. Now, by the way, the only right will be what happens that we don't know today. So I can feel very strongly about something that's being done and be wrong. And that's the nature of the investment industry. But we were talking about, could we make it so simple as having just 2 funds? There are a lot of people who love the idea of finding 2 funds. For retirees, many times I've talked about combining Vanguard, Wellington, and Wellesley. 2 funds. And it's not unusual to be able to find 2 funds that can do most of what you need to be done during different parts of your life. But here's what Chris developed. First of all, he said, what if we took a target date fund and just put 10% in small cap value? No rebalancing, 2 investments for life in essence. One's the target date, the other 10% is small cap value. Is that going to threaten your existence, do you think, to have 10% in small cap value? I think not. Then he also looked at having 20% in small cap value. Obviously, we would expect the returns to be higher by having 20% rather than 10%, and you'll see in a second that they were. Not will be necessarily, but were. But then he came up with something, because there's a problem. If you put 10% or 20% of small cap value in the portfolio, you run the risk that the small cap value does so well that it becomes a major part of your portfolio when you're 65. Not a good idea, because it's a higher risk asset class. So Chris came up with this simple answer. It's a formula, not patented, not copyrighted. Just a great idea for people who would, in fact, like to figure out how to add small cap value to their portfolio and still not have to kind of do anything. Just put it on automatic. Well, it's going to take you 5 or 10 minutes a year to do this. But you devote your target date fund money to 2 funds. The formula is you take 1.5 times your age. And that's what goes into the target date fund. The balance goes into either small cap value or large cap value or small cap blend or a combination of small cap value and large cap value. So if you're 20, you multiply that by 1.5, and there you go. You got 30% into the target date fund and 70% into small cap value. By the time you're 40, it's 60% in the target date fund and 40% in small cap value. By the time you're 66, it's 100% in the target date fund and the small cap value is gone. Here's some numbers. And we always struggle with what to say about numbers when we look back. I can tell you that Chris has turned the numbers inside out, looking at Monte Carlo studies and different ways to judge the risk, to judge the return. And from 1970 through 2017, and by the way, he's done this study going all the way back to 1926. And you'll be able to see that if you go to 2fundsforlife.com. And I really do encourage you to read his article. You know, this is all about do it yourself. This is not something that we have any involvement in except to help you do better if we can. But I want you to see these returns. The Vanguard-like TDF, target date fund. How can you create a Vanguard-like going back to 1970? There was no Vanguard target date fund until 2004. So what you do is you take their glide path. And the asset classes have been around. You can see how the asset classes have done using the glide path that Vanguard creates and shows you right there on their page in Morningstar. So what did Chris find? He found that if you put away $10,000 a year, and in order to kind of make up for whatever raise you might have gotten or the inflation, he adjusts that amount each year for inflation to make it more real. Make it in today's dollars, I guess you could say. It was about $800 and some thousand invested. But the Vanguard-like target date fund grew to be worth almost $8 million. If you put 10% in small cap value, 90% in the target date fund, it was $10.3 million. not only does that change how much you take, this, by the way, is at age 65 in theory, 40 years of doing this. Actually, these are 40-year periods from 1970 through 2017, so you have more than one. But when you put in 20%, it turns out to be 12.6 or $7 million. More to spend, more to leave. And then you'll see on the table here that it shows the returns of the 1.5 times your age using large cap value, 1.5 times your age using small cap, 1.5 times your age using small cap value. And those returns, by the way, which are much less risky, are still significantly above what you would have gotten had you been just in a target date fund. Look, many of you, as this video was made for professionals, CPAs and some others, you have an impact on other people in a number of ways. I happen to know with CPAs that they are probably the most trusted individual within the world of money. Partly because we expose everything to you about ourselves, including all the mistakes we make. Nobody knows more about us than our CPA. But I do think there's an area here where you can have an impact on a trustee with a 401k plan. You'll probably know that they are a trustee with the company. It could very likely be they are the president of the small company. You have an impact on your clients who have children who are hopefully going to be investing in the right way for their financial future. And finally, you have yourself and your own family and the people who work for you. I was recently in a large organization that is in the accounting industry, and I was surprised to find out they do not have target date funds in their portfolios for their employees. Again, I wanted to go for the neck, but I just know that whoever sold them what they got didn't want them probably to get into target date funds. Because once you get into target date funds, you realize you don't need a lot of fancy advisors. My life is about writing articles at marketwatch.com. I'm a regular columnist there, doing a podcast every week, answering questions, doing all that I can to help people do better in their financial lives. I hope you will put me to the test to see whether when the rubber meets the road, we are really there to try to help. I appreciate your time. I do hope you will share this information with others. And go see twofundsforlife.com. And I think you'll feel as impressed with Chris Pedersen as I am. Thank you.
Hi, I'm Craig. The goal of this video is to provide an overview of the strategies that are available in the Lifetime Investment Calculator. This slide represents the strategies that you will find in the strategy dropdown. And as you can see on the left of each table, I've listed the strategy, and on the right, I've listed the asset classes for which the strategy is comprised. So the S&P 500 is primarily US large cap blend. The ultimate buy and hold worldwide includes the 10 asset classes that Paul is so famous for. And you can see I've listed the remainder here on the right-hand side. We'll start this video by looking at the all small cap value US strategy and comparing that against the S&P 500 so that you can see how the strategies have played out over the 51-year period. So I'll go ahead and switch over to the calculator. As always, I start with the default view. I'm going to get rid of some of the noise. So I'm going to remove the equity fixed income allocation so that we're not looking at any bond information. I'm going to start with just $1,000 to show so that we can show the 51-year growth of that $1,000 with no contributions. So I've zeroed out the contribution amount per year. And then we're going to start with, I've added this S&P 500 baseline to all of the strategies. It's available in the equity and fixed income allocation as a checkbox. So we're going to jump straight to that all small cap value US. And now we can compare the large cap blend of the S&P 500 index against the small cap value US portfolio. As I scroll down, you can see that over the 51-year period, the S&P 500 large cap blend would have grown, $1,000 would have grown to $179,000. In the all small cap value US over the 51-year period, it would have grown to $639,000. So that's a huge difference, of course. Now let's trace down the years and see the history, right? I'm always focusing on the big losses and the volatility so that I can better prepare myself for when those losses happen. You can see that both the S&P 500 large cap blend and the all small cap value portfolios both had down years in 73 and 74, right? The small cap value lost 30% in 73 compared to the large cap blend of the S&P 500, which only lost 14%. So you can see that these small cap companies, the small cap value companies, performed worse during this period. There was also a bit of volatility in 87, whereas all small cap value lost 6%, but the large cap blend of the S&P 500 gained 5.2. And there were much worse losses in 90. But in the year 2000, the large cap blend of the S&P 500 had a bear market, a loss of 9.1% compared to the all small cap value. So you can see in the year 2000, when large companies were down, small cap value companies were up for those 2 years. And then there was a small loss in 2002. Looking down to the S&P 500, the 2008 financial crisis, right? In 2007, small companies took a hit, but the large blend companies didn't in the S&P 500 in the US market. So this is really interesting to see this history and the volatility that's available in small cap value. Of course, the returns are huge compared to the S&P 500. Now we're going to flip over to the four fund strategies. We have a US version where all of the asset classes are in the United States, and then a worldwide version where half of the asset classes are in the United States and the other half are in international markets. In this case, we're trying to hit the four corners of the market. So we're looking at large cap blend, large cap value, small cap blend, and small cap value. You can see in the international worldwide four fund strategy, we put the large cap value and the small cap blend in the international markets as well. So I'll flip back over to the strategy and then change it here to the four fund US. Again, we're comparing it against the baseline of the S&P 500. And let's see how that does. As you scroll to the bottom of the 51-year period, the four fund US strategy is at $345,000 compared to the $179,000 of the large cap blend in the US market. In terms of volatility, we can see, similarly in those bear markets, you've got a 23% loss in the 4 fund compared to 14% loss in 73. But in 75, you can see that the 4 fund strategy comes roaring back, right? In 1975, it was a 51% gain in the 4 fund compared to a 37% gain in the large cap blend of the S&P 500. We also experienced a little bit of different volatility here in other down years of the S&P 500, so namely 77 and 81. And then jumping down to the 2000, you can see, again, that extra diversification of the 4 fund strategy doesn't have those down markets. So in 2000, it's grown, most likely because of that small cap value that we showed earlier. It grew 4.1% as opposed to a 9.1% loss in the S&P 500 large cap blend. There are a couple of down markets with similar. 2008 was a similar level, so 37.6% loss in the 4 fund versus a 37% loss. And then there were some losing years in the 4 fund strategy compared to the S&P 500. Right. Now we'll diversify further with the worldwide. So I'm looking at the 4 fund worldwide strategy, and this is 50% international, 50% US. So in this case, we've added, the international component, which is further diversification outside of the United States. And, we can learn similar lessons, right? 73 and 74 in this 4 fund strategy, we're also down. They seem to be greater. So it looks like compared to the previous 4 fund US, the addition of international made it more volatile. So I'll just quickly flip back and forth there. Well, forgive me. I've noted this incorrectly. So in the US, in the 4 fund US strategy, we had 23 and 22% losses in 73 and 74. But when we diversify into the worldwide strategy at 50-50, the loss in the first year is 15%, and the loss in the second year is 30% instead of 24%. So that's an interesting piece of information there, that in the first year, the international diversification helped us, but in the second year, it hurt us of 74 of that bear market. So now we're going to shift over to the all value worldwide portfolio. You can see we're trying to capture value and a bit of emerging markets in this strategy. We capture both large cap and small cap value, both in the US and internationally. So I'll flip back to the dashboard and we'll check this one out. So in a 50-50 asset allocation, let's see how we did. The all value portfolio in these bear markets of 73 and 74, again, you can see that the value, we did better than the S&P 500 through this diversification in 73, but in 74, there was an impact where we had, it looks like the international markets were impacted as well in 74. In 81, the S&P 500 was down 4.9%, but this all value worldwide portfolio was up 10.6%. So this suggests, of course, that the large cap blend of US S&P 500 performed worse than this diversified all value portfolio. So the value stocks won during this time. Going down to the 2000, again, focusing on the bear markets, there was in this all value worldwide portfolio, there was a 1% gain instead of a 9.1% loss. But there was some extra volatility in the future years of 2011, 2015. To wrap up, you can really see how the different asset classes have had an impact over these past 51 years through the different strategies that the Merriman Foundation promotes. We started by looking at all small cap value US, comparing that against the S&P 500. And then we shifted over to the 4 fund strategies, both in the US and worldwide, followed by a quick look at the all value worldwide strategy. We hope that you can continue to dig in and look at the other strategies that we have here, in particular, the fully diversified ultimate buy and hold worldwide strategy. Or if you're interested in all small cap value worldwide, you can see how that has performed over the years. Our goal with these videos, as always, is to provide you the tools so that you can dig in and learn about the past and hopefully make better decisions for your future. Thank you for tuning in. We really hope that this video has been helpful in understanding the different strategies that are available in the Lifetime Calculator, but also promoted by the Foundation. We look forward to continuing the conversation through video. Please feel free to share any feedback that you have over email.
Well, I have a real treat today. In fact, this is something I have waited literally years for, because way back in 1999, when I was working as an investment advisor, our offices were in what was called or still is called the AGC building. It's a beautiful building right down on Lake Union. And as good fortune would have it, a guy named Paul Hayes pulled his boat. In fact, his boat is called Investorship. He actually, I found out, offered classes on that boat about how to be a good investor. And boy, this is somebody I want to meet. And I did, and we have been friends ever since. And for full disclosure now, because I just hate conflicts of interest, Paul is an old friend. He is part of the reason I live on Bainbridge Island, because he put his stamp of approval on Bainbridge Island when I met him. And he is on our board here at our foundation. So it gives me great pleasure to introduce Paul Hayes. And Paul, welcome, and tell our listeners and our viewers, by the way, we have viewers and listeners because this is both a podcast and a YouTube piece. Please tell us a little bit about your background so we'll know why you are qualified to have written a book, Spending Your Way to Wealth. And that's what we're here to talk about. And Paul, we're here to talk about it with you. So tell us about yourself.
Well, that's interesting you remember the boat, because that was a boat that I acquired right after retiring from a career in the financial industry as a financial advisor with a New York-based financial firm. And I served clients that were both individuals, corporations, and municipalities. And at the point in my career, I reached where I no longer needed to work, but I had an abiding interest in the financial industry and saw some things that I thought could be made better or could be made more understandable. When I retired, I commenced a relationship with a psychologist that was introduced to me at the University of Washington, Ron Smith. And he was introduced to me as one of the most qualified people that this particular individual had knew to deal with financial decision making, because Ron's entire career had revolved around being a personality psychologist. He had spent many of his university years also as a sports psychologist, working with professional athletic teams who hired him to come in and help the professional athletes perform better, enhanced behavior. And it seemed to me that this was exactly the kind of person that could help me put together something that would resemble a course, would help people make better financial decisions. So after getting to know him, we hit it off immediately. We put together a body of work and we started putting on seminars for corporations and individuals. And as you mentioned, they were held on board this vessel, which would seat 10 people comfortably inside a cabin. And we talked to people about how they could understand their personality and their behavior, and in fact, enhance their performance in investment or financial decisions. And we did that for quite a number of years. Ron was invited to come back to the University of Washington and head up the clinical psychology program there, which he did. And he also was a prolific textbook writer, wrote numerous textbooks in professional journals that were published by McGraw-Hill. But we stayed in touch over the years. I moved to Bainbridge Island and immediately started putting on some workshops in the high school and in the community, still dealing with personality psychology and how people make financial decisions. That's when Paul and I met, was when he moved to Bainbridge Island, and we got really connected and became friends. But we've both seen eye to eye on so many things. Paul has no conflict of interest approach to helping people make financial decisions, which is critical. And he's an educator, an excellent educator who understands not only his subject, but he understands the people he's talking to. And so we've seen eye to eye, and his avenue is in investment advice, or not investment advice, but investment education, investment information. And my area of expertise now has morphed into how do you understand the psychology that goes with financial decision making. So that's a little bit about my background, and that's who I am.
Great. That's great, Paul. And really, when I saw your original handout material on investorship, and I said, boy, now that is going to be a good book someday. And it took about 20 years, but you've done it, and I think it's absolutely terrific. And I highly recommend it, and we're going to find out why in the next few minutes. And I'm going to save one piece of information to the very end, and it's something I think that Paul hasn't thought about in terms of the value of this book. So we'll see if I surprise him or not. But let's talk about this book. Talk about that title, Spending Your Way to Wealth. Now, this sounds backwards to me.
Well, let me start by explaining a few words, or defining a few words, and I'm going to see an example of some terms. The definition of wealth, because that shows up in the title of the book. Wealth is an abundance of something of value. It doesn't have to be money. It could be a whole lot of things that have value. We could have a wealth of integrity, a wealth of decency, a wealth of generosity, a wealth of great memories, a wealth of friendship, all kinds of wealths that are worthy pursuits. We should all strive to have a wealth of some of those valuable aspects of who we are. And yeah, we need to have some level of wealth and financial assets so we can go on doing the things that we want to do in life and need to do. We need to have some level of financial sufficiency, maybe is a better word than wealth. And spending, terminology there, is an exchange of one thing of value for something else of greater perceived value. Again, nothing in the word spending that denotes money. Although when we hear the title of the book, Spending Your Way to Wealth, we almost think immediately that it must be about money and investing or whatever. And yeah, there's a big component of it, but it's really about acquiring those wealths that are important in life, and spending things beyond just money, spending time to get an education, spending time with family, doing the things that are meaningful. So the book has a real broad reach. It's a book that should appeal to anybody that's aspiring to have a really fulfilling life. And I like to start with an example, because the book starts off talking about how normal we are. And we are normal. But here's an interesting question to contemplate. Start with a penny and double it every day for 31 days. And how much do you suppose you have at the end of 31 days? I put on talks on cruise ships, and when I have an audience of people of some size and I ask this question, I just ask the question and people say, well, I don't know, you might have, maybe $500,000. And somebody else say, no, I think it might be more than, it might be closer to $1 million. Or somebody says, no, that seems high. Well, the answer to the question is $21 million. And I'm not sure you can see that whole slide there.
You
But,
can't. You go out to 27. I will tell you, by the way, Paul, that I posed this question to my 6-year-old grandson. And this is really terrible, but I offered to pay him if he could tell me whether he would take a job for $100 a day or for 30 days, or take a penny for the first day and double it every day. And he got out his calculator, doubled it 30 days, and said he'd take the 30-day payoff. But anyway,
well, good for him, and good for you for having instilled. Good for you for instilling in him the thought process of taking the time to consider that, because most people's idea is way, way less than the answer. And all it takes there is that 31 columns or 31 rows in a column sheet, just doubling, starting in a penny, 2 pennies, 4 pennies, and right up there to 21 million. But the point of the question is, the answer is so far outside most people's thinking area that they really can't contemplate something as big as 21 million when you start with a penny. And why is that? Why does our mind sort of not allow us to do something that's as simple as multiplying something by 2 31 times? Here's another example of how normal we are. Again, I call this windmill number 1 because I was putting this presentation on while we were cruising through the Mediterranean in Spain, and everybody was thinking about Don Quixote and windmills. But it's analogous to having a lot of windmills rattling around in our brain. A bat and a ball that costs $1.10. Pretty straightforward. A bat and a ball costs $1.10. Bat costs $1 more than the ball. Okay, again, pretty straightforward. So it's a pretty simple mathematic calculation. If you ask how much does the ball cost, it has to cost 10 cents, right? I mean, it's just intuitive. The two together cost $1.10. A bat costs $1 more. The ball has to cost 10 cents. 99% of the time, that's the answer, whether they're prompted to agree with it or I just ask the question and then shut up and let them answer. It's 10 cents.
That's what I guessed.
Wrong.
Yeah.
It's absolutely wrong. It cannot cost 10 cents. It costs a nickel. Well, why can't it cost 10 cents? Well, if the bat costs $1 more than the ball, which the question stated, if the ball costs 10 cents, which is your answer that people come up with, the bat would have to cost $1.10. And if you take a $1.10 bat and you add a 10-cent ball to it, you have $1.20. But the question started off saying they cost $1.10. So the answer that we all come up with almost instantaneously, we don't think about it, it's so obvious, it's intuitive, that answer is wrong.
And by the way, Paul, I of course got it wrong the first time as well. And even when I knew the answer, I still had to stop and think about it. It still was counterintuitive. And you're right. There are a lot of these brain the brain plays tricks on us. And unfortunately, sometimes that happens with investing.
Well, it does. And we just are so normal when we do this. I had people on cruise ship that came up to me the next day and said, tell me again how that ball cost 5 cents. Yeah. Same as you, Paul. You think about it. And I dare say people that are listening to this or watching it will have the same question. They'll go back afterwards, try to figure it out. And you can use algebra to do it. But you don't need to. Just if you know it's not 10 cents, take another number and plug it in and see what you come up with. If it costs 5 cents, the bat costs $1 more. That makes the bat cost $1.05, and $1.05 bat and a 5-cent ball is $1.20. Voila.
$1.10.
Yeah. So that's just kind of how we think. And yes. I don't want to go into.
And that's normal. You call that normal.
I call that normal, and it really is normal because that's just kind of how we think. Sorry about this.
So what is this term normal plus mean?
Well,
because that's a lot of the book.
Well, it is. And if normal means coming up with a 10-cent ball, and normal means coming up with an answer that's way less than 21 million, and I have a whole series of questions in the book, or not a whole series, but 5 questions in the book that all are easily answered and all come up with the wrong answer. And why is that? Well, it's because we're normal. We have one head, one brain, 2 arms, 2 legs. We're pretty normal in a broad sense. But being normal means we're very prone to making very predictable errors at times. And that's what the book is about. It's helping recognize that we are normal, and that being normal means we're almost guaranteed of making some predictable errors unless we can come up with some countermeasures to overcome that normal tendency that we have. And that's what I call normal plus. So normal plus would be a quality that somebody should strive for. Warren Buffett has normal plus qualities or I call them investorship qualities, qualities that distinguish somebody that's discerning, somebody that will take the time to slow down. So in this book, I talk a lot about some of the findings of the last 50 years dealing with how people think. And one individual in particular that comes to mind is somebody whose name is not a household name, maybe unless you're an economist whose
Right.
his name is familiar, but the name Daniel Kahneman. People don't know who he is, or most people don't. Most people have not read his best-selling book that was published 3 years after he got a Nobel Prize in economics. This is a psychologist who's the only non-economist to ever get the Nobel Prize in economics. And he did it because he presented enough information and evidence to support how people think that economists unanimously changed their decision-making process to incorporate some of the realities that he introduces. And basically, he introduces the concept of people make decisions not just based on reason and rational thinking. People are emotional creatures. People make emotional decisions, and those emotions influence and corrode at times our better judgment. So Kahneman's work is a pivotal part of the basis for this book, Spending Your Way to Wealth. And in the last part of the book, the fifth appendix, or Appendix E, is a 20-page summary of that book, Thinking Fast and Slow. And for those that don't want to take the time to read 500 pages, that summary will give you some real insights into who you are or how we think. And it's a great, important part of that book. And it's free in the book. It's just there. And I didn't write it. It was written by a real scholar who took the time to read the book many, many times at the recommendation of a neurologist, and then summarize it in this 20-page summary that is reprinted by permission.
Well, and let's make it very clear. The book by Kahneman, Thinking Fast and Slow, was a bestseller amongst people who are interested in that topic. But it's 500 pages long, and it has a lot of it. Even people, I think, who are interested in the topic probably didn't get past about halfway through the book and may have ended up missing some really good stuff. But the beautiful thing is about that 20-page, what I would call like cliff notes of that 500-page book. It is the material out of that book that when we talk about individual investors learning how to be better about the kind of biases and the hurdles they have to clear in order to be a success. It's a terrific read. And yes, you didn't write it, Paul, but you somehow got the rights to print it. And I just think that's terrific. But as far as I'm concerned, it's 2 books in one.
Well, thank you. It's a good way to look at it. But the first part of the book, which is the book I've written, takes what his subject matter deals with, and it tries to break it down. It talks about some of the things that corrode our judgment. You know, why do we make those kinds of mistakes that we just evidenced in the bat and the ball and in that adding up a penny or multiplying a penny? It's not just because we're normal. It's because there's certain things that we do. You know, why is that? Well, as human beings, we're wired in a certain way. Psychologists have taken the time not only to study that, but to do enormous amounts of research into the brain in terms of how the brain functions. It's said we now know twice as much about the brain than we did 10 years ago. That's how much has been learned about how processes and how things are responded to, the responses we have to certain stimulus. But why is that? Well, we have biases, and the book talks a lot about biases. We have hundreds of biases, or probably hundreds, but I sat down and came up with a list that's enormous. You know, we have some biases that are very conscious. We're aware of them. We have an awful lot of biases that are very unconscious. We don't really know that we have them, or we don't stop to think about the fact that we might have them, which we should, because those biases affect the outcome of our decisions. You know, we have a tendency as people to try to avoid conflict. That's a normal part of our human nature. Cognitive dissonance, I guess, would be the term a psychologist would use. But if we see something or hear something that's contrary to what we believe, we have a tendency to resist it. We don't want to take it on. We don't want conflict. So we tend to tune out things that are at odds with our conviction or our beliefs. And our beliefs,
especially, by the way, especially during an election year. I think that's that's where it's pretty obvious. So what if Paul, if you had to pick one of those 50 or 100 biases that make it difficult to be a successful investor, what would stick out?
Well, it would be more than one, but it would probably be a handful. If not, I mean, there's some that you can look at and say, yeah, we all fall victim to these. Not only is cognitive bias, which says we want to find things that confirm what we already believe, even if what we believe might be wrong. Mark Twain had a saying, it isn't what we don't know that gets us in trouble. It's what we know for sure that just ain't so. Right. And we know an awful lot of things that aren't right, but we think we know them, and we then turn around and reinforce them by hearing from other people who think the same wrong thoughts or have the wrong opinions.
So give us an example in the investment process where that bias hurts us.
Well, we hear something and it sounds reasonable, and so then we hear somebody else say the same thing, and it sort of confirms what we heard and what we tended to believe, and we may hear it 2 or 3 times, and it each confirms it. It just cements it in our mind to the point where somebody comes along with a different point of view, and we just, we don't want conflict in our life. We don't want to expend energy. We're hardwired to conserve energy, and that means at times we're pretty damn lazy. If you have to stop and think hard about something, that's energy consuming. And our hardwire, conserve energy goes back to when we wanted to conserve energy so we could run from a lion that was about to eat us. So we naturally conserve energy, and that means at times being lazy when we shouldn't be. We need to be able to make quick decisions. At times that can save our life, but at times we don't want to make a quick decision. That 10-cent ball was an example of a quick decision, and we didn't stop long enough to go back and think about it and come up with the fact that it's wrong and it could be made, there's a better answer. Another bias that gets in our way is recency biases. We keep hearing something. Advertising industry revolves around the fact that if you can repeat a message to people long enough, eventually it's going to impact them. So you hear the same advertisement over and over, and Comcast or somebody will give the advertiser a price incentive to run exactly the same ad 10 minutes apart. And you think, it's the same person hearing the ad. Why do you want it? Because you want to hear it over and over again. And that really does bias our thinking, because we recall and we put more weight to things we've heard often than things that may sound unusual or we haven't heard before at all.
And Paul, you talk about in the book this idea, the difference between, I guess it's again thinking fast and slow, but the reflexive versus the reflective.
Yeah.
And I think in the book it makes the point that so many of the investment decisions that we make are more emotionally driven than intellectual driven, but it's hard work to take the intellectual path, even though historically it has been more profitable.
Well, and not only is there recency bias, but there's this bias that comes from having heard it from so many sources. If all these people are saying the same thing, it almost becomes a mob psychology. I mean, mobs will do what an individual won't do. Crowds of people will invest in things that an individual might not otherwise. But if everybody else seems to be doing it, who am I to say that they're wrong? And I probably should do the same thing.
Well, I'll give you an example, Paul. Going back to the late 90s, you and I both remember Janus, the Janus funds. That name was everywhere. Money Magazine, best mutual fund family, Janus. They were hitting great returns. They turned out to be one of the worst performing families in the bear market of 2000 through 2002. They had funds that had the same thing virtually in every fund. And so they had lots of funds that were considered to be amongst the best. And people talked about, back in those days that didn't have the internet in the same way that we do now, the money came in huge sacks of mail filled with checks for a lot of money, because that name became a household name and therefore trustworthy, and it costs people billions.
Well, we have a tendency to follow trends or give more credence to a trend than it deserves. And that's an example of it that you just mentioned with the Janus Fund. Happens in mutual funds all the time, where a mutual fund will do well for a quarter or a half a year or maybe a couple of years. And people see that trend and conclude that that trend must be something that's going to continue forever. Remember, Jerry Brown, when he was the governor of California, made mention of the fact that if the population of California continued to grow at the rate it had been growing when he was governor 30 years ago, that within 10 years, 115% of the population of the United States would reside in California, because that was where the trend was taking them.
Yeah.
Well, it couldn't happen. And that's just part of our nature. And it's one of those things we have to be aware of. And we have to be judicious about it, because some trends do tend to continue over time. Some trends that are based on good, solid logic and cautious assumptions, those are trends that have a high likelihood of probably continuing. They may not continue unabated forever, and they may have periods of time where they tend to fall out of favor and it appears that they're not working. But this is a mutual funds nemesis. People will invest in a fund while it's doing well, and then they'll turn around, and as soon as it's not doing well, they'll decide it's time to get out. In the book, I talk about investor behavior and investment behavior, and a big distinction between the two, because investment performance often will exceed an investor's performance or an investor's return. How can that be? Well, people will invest in a particular mutual fund and hold it while it's doing well. And then if it starts to look like it may not be continuing to do well, the strategy of the fund may not have changed, but maybe the psychology of the moment for people has changed. And so people will sell that mutual fund maybe at precisely the wrong time. They think that that trend can't continue.
So now we're talking about investing, but I want to go back a step, because there's the spending that you equate. I mean, this spending versus saving, and then there's a word that creeps in there that's a big deal. It's called spilling. And can you tell us about this idea of spilling?
Sure. Well, it's a term that probably nobody's heard used before as it relates to money, because I'd never heard of it until I wrote the book. And I thought, nobody likes to spill anything because it's messy. It takes time to clean up. It could be expensive to clean up. And yet, applied to money, it's very relevant. It's a good term, because spilling money is nothing more than wasting money in a sense. It's spilling money is spending more for something than you need to spend to get exactly the same thing. It could be a service, it could be a product. And we tend to do it at times because it's so easy to spill money, or it's so easy to spend. I'll digress for a minute just to the whole subject of spending, because spending is probably the most common financial thing that any of us ever do. We spend so much, so often on so many things. Amazon reports handling 26 million financial transactions a day. 26 million a day. And Amazon is said to account for about 6% of aggregate sales. So that says that if you take that 26 million and you factor it up to where it's 100%, Americans are spending about $500 million a day. That's 6,000 transactions a second. That's how fast we spend money. And we do it because it's so easy. We've got money in our pocket. We don't think about it. It may not seem like a lot at the time. So we reach in our pocket and we pull out $3.50 for a latte, and we don't think anything about it. Tastes good. We like them. It's sort of soothing. It slows us down. It's kind of a little creature treat, which we need. We need to treat ourselves to things that make us feel good. But that $3.50 a day for a latte, if you put that in the hands of an 18-year-old who loves lattes and gets one on the way to school, or maybe he's just graduated, he gets one on his way to work. In fact, he loves lattes so much he buys one when he comes home from work or home from school. So he's not spending $3.50 a day, he's spending $7 a day. Well, if he just cut back and said, I'm just going to have one latte a day. We don't want to do without things that we really enjoy, but we probably don't need 2 lattes a day. But if you cut back and instead of spending that extra $350 a day, put that $350 a day, which will have aggregated up to about $200,000 of aggregate expenditures during his working career. If you put that $350 a day into an S&P index fund, and I know you talk about funds a lot, Paul, and you believe in them, and so do I. S&P index fund is probably just a proxy for the 500 major companies in the country. That guy that spent that extra $350 a day or didn't spend it and put it into the S&P index fund would have $2 million in that S&P index fund when he retired. That's what $350 a day into a S&P index fund would amount to over the course of a working career if it just did in the future what it's done in the past, which is average about 10% a year. So that little spillage, which is that extra money that got spent over and above what you really needed to, it can add up to a lot of money. And the book has a lot of examples of that. We can maybe talk about another one if you want, but
let me ask about. I think most of us parents and grandparents who are worried about our children probably like that term spilling, and we want to stop them from spilling if we can. Do you have any idea how to stop them? Or do you have an idea? How would you use your book as a grandparent and a parent yourself? How would you use your book to get these young people to understand that concept of spilling? And of course, that means understanding the concept of investing along with it.
Well, unfortunately, it's not easy. I mean, people for years have been saying, you have to spend on yourself first, and then whatever you haven't spent on yourself for investment purposes, you can go ahead and spend on other things. In other words, invest first and then spend your money later. That's a hard thing to do. People are not inclined to do it. But there are certain things in life you just have to do if you know what the outcome is likely to be or probably going to be. And putting money into a category where it can increase in value. I call it positive spending and negative spending. 95% of the things we spend money on today will have absolutely zero financial value within a year.
Now, wait a minute. I got to ask about that because I heard you say that on another presentation that you made. And I was thinking, does that 95% include the food they eat and everything that they might buy to
Yes.
survive?
Yes.
So that's one reason it's so much is because they need it to survive.
Well, I would make a distinction here, as I do in the book, between needs and wants. And that's something psychologists have spent a lot of time thinking about, and everybody should think about it because it's important. You get off work and you're thirsty and you need a beer, so you go get a beer. Well, if you're thirsty, you don't need a beer. You may want a beer, and maybe you should have a beer. Maybe that's part of what causes you to slow down and be comfortable. This book is not about doing without, but it's about taking the time to think about the difference between wants and needs. How badly does somebody really need a second latte a day? Probably not at all. They probably could be very comfortable if they had something else, maybe a cup of coffee with a little cream in it for a third the price. But that whole distinction between wants and needs is something everybody can take the time to think about. Abraham Maslow, the psychologist back in the 40s, wrote a paper. It was called Understanding Human Motivation. And in that study, he put together a pyramid of needs, starting at the bottom with what he called the physiological needs that we have and working up from that. The physiological needs are, we need water, we need air. We can't live very long without air. We not only need it, we want it badly. And as you move up, then you get up to the, we need friends, we need companionship. Those are psychological needs that we have that aren't quite as essential as water and food or lodging. But and we need safety. That's moving up on this pyramid. But you get up to the third level and you have this area of self-esteem. And that's a huge need that we as people have. But it's a need that left unchecked can be the cause of enormous spillage, because we have such a need for self-esteem that we spill money on things that will enhance our self-esteem needlessly. we probably don't need a new car every year. We may want one. We may want to park it out in front of our house so our neighbors can see it, because that's going to cause them to think, oh, these guys are really successful. They must be really wealthy. Well, we have a need to appear financially secure, and we allow that need to appear financially secure to drown out our greater need to be financially secure. That money that goes into an investment account and stays there for an extended period of time, that's money that we will need in the future. Nobody sees it. Nobody knows about it. We probably shouldn't talk about it because it's not seemly to talk about all the money we've accumulated, but we need to be doing it. But if you allow your self-esteem to drive your motivation, and you do things that showcase what you think is wealth, but maybe is just a pyramid of debt, you can allow that self-esteem to cause you to spill an awful lot. So going through that list of needs and then your own list of wants, and striking off of that list of wants, some of the things that you want, but you don't have to have immediately. Maybe you want them and you can put them off for a year or two while you park some money to be able to pay for them in cash. But that spillage and filling wants, needs is important.
So you got your normal plus, you've got your spillage. We've got, and I love the idea that we didn't really hit yet, and that is this idea that what we consider saving is really spending, but spending for the future. And you make the point so well. We are going to spend every dollar we make. We're going to put it somewhere. We're either going to put it in things that go down in value, or we're going to put it in things that go up in value. But we are going to spend it all, and that we should have a commitment to spending for the future. And is there something you could add to that would make it complete the whole idea of the saving is spending?
Well, I would add to that the fact that if you put spending and savings in the same sentence, people perceive it as polar opposites. You know, if I don't spend it, I can save it. And if I put it in savings, I can't spend it. I look at it like you just said. I look at it, I say, forget that polar opposite aspect of it, because they aren't. We spend everything we have, literally. When we put that money in the bank, we've spent it. We spent it at the bank, and the bank gave us, in exchange for the money we gave them, they give us a piece of paper that evidences that the bank owes us that money back. If we buy treasury bills or treasury notes from the treasury, or we buy a mutual fund or a real estate investment, we get something that shows evidence that we spent money and that we have something to show for the money that's spent. So I say spend everything, but take a close look at how you allocate that money. I use Warren Buffett as an example. Warren Buffett is one of the most successful investors, period. Over long periods of time, he has been extremely competent at making good long-term decisions. And he says his job, he takes the money and he owns other businesses. That's what he does with the money. That's what Berkshire Hathaway is. It's a holding company for a lot of other businesses. And so Berkshire Hathaway owns all of a lot of businesses and owns some businesses. They own parts of Coca-Cola and Geico. I guess they own all of Geico Insurance now. They used to own a large part of it. They bought the remaining shares. But the companies that he owns all earn money, or that's the basis on which he makes a decision to buy them. They earn money. And over time, the earnings come back to Berkshire Hathaway or to a shareholder as dividends. That's a distribution of the earnings. And he takes those earnings that Berkshire Hathaway receives from all of those companies that are held in the portfolio, and he takes those earnings and he redeploys them and buys other businesses. He says his job as chairman of Berkshire Hathaway is to be an asset allocator. He allocates the earnings of the businesses that he holds as investments. He reallocates those earnings into other businesses that can go on to grow and have more earnings himself. Well, if people would just take that approach and say, I'm going to spend everything just like Warren Buffett does. He spends those earnings. He may take those earnings and buy treasury bills if he wants to have readily available cash, but he spends the money. He says, I am an asset allocator. We should all be asset allocators, and we should focus our time on making sure we're allocating enough money into things that will be worth more in the future. That's positive spending. Positive spending is spending on something that will have greater future financial value in the future. Negative spending is spending on things that will have zero financial value in the future. We need to have a much greater percentage of our spending spent on things that are positive in nature and that will be worth more in the future.
By the way, you do in the book many times suggest investing in the S&P 500. And you bring up Berkshire Hathaway and Warren Buffett and what a great investor he has been. Just for the record, over the last 15 years, according to Morningstar, through yesterday or day before, the return of Berkshire Hathaway is virtually the same as the S&P 500, which says that over the last 15 years, you would have made the same return as Warren Buffett. And where does Warren Buffett plan to leave his money other than to charity? But to his wife, it goes in the S&P 500, 90%, I believe, with 10% in T-bills to pay the bills. So it's even for Warren Buffett, it's hard to do better than the market, which is fascinating for as smart as he is and all the people he's surrounded with to help him.
Yeah. Well, as people, we don't want to be average. We go out of our way to try to not be average, and we don't consider ourselves average. So the idea of owning a portfolio that is comprised of all of the companies by definition, or at least the 500, that sounds like it's sort of average. Well, sometimes average is really good. 10% a year over extended periods of time is a wonderful rate of return. So I advocate in the book that anybody and everybody should consider having a holding, not necessarily all of their holding, but having some money in the S&P index fund. And so the book goes out of its way to show how simple it is to invest in an S&P index fund, which is a fund managed by various firms. Lots of companies will have a mutual fund that's basically patterned after the S&P index fund, and they have very, very low fees associated with them, maybe 0.1% a year, and some of them and most of them are offered with no upfront commissions. So it's a very efficient use of money, something you talk a lot about, Paul, and I think people that know you know how important that is. You have a cadre of people that follow you that are very bright, intuitive people, and I applaud you for pointing that out to people that don't just assume that something is going to lose favor and jump out of it in a hurry. Have a diversification. The book also goes out of its way to point out the importance of having somebody or maybe a group of people that you look to offer financial assistance. A registered financial advisor who's a fiduciary is somebody that can be of enormous help to anybody. And some of the best things they can do is help people sort of buffer themselves from their own natural tendencies, that tendency to jump in and out of things because that's what their neighbors are doing, and that seems like the tactic du jour.
So Paul, you also focus on a hugely important topic, and that is this tug of war between thinking about short-term risk, the possibility on a short-term basis of losing money versus keeping the long-term in the front of mind rather than the back of mind. Can you talk about that bias and that risk?
Yeah, I talk about it a lot, and I try to point out to people that fallacy that volatility is risk. It becomes defined as risk by people within the financial industry because stock markets go up and down. Stock markets reflect the psychology of the moment, the mass psychology that governs people day to day. And so financial markets do go up and down. But over time, the ups exceed the downs, and that 10% average return isn't guaranteed every year. But if it's been an average over 50 some years, it's probably got a good enough track record to assume that it's sustainable and maybe repeatable in the future. That whole idea of volatility scaring people out is a shame because it causes people to react rather than just staying put. You said something else a minute ago that triggered a thought, and I lost the thought. But
Well, let me just follow up on this concern about short-term loss and volatility.
oh yes,
There's this wonderful new Wharton study that tracked 1.2 million accounts at Vanguard, retirement accounts, tracking them within some 880 different 401k plans. So they had access not to the names of the people, but to the information about what they did. And they broke that down into three parts. One part represented the people who didn't use target date funds at all. They did their own thing. The second group had some target date funds, but they also did some things on their own. And the third group was all target date funds. And this went from 2003 to 2015. And it turned out that the people who used 100% target date funds made 2.7% a year better than the people who didn't have any target date funds and were winging it. And then the ones that had some target date funds, they compounded at 1.7% better than the wingers. But what is it that those people who were winging it tended to do? They were sitting on lots of cash, lots of something that just promised they'd never lose any money. When, of course, we all know that sitting on cash or bonds is not likely to help you grow your money. But that is about the fear, particularly about young investors. It drives me nuts to know that 30% of millennials don't want to put any equities in their portfolio because they're risky, because they're volatile. And your book makes it very clear. It's not about the short term, it's about the long term, and the volatility disappears when you look at the long term.
well, the whole idea of losing money is something that just is worthy of real consideration. What's the difference between losing money and losing value? If you own something of value, you own a nice home, and let's say it's worth, I don't know, just pull a number out of the air, $750,000. You just bought it, you're proud of it, you thought you got a good value, and over time you're confident it'll prove itself to be not only a great place to live, but probably prove to be a worthy place to have some money parked. And the next day after you bought it, somebody knocks on the door and says they were looking at a study that shows that there's an earthquake fault line in Seattle that imperils Bainbridge Island as well. And that they're willing to buy your house and take on that risk, but they'll only pay you $500,000 for the house. You know, it's a firm offer. They've got cash in their pocket. They're willing to give it to you today for do you sell the house? If you did, you'd sustain a loss because you would be selling it for less than you paid for it. If you just said, no, you know, that's, I don't need to take that loss. The value hasn't dropped. The price that you're offering has dropped. But the distinction between price and value is something people don't take time to consider. You're considering it when you say, no, I'm not going to sell you my house for 2/3 of what I know it to be worth. You do the same thing with stocks. You know, if the market price of a good portfolio goes down and you sell at a lower price than you paid for, yeah, you'll lose some money. If you don't sell, you don't realize that loss. You know, if a football coach wants to win a game, he can't go into the football game and tell his team, listen, by all means, don't ever lose a yard. You know, you'll never play a football game with the thought of winning if you're not willing to risk losing yards. But losing yards is not synonymous with losing the game. You've got to be prepared to lose yardage. You've got to be prepared in the financial markets at times to see prices lower than they were the day before. If somebody had had a crystal ball and could have figured out every year for the last 25 to 50 years, what will be the high water mark for the market this year? Because I want to buy at the absolute high every year in the future. And if they were able to do that, they had that crystal ball and said, today's the day the market said it's all-time high for the year, I'm going to plunge, I'm going to buy. If they had done that every year for the last 25 years, they would have made so much money by buying at the high. Because the highs 25 years ago we're so low in relation to the highs today. And does that mean prices today are way overpriced? No, business values have gone up. Society has changed. If you're waiting to buy another $25,000 or $25,000 house,
Yep.
Good luck. Just take a good look at the history or the things you can learn from history. I take an example in the book. I take 25 years ago, 50 years ago, today, 25 years from now, 50 years from now. I say, okay, 50 years ago, the average house sold for about $32,000. $32,000. 25 years ago, the house sold for about $135,000. Today, that average house is about $330,000. Those are the increments of change over that 25 and 50-year period of time. Take those same increments of change and extend them into the future. That $350,000 house today is going to be worth about $800,000 in 25 years. And it's going to be worth, I think the number is about $2.5 million in 50 years. Just take a look at what history has shown us and take a look at the probability of modest history repeating itself.
By the way, Paul, I did look at that table, and just to correct you, it's not 330,000, it's 331. I just want you to know I actually read the book, okay? But
Good for you.
but I saw that 800 and some $1,000 what the future value of the house would be. I calculated the compound rate of return for the from 50 years ago till 25 years ago. It was about 7%, I believe.
Yes.
The following 25 years, it was between 3 and 4, I think. So even knowing where we might fall in the inflation question could have make a huge difference, but it doesn't change the impact of inflation, whatever it might be, 3% or 5%. It's a life changer for people who are trying to buy that inflation adjusted cost of living if you haven't done something to save for the future. Now, I want to go back to this price versus value because that's a great part of the book. I really like that. Address, if you will, all of these people who were asking me, Paul, how can the market possibly be up for this year? Or why aren't we down 50% with the fact of given the fact that we're in the middle of a pandemic? How can it be that people are willing to pay these prices for these companies? When you think of price versus value, what do you think the story is behind the reason that market is basically unchanged?
Well, you say unchanged from where it was prior to the pandemic.
Yes.
Well, I think people have learned a lot from the current environment. A lot of good things. There's some good things that come out of any kind of adversity. One of the things we've all learned is that we are capable of changing our behavior. We've had to change our behavior as a result of the pandemic. Some of us have less income coming in. If you had a job, maybe people don't have a job. We've been forced to do things, but we've become aware of the fact that we can do it. As resistant and reluctant as we are to change, we've proven that we can change if we need to. And I think what we're seeing people realize is, we're going to come through this. Things are going to get better. I don't know when. Maybe it'll get worse before it gets better. But when it gets better, it's going to be a whole lot better. And it'll probably be better than it's ever been in the past. 5 years, 10 years from now, the likelihood is that the market's going to be a lot higher than it was at the start of the pandemic. It'll probably be a lot higher than it is now. And I think you're seeing a growing awareness, maybe more thought going into decisions today because some of the decisions require more thought. As Kahneman says, slow down and think things through.
So is that a matter, Paul, then, you think, of the price versus value? I mean, people see the long-term value of owning these companies, even if the price today isn't what they wish it would be, because if they're buying, they wish it would be lower in theory, but that they're there for the long-term value. It is, I don't really know for sure what it is. There are lots of lists of reasons the market is held. And by the way, a lot of the market hasn't held at all, but it's down significantly. So that's another part of this whole process that is a challenge for investors, because some stocks are doing well and some aren't doing so well. But this is the way investing is. And that's part of that volatility that you talk about versus the long-term return. So let's talk about Kahneman's work, if we can, for a few minutes, because I think that final 20 pages is worth a lot to investors who don't want to take the time to read the 500-page book. Tell me how you think people could use that information in being a better investor.
Well, one of the real benefits of Kahneman's thinking is its relative simplicity.
Mm-hmm.
Here's a man who wrote 500 pages about the psychology dealing with financial decisions under extreme examples of pressure. He talks about the kind of decisions people make if they're confronted with a loss or with a gain. And interesting that a decline of a certain magnitude will trigger one kind of response, and the intensity of the response, if they're making a decision when things are depressed, will be different. They'll make a higher risk decision than if things are higher. But I think the benefit of Kahneman is keep it simple. You know, I've got videotapes of him, and one of them that I show in a presentation is just a summation where it's about a 10-second video, and he's basically saying, really about all we can say to people is just slow down. You know, stop trying to make things complicated. We have a natural tendency as human beings to try to solve puzzles and to make things complicated. And we can make investing horribly complicated to the point where the probability of an error becomes greater and greater. Just slow down and don't allow your natural tendencies to make things complicated. I saw this over and over again in my financial career where I'd be dealing with people who reached that point in time where they were retiring and they had their monies in their retirement plan, and now for the first time they could take control of it. You know, people want to control. They could take control of their money and they could roll it into a self-directed IRA, and they would. And but the thought that they now had control, but they also had time. They never had time when they were working. They were too busy earning a living and just letting the money build up in their retirement plan. Now they had the luxury of time, and they watch CNBC or they read the newspaper and they see how these so-called experts, and now they see all these experts that come on CNBC, and the moderator says, you know, you were on 6 months ago and you were recommending such and such and so, and today it's down 20% from where you said people should be investing in it. And so people look at it and think, God, these experts aren't all that, they're not so good. I can do better than that. So now people take control of it and they start trying to manage their money. And they think somehow that the key is to spend a whole lot of time studying things, trying to figure out what earnings are going to be. And all of a sudden they're making way more decisions than they need to be. They're exposing themselves to greater and greater probabilities of errors, and their performance suffers. They don't do as well when they're managing that portfolio themselves than when they just had it kind of building automatically.
Well,
it's kind of part of your question.
Yeah, no, I think that's I think people who will take the time to read through those will see a lot about themselves. I certainly saw a lot about myself, my fears, my desire not to lose, loss aversion. That's a really big deal for those of us who deal with any scarcity issues, which is why when I feel like we're spending too much money, even though I know we can afford it, I still get these rushes of scarcity concerns. So I just can't recommend this book any more highly, Paul. And I want to encourage people to do this. You offer a free chapter out of the book. Now, is that on your website, or is that at Amazon, or should we put that on? Now, I can put it on our website if you want us to do it that way, but it's on your website?
It's on the website. The term investorship is a word that we coined 20 some years ago. It's a word that's basically an adjective describing a successful financial decision maker. But investorship.com will take you to where you can read more about the book. You can order the book. Or I'd love to have you put that link to the webpage up on your webpage.
We'll do that. We'll do that. Yep. And now this is going to maybe, I didn't ask for permission to ask this question, but when you made the presentation to the people here on Bainbridge, you offered an opportunity for them to buy 3 books, I think, 3 copies, and you offered a special price. If you say no to this, we can cut this out of the presentation. Okay. If you say yes, we're leaving it in. But talk about that, because this is a book that if you got a couple of kids or grandkids, they ought to have a copy of it. And the price you offered, I just thought was super. So are you up for it, or do we have to cut this out of the presentation?
No, I hope you'll put it in there, because this book is now starting to be used in some schools, and make presentations at educator conferences, or they want to get the book. And so I've put together what I call an educator's edition, and it's basically on 3 or more books. They're $10 each plus a minor shipping and handling cost. Yeah. But I think anybody that is listening to this video or is on your webpage, you're an educator. Everybody you're talking to is an educator. They have people they can educate, and hopefully your message gets amplified amongst other people. But people you're talking to tell other people, tune in. But anybody that tunes into your webpage, I would consider to be an educator, whether they're a formal educator in a school, or they're a grandparent or a parent, and they're trying to educate people they love or friends. So that offer, if you go to the webpage, there'll be an easy link that'll say Educator Special. Click on that, and it'll take you directly to where you can order the books. 3 or more copies, $10 each, plus shipping and handling, which is minor. I had one person that I sent a copy of the book to, who's a financial advisor, interestingly enough. And he got the book, called me back. He called me, I didn't call him. He said, I want to order a large quantity of books because I want to give it to all of my clients. I want to give it to all the people I wish were clients. And I also want to give it to all the teachers in the school where I'm a member of the school board. And I think every teacher should have it. So he bought the copies of the books to gift to those people.
That's great.
And the people that I've talked to that are friends and people that have called me after they bought the book, I'm finding that people are calling back, buying more copies because they want to give it to somebody. So my hope is that this sort of becomes a best possible gift that people can look at and say, I got a whole lot of people I'd like to give a copy of this book to, and make it available to them at a price. They're an educator. They can buy it at basically half price and buy it directly from the publisher. So feel free to extend
That's
that
great.
off.
Okay, I'm leaving it in, Paul, but now I want to talk about a way to use this book that I think could be a life changer, because I know that most young people get caught up in some of these very biases that Kahneman talks about. And they kind of trick us into coming to conclusions that are really based on a myth rather than what we'd call a fact. And here's the thing we need to understand. When you read through all of those biases, and it only takes, it's 20 pages of information out of Kahneman's, it's a condensed version of Kahneman's work. I got to thinking, these problems that people have, almost all of us have these, but we are an individual investor trying to figure out, oftentimes looking for guidance from somebody we think is working in our best interest. But I want everybody to understand, everybody in the financial community, everybody on Wall Street, they have those very same weaknesses, those very same biases. And my concern is that my child or my grandchild ends up in the hands well, they have their own biases. Hopefully, I've been able to talk them out of them, but that they end up in the hands of somebody who is also tainted by those biases. And that's the worst of all worlds, to have two people who are struggling dealing with these biases, except that advisor could come with a commission from the transaction. And I just think it will be so valuable if we can get people in their 20s just to read that 20 pages so they understand not just the things they struggle with, but what the people who are probably trying to help them are struggling with. And that could be a costly experience if those people haven't figured it out as well. So I don't know if you approve of that train of thought, Paul, but that came to me as I was thinking this morning about this conversation. So there you go.
Well, I agree with your whole premise there, and that is that people do fall victim to people that have similar biases or biases that are contrary to the interest of the person they're trying to rely on. One of the purposes of the book is to give people confidence in themselves.
Yes.
A confidence to make simple, meaningful, uncomplicated choices, which this whole idea that something has to be complicated to be good is a false notion. It's a notion that in part is spread by some of those people you're talking about who are trying to talk somebody into doing business with them because, they're going to make some money off of them. So they're going to make things sound complicated. And people listen to them and think, man, I can't do this by myself. I don't understand all the terms. And I must need to understand those terms if I'm going to be successful. You don't. And you probably shouldn't even try to understand them. Turn off that noise, as I call it. That's distractions, those things that will rob you of the self-confidence that you can have in yourself if you'll just take the time to reason things through, do some smart things, and then follow through and just keep doing them. You don't have to keep doing one thing this year and something else another year. The key to success is to keep doing a few smart things. I'll leave on a note here a conversation I had with the person that wrote the foreword in my book, who just is retiring from the university as a full-time professor and author of numerous textbooks through McGraw-Hill. He retired. We got to know each other 25 years ago. He had started his career at Princeton, and he had an opportunity to put money into his investment account when he started teaching 60 some years ago. He put half of it into stocks, half of it into bonds, through mutual funds, through TIAA-CREF, I think was the choice that they had in that pension plan. And he continued to do that all through his career. When we got to know each other 25 years ago, he was thrilled by the fact that now he knew somebody who was a vice president of a major financial firm, and I could give him some insights that would be meaningful, and he could start to really tune in on the fine tuning that he felt he needed to do. And he asked me, what should he be doing? And my advice to him was, just keep doing what you're doing. You're putting 10% of your salary into that retirement plan every year. You're allocating part of it into stock, part of it into bonds. You're not trying to do anything other than what you do so well. You're a brilliant professor. You write textbooks that are read in all of the English-speaking universities in the world. Keep doing what you're doing. We talked last Friday, 3 days ago, and he's now retiring from the university, and he was wanting to have some clarity and better understanding of his choices as he withdrew the money from his university plan and rolled it into a self-directed IRA. And he was being guided by a certified financial planner at a major firm, good person, solid evidence of competence. And he wanted to know, was he doing the right thing? And I said, Ron, you're a poster boy for having done so much right. Just keep doing what you're doing. You're relying on somebody that's reliable. They're making suggestions to you that you've asked me to look at. They're good suggestions. They're consistent with the continuation of all the things you've done. There's a reason you're a multimillionaire today, and it's because you did things so simply. You just kept doing them, and it worked in spades. My hope is that when that money goes from you to your kids, next generation, they'll inherit some of the wisdom that you've demonstrated of having, and that your real legacy to them isn't going to be just a large stipend in terms of inheritance. It's going to be the lessons of what you can do so well if you just keep things simple and just point yourself in the direction of a successful career. So that's my advice to any young person. It's also my advice to any grandparent that's trying to counsel what they hope their grandkids or kids will take on or do. So
That's great. That's great, Paul. And as long as I get the educator's price, put me down for 10, okay? I'm going to
gotcha.
find it.
I heard you. 10,000 books are coming your way, Paul.
And I want to ask our listeners, our viewers, to do me a favor, because some of you will, in fact, buy the book, and I want to know from you. Please email me. Tell me what you learned from the book that you thought made it worthwhile, because I want some feedback. This is a very good friend of mine, somebody who I have a high degree of trust for his guidance. And of course, that's a risk when you trust somebody that's a good friend. And so I would like to hear from you. Did you find that good stuff in that book? Let me know. And Paul, all the best. I've waited for years for you to write this book. I'm really proud of you and happy for you, and all the best to you. And now this means you can spend some time with your wife again. That's
I
great.
will. I'll look
All
forward
right.
to spending time with you and yours. So thanks for inviting me.
Thank you, my friend. All the best.
Thanks, Paul.
Okay. Now,
I just
I
stopped
want to
recording.
pause.
And now, with Sound Investing, here's Paul Merriman.
Our mission is really about giving you the tools and the information to manage money on your own. I am going to make the case before I'm done as to how you can make additional millions of dollars in your life. And you'll see that. We'll do it by the numbers. But one of the biggest decisions you will make is whether you do it yourself. And I don't mean you pick individual stocks, but that you will take care of your money over your lifetime rather than having to hire somebody to do it for you. It is a huge decision. And Warren Buffett, I think, gives some of the best advice within our industry. And what he says is, and before he said this, he said to be a success. So this wasn't only about investing. He said you only have to do a very few things right in your life, so long as you don't do too many things wrong. And as far as I'm concerned, and I've been around this business, the process of investing since I was 19 years old. I am 79 years old. I've been doing this a long time. And I will tell you, from everything I've seen, the simpler you can make it, the higher the probability of success. And I think it is very, very important for people to understand that it's about the math. When you talk about how to be a great investor, it is really about the ability to follow the math. This industry, I had to think to myself about what you're going through and what you're deciding to do with your life. And some of you may go on to graduate school, but you're going to go on, you're going to have these careers filled with solving major problems. I come from a career, literally, where in a couple of weeks you can study and you can take a test and you can pass it, and you are in the business. You are giving people advice. You are acting friendly like you're a friend, and you act and talk like you know what's going to happen. You pretend that somebody in your organization can see into the future. The fact is, this industry, unlike yours or whatever industry you go into, most of the people would not survive in your industry, because if you look for two things in your life to take guidance from, to look to for advice and information that you can trust, you are looking for competent people who are ethical. And I will tell you that I'm not going to say most, but many of the people in the financial industry are not very competent, and they are not very ethical. And the problem is, if you're not careful, you end up in the hands of somebody who in fact sounds competent, sounds ethical. We know in this industry, when I went to school, when I was 22, back to New York, to the Institute of Finance, and what it was really was a sales training to go into the securities industry. I don't know that it should have been considered an institute, but that's what they called it. And what they told us is things like, it's the sizzle, not the steak you're selling. They would tell us that you are a fool to recommend many of the things that you do to potential investors, but as long as you're able to find a bigger fool to sell it to, you're doing a good job. I mean, it is in many ways an industry that is just ripe, not only with sales pitches that are carefully designed to motivate you to do what they want, not what you would do if you followed the math, but many of them are liars. And the reason I know they're liars is because the studies show that about 5 to 13%, depends on what study that you look at, of people are just liars. And the problem is, if you're listening to a liar and they are able to pitch in a way that gives you a sense of trust and friendship and all those things that you might look for in a long-term relationship, you can get yourself in a lot of trouble. And what I love about your position, you are at an age where you're learning the things that are most important. And many, in fact, including many engineers, would tell you, I didn't learn this stuff until I was 30 or 40 years old. Here's some numbers, here's some math, pretty simple stuff. And what it says to me, well, first of all, let me just highlight the fact that there's a number here, whoops, excuse me, a number of 0.5, 1/2 of 1%. 1/2 of 1% can change your life. If not change your life, it'll change the life for somebody else. I'm in the process right now of putting some money into a brand new child. My first granddaughter was just born last week. And I just talked to her mother, my daughter, today, and we're making the plans to get together and put together the investment that's going to be there to in essence, underwrite the Roth IRA for my granddaughter when she starts to be able to put money into the Roth. And what I know is, if we can invest the money efficiently, that extra 1/2 of 1%, if we can find it somewhere in the industry, could lead to a lot of extra money. And so what I've done is show you here a table that assumes a couple of easy things. One, that you put away $6,000 for 40 years, $240,000. You make, during the 40 years of accumulation, 8%, and then you retire. And in the period of retirement, you make 6%, and you live on 4% of that. And so that means that the person who makes an 8% return would, in fact, end up at the age of retirement with $2.8 million. And then you start taking the money out of, I'm sorry, that was $1.6 million right here, 1.6, 1.7. That's what you have at retirement. And then you start taking the money out 4% a year, and over 30 years, you would take out $2.6 million. Now that would then, over those the 40 years plus the 30 years, you would have then access to about a total of about $5.5 million. But if you could find somewhere to find an extra 0.5% and make 8.5% instead of 8, and make 6.5% instead of 6, instead of ending up with 1.7, you end up with 1.9 when you reach 65. Instead of taking out 2.6, you take out 3.2. Instead of dying and leaving 3.7, or I'm sorry, 2.8, you leave 3.7. The total difference then between what you would have in scenario 2 and scenario 1 is about $1.5 million. That comes from 0.5%. But what if you were able to make another 0.5%? Well, you know the answer. The answer is basically you would be doubling the return that you would have over a lifetime to live on the money, and the lifetime of saving for other people at your death. So instead of about $1.5 million, it turns out to be about $3.5 million. And that 1% right there, I'm going to show you 12 ways I think you can add $1 million to your portfolio in this presentation tonight. But that 1% is what people charge to manage their money, which says to me, if you could get the entire 9% instead of giving 1% to the advisor, if you could get the entire 7% instead of giving 1% to an advisor, you get to keep the $3.5 million. And you all were given a link to my book, We're Talking Millions. I have no idea how many actually looked at the book, but I can tell you that there are all of these 12 are in the book. Now, I'm going to go beyond the book tonight and take you into actual portfolios you could use in your retirement that have just been killer portfolios in the past. Now, this seems like a pretty obvious one. We'll start with a real easy extra $1 million. Obviously, if you don't save, you are behind the 8 ball. And so you're going to leave $1 million on the table for the person who does save. And you and I know, we know that society, the capitalistic system, businesses don't want you to save. Well, the banks may, the Schwab and Fidelity may, but most businesses want you to spend. When I teach high school classes, I ask them to make a list of the people who want you to save and invest. And typically they come up with mom and dad, maybe grandma and grandpa. And then I ask for a list of the people they want to spend. Well, you know the answer. It's everybody else. And so the key is to have the discipline to save. And a lot of people will say, well, I don't want to give up things to save. I want to enjoy this money. Well, at 79, I can tell you, I am enjoying the money that I saved. And in fact, because I saved, my wife and I can give away about 30% a year of what we make to causes that we care about. And the good news is that includes children as well as charitable causes. So there is lots of wonderful spending that comes from saving. In fact, I can tell you, some of the best spending you will ever do will come from the period of saving. Well, I want to share one more thing. That first $1 million that you put aside there, or that you built from saving, you have control to increase that considerably. And the way that you can increase it is by simply, instead of saying, okay, I'm going to put away $6,000 a year, you say, I'm going to add 3% a year every year to what I contribute. You might do that because inflation historically has been about 3%. So you're kind of keeping up with the cost of inflation and the impact it has on the money that you make in your portfolio. Well, it turns out if you went from 6,000 to 3% of 6,000, it sounds like anybody could afford $180, $15 a month, not a big deal. Then you do that every year. And over that same period of 40 years of saving and another 30 years of spending, instead of having 8.9 million, you have 12.5 almost $1 million you have added, because you invested a little more than an extra $100,000, you have added $3.5 million. This is not about the market. This is not about something else making you money. It's about you taking the steps to make money. And the earlier you get started, I am so excited for my granddaughter. I'm not going to spoil her. This money that I'm putting away, and I've done this for every grandchild, the money I'm putting away is not for now. It's not for getting an education. It's not for going on great trips when you're 30 and 40 and 50. It is purely for the last third of her life. And what I know is, if I have time on my side, and the problem is, I don't have time on my side. I am thrilled to be here tonight because I don't have very much longer to live. And if I can actually change the financial future of a handful of students here this evening, I've done some good work. But the work I can do for a newborn child, the work I can do for a 10-year-old or a 20, well, you are a 21-year-old in many cases, or close to it, it makes a difference. Because if you put away $1 a day from the day a child is born, and that continues to happen until they're 70 years of age, and you get a 10% compound rate of return, that is the rate of return of the S&P 500 since 1928. That would turn into $2.9 million. But if I wait until, or you do when you have a child or you have a grandchild someday, wait until they're 10 years old and do the same thing. And instead of having 2.9, that missing that $3,650 investment will cost you 1.1. That is the impact of starting sooner. If you started when they're 20 years old, it'll turn into about $425,000. The sooner you get started, the bigger the impact. It's huge. So we have one more table of math here, tables of numbers. I absolutely think they are just as important as the hypothetical returns of past returns on different kinds of investments, because this tells me right now that if I can step up and start at age 25 instead of 30, and if I get 9% and 7%, and if I take out 4% during that 30 years and I do all of that, in one case where I start at age 30, I'll end up with $7.8 million. If I wait, if I started when I was 25, I'd end up with $12.5 million, about a $4.7 million difference because of that 5 years of early contribution. And I know I'm talking to a room full of people who aren't even 25. So you can even make a bigger difference. And sometimes, for what it's worth, sometimes it means you might even, well, with this group of people, from everything I know about what you all are likely to make when you go out and start making a living, that you'll make a good enough living to be able to put a decent amount away if you can control your spending. And I've found historically, I've been doing this since the mid 60s. I've been in this and around this industry for a long time. The group that I could always count on being relatively frugal as a group and being good savers as a group, the best group are the engineers. And so I love talking to you folks, because I know how most of you are likely to be from everything I know about my past. I have two people that work for me. They volunteer their time. One electrical, one was an analyst, systems analyst for Boeing before he retired. Another was with NVIDIA before he retired. I know the difference about the way engineers think versus the way people like me think. I am not an engineer. I'm not even a certified financial planner. I did sell a business that grew from nothing to about $1.5 billion under management, because I learned these things that made people make money. I never made a penny for a client. And you will not be the one to make the money. The market makes the money. The thing is, you have to do the right thing with the money. And sometimes they need people like me to encourage them, to be there to help them when things start going wrong, because they feel like they can't trust the future. I know there are a lot of people who got out of the market recently because of all the volatility, and it's been a bear market. And then today happens. And if you don't know it, it was one of the big days in stock market history. And there are a lot of people who not only missed today, but I know people that got out of the market in the spring of 2009 because they couldn't take the market going down more and seeing their investments evaporate. Well, you're going to find out in a few minutes, evaporation of your money is part of the process. And sometimes you need somebody there to hold your hand to keep you in that process. I hope you don't need somebody to do that. I told you I would show you a bunch of ways to make an extra 0.5%, or at least ways to make an extra $1 million. So we know that if you'll save, you'll probably make an extra $1 million over not saving. If you save sooner, if you save more, I mean, they're all easy things to understand. Stocks versus bonds, this is the best of everything in terms of being able to add a big, big number to what you have at the end of your life. Now, I'm not telling you you should be in stocks for the rest of your life, by the way, because stocks have compounded at 10. And by the way, that's the high quality stuff. There is stuff that more types of stocks that are more risky than the high quality stocks that makes a lot more money than the high quality stocks do. And the reason they make more money is the same reason stocks make more money than bonds. Bonds are less risky. Bonds are a guarantee. Somebody says, let me borrow $1,000 from you. I promise, I guarantee I will pay you back. Now, there are times when you will find out in your life that some promises are not very good, like when you loan money to a friend, sometimes you never get it back, or you loan money to a child and sometimes you never get it back. But when you buy bonds like government bonds or high-grade corporate bonds, you get it back when it matures. But the stock market is different. You don't get any guarantee, except you get to own a piece of the company. And stocks historically, not one by one, and I'll talk about that in a second, but in the totality, for example, of the S&P 500 have compounded at this 10%. Bonds, historically, about 5%. So if I'm right, that 0.5% will make you an extra $1 million. And by the way, you're going to be investing more than $6,000 a year. You're going to get probably going to work for some company that's going to match part of what you put in. So the 6,000 and the money it grew to in the math that we've looked at so far is peanuts compared to what you're likely to have. But here's what I do know. I do know that there are 10.5% between the 5% and the 10%. So that means I should get an extra, what do you know, but maybe $10 million. Well, let me just show you how that works. If I look, for example, over 40 years, put away the $6,000 a year, if I did that with stocks, it would turn into about $2.6 million. If I did it with bonds, it would be about $725,000. Then I took distributions out of those stocks. Let's just stay in stocks. Then I would get about $10 million in distributions. The bonds would get me $1.1 million. Then I die and I leave 14.3 million, or less than $1 million. Now that's based on 10% versus 5%. I've looked at every 40-year period since 1928, and the worst 40-year period was a compound rate of return of 8.9. And I will tell you, you'll see this in a few minutes, the average 40-year period since 1928 for the S&P 500 is 11%, not 10. So I'm making the case, and you may not believe it. And by the way, while I may not have time to take all of your questions tonight, because I know you're going to be exhausted after an hour and a half. I will be. I'll be here to answer questions, but I will tell you this. If you have questions about what I present tonight, paul@paulmerriman.com. And in the subject line, just put in Rutgers, okay? I will know, and I will know that that is a question that I am obligated, that I promise to answer. Now, if you ask me what stock I think is going to be good for the future, I will answer, but you won't get an answer because I have no idea. If you ask me what mutual fund I like for the future, if you don't know by the end of this presentation, I failed. Another fork in the road, one stock versus many. Now, we all know the way to have many stocks in a portfolio. Well, if you don't, it's a mutual fund. It's a whole bunch of money put in a fund managed for millions of people, oftentimes millions of people, by professionals to do the right things at the right time. Now, there's one kind of particular mutual fund that is probably from 99% of investors, the right mutual fund to be in. And I'll make sure you know that before I'm done. But the one stock, there's a possibility of total loss. Eastern Airlines, total loss. Washington Mutual, total loss. Enron, the 7th biggest corporation, public corporation in the country, gone. From number 7, slowly within a couple of years to nothing. And so that's the reason I don't want you to put all your money in one stock. Now, you might say, well, doesn't it make sense that if you can find the really, really great stocks, that you would make a lot more than 10%? And of course, I invested in a company over 30 years, and it compounded at over 30%. I would have no idea how to recommend a company like that again. Let's say, for the sake of discussion, I just got lucky, but I only put $15,000 in it. If I knew it was going to make 30%, wouldn't I want to put more than 15,000? 30 was enough, by the way, but you see the point. I mean, we always know what we should have done. There is no risk in the past. And that's one of the weaknesses of listening to a sales pitch from this industry. We always talk about, we know how it's going to be, because we somehow give you the sense that the future will look like the past. Well, if it came to trying to pick an individual stock, there is nobody who can tell you what that great stock is going to be, which is why the academics tell us that the smart thing to do is to buy them all. Own the whole market. There's this wonderful study by Dr. Bessembinder from Arizona State University. And here's basically what he made. The question was, do stocks outperform treasury bills? Now, remember, I said that bonds made 5% historically, but that's not treasury bills. Treasury bills are super risk, have super low risk. They produce about a 3% compound rate of return. In fact, 3.3, because they make 0.3% more than inflation has over the last 94 years. So what did they find when they looked at how much stocks outperformed the treasury bills over that period? In fact, the period was from 1928 to 2016. And what did they find? I was fascinated by this. This is about the stocks as a group that compounded at 10%. 4% of them made huge returns. 96% of them compounded at about 3% a year, and about half of them ended up not making any money at all or being broke. Now, what that says is that 1 out of 25 companies was what, in fact, helped the total market compound at 10%. Now, there's another part of the market that they compounded at over 12. There's another that they compounded at over 13. There are different pieces, aspects of the market, and I'll share those with you. But my point is the academics think it is way safer, much more probable to own the entire S&P 500, the largest 500 companies in the US, if you want to have all your money in large companies in the US. And there's nothing wrong with that, but the expected rate of return is 10%. And that return comes including the companies that failed. So, yes, you might make more than 10. In fact, you probably will for some periods, but when you have few stocks, there's also a very high likelihood that you will underperform. High expenses versus low expenses versus no expenses inside the mutual fund. Most of you will invest in mutual funds because most of you will have the majority of your, at least the early years when you're accumulating money, it's going to be inside of a 401k, and you're probably going to be investing in mutual funds so that you get the broad diversification. And some mutual funds have high expenses, and some mutual funds have low expenses, and some have no. And the academics, and by the way, before I mention the academics, one more time, I want to tell you something that I think is very important. I think one of the biggest decisions that you will make as an investor is who you trust, the information, the source of information you trust. And I see three sources. One is Wall Street, the insurance companies, the banks, the brokers. I don't trust them. Now, it isn't that they aren't smart, but I don't trust them because they are basically foremost driven as a group by greed. And most of those are public companies, and those companies have a fiduciary responsibility to do everything they can to make money for the shareholders of the company. Yes, they'd like you to make money too, otherwise they don't ever make any money. But they really, their first job is to answer to the boss, not to the client. And so I'm not a fan of Wall Street. I'm also not a fan of Main Street. Main Street, a relative. In fact, Thanksgiving's coming up, and you may have somebody at the table talking about how to make money in the stock market these days. Well, or by the way, how the stock market is a terrible place to put money. All you do is lose. That's bad advice too. But I don't like Main Street as a source. There's no way I can test it. I don't know what they were telling people yesterday even. I just know what they're telling me today. How can I develop the history I need to make a qualified decision? I can't. The only street I trust is what I call University Street, or the academic community. They are the only group of people that I know, and by the way, they aren't without conflicts of interest either. But I don't know any other group of people that have to answer to a group of peers when they do research and come out with a statement about what they find. Again, I want to remind you that it takes almost no education to become a top salesperson as a security salesperson. And most of you, if you ever go that route, if you ever end up in the hands of a security salesperson, it is likely going to be because you have totally disregarded my advice. Because I think, and academics tell us, that the one thing that really counts, the one thing that is dependable and that you can count on for a lifetime, is if you are in investments that have high expenses, you are guaranteed to make those lower returns forever. And for people who are in mutual funds with low expenses, you are guaranteed to make the difference between the low expense and the high expense. And if you're in a mutual fund that has no expenses, and when I was your age, there was no such thing as an index fund. There really wasn't. Yeah, there were a few no-load funds where there was no commission to get in, but most of the mutual funds that were being purchased with a load, with a commission. and had high expenses. But today we have index funds. I'll talk about them more in a few minutes, but you can get mutual funds with no internal expenses to run the fund. Now, I can tell you the fund that offer those is a come on, because they are just hoping. They're hoping that one of these days you're going to get out of that fund and go into something that's been doing better lately, because the industry loves to sell people things that have been doing better lately. The fact is, one of the worst mistakes you can make as an investor is to chase fads, to chase returns, to chase what feels like magic. Cryptocurrency, this is only, by the way, in the minds of a whole bunch of people, including Warren Buffett, we're talking magic. And so Warren Buffett doesn't have any money in cryptocurrency. I've never had any money in cryptocurrencies. I can't figure it out. I'm serious. I got to hang on here for a second. I see that I lost a connection. Excuse me. I tell you, it's not easy getting old. You can't see, you can't hear, but I can make the connection. Okay. Thanks for waiting. That can be that difference between low expenses and the expenses you could pay could be 1%. I mean, I'm looking for ways to help you make an extra 0.5%, and along comes a guarantee that you can buy access to the market for 0.5%, 1%, in some cases more than 1% cheaper. And the good news is there are lots of people now on the internet that help you do it at zero cost. I help you do it at zero cost. Then you come to another fork in the road. And that is, am I going to buy an actively managed fund or an index fund? Let's make sure we understand the index fund. Let's just think of the S&P 500. I could be an actively active manager in a mutual fund, and my job is to find the best stocks out of that 500. My job is to know when to get in and when to get out. I am working for you. I promise. I really am, because if I can beat the market, money will come rolling into my mutual fund. I will be rich if I can show you performance that's better than those terrible index funds. I mean, who would ever want to be average? Was the sales pitch against the index fund. In fact, when it originally came out the first one in 1976, it was called Bogle's Folly. Who would ever want a mutual fund that owned all of the companies rather than owning the very best companies? Who wouldn't want somebody smart sitting there every day trying to make the right decision where to be? That was how they viewed the process of investing. And what does Warren Buffett say about investments? We should make an investment as if it is an investment for a lifetime. When he buys a company, he thinks he wouldn't mind if the market closed down and didn't open up for 10 years because he was in a great company. Now, what do we know about these actively managed funds versus the funds that own everything in that, what we call asset class? There are big companies and small companies, two different asset classes. There are growth and value, and I'll explain that in a minute, but they're two different asset classes. There's international, there's US, again, different international classes. So if you're going to build index funds, you would build one for every one of these major asset classes. And that's what they've done. Index funds now represent about half of all the money that is invested. There are states, like I think California may be one, but there are huge pension funds where the only thing they buy are index funds because they know they don't have to pay a manager. They were told for decades that you have to have a manager in order to get a good return. It turns out, and there's a firm that tracks. There's a firm that tracks the indexes versus the active managers. And they look at all of the active managers in each of these asset classes, and they've looked at them over the last 20 years, and they update the lists every 6 months. And here's what we know. About 1 out of 10 will do better than the index. And what the academics teach us, yes, that's easily a random event. That could happen with dart throwing. Now, of course, it is easy to say, no. People who make better than the indexes, they got something up here. They must understand something better. And for 15 years, there was a fellow who beat the S&P 500. And money just poured in. And then for the next 10 years, he was one of the worst managers in the whole industry. Think in terms of the math, the probabilities. If you're sitting there and you're thinking about probabilities, and you can say, wait a minute now, there are 10 managers, and I don't know what their performance is going to be. I don't even know what the benchmark will be, but I know that the benchmark is likely, or the index is likely to beat 9 of the 10. So if somebody will just turn over the index fund, I'll be happy with that. Or would you pick from the other 9 the fund that you think is likely to be the best over the next 10 years? Well, I hope, probability-wise, particularly since we know that there is not a correlation for the returns for the next 10 years based on the last 10 years. If there was a really high correlation, and if there was a really big payoff, but the extra money that they make is actually fairly small, but it was enough to say that they did beat the index. And oh, by the way, how would you feel if you found out that the bottom 25% of the people who did not beat the index left about 2% a year on the table? 2% a year, and we're talking 0.5% as being important. Here are the returns for bond funds, not bond funds, but 3 different kinds of bonds. STGB, short-term government bond. Short-term government bond is very, very low risk because that's the Treasury bill, 3.3% compound rate of return, and $100 grew to $2,040. Or if you went out to a longer maturity and you bought the intermediate term government bond, ITGB, it was a 5% compound rate of return, and the $100 grew to $10,228. And if you wanted to take a very long-term government bond, in other words, the government is saying, I will borrow your money and I'll pay you 30 years from now or 20 years from now, the return was 5.6%. But notice the worst 1-year return. Notice the T-bill, the short-term government bond, almost didn't have a losing year. It was a break even. And by the time you get out to the long-term government bond, it was down 14.9%. That was from 1928 to 2021. I love the lesson that you're about to learn, because a whole bunch of people have learned this lesson this year, and it's an important lesson. The period of time from 1928 to 2021 is statistically meaningful, but it's a very short period of time. I mean, I'm not saying that we have to go for billions and billions of years or anything, but I am saying that a lot of things can happen that didn't happen between 1928 and 2021. And the reason I'm bringing this up is because the long-term government bond this year, a week or so ago, was down 33% this year. It is on its way, theoretically, to having the worst year it has over the last 95. And it may be by twice the loss that we see her on this table. And that's an important piece of information to you, for you to have. But we can't let the bad years scare us, because one year when you're putting money away for 40 is meaningless. Well, pardon me, it's not meaningless totally, but it isn't what you, if you focus on that, you'd think you're going broke. This is what the average compound rate of return was for those same three bond types: 4.5, 5.9, and 5.8. So, you know something? Not bad. And $100 grew to be worth a fair amount. That probably for many people would say, like, isn't that good enough? Well, it's good enough unless you know that over the last 94 years, that LCB, US LCB, the S&P 500, compounded at 10.2, and $100 grew not to $2,000, but 917,000 plus. And then you have US LCV that compounded at 11.2. Now, this is also a fascinating piece of information. That index, that group of companies, that asset class represents companies that are out of favor, companies that are not viewed as being great growth companies of the future. LCB, the S&P 500, oh man, you can't, hard to find the name of a company that's a hot dog, great growth company that's not there. Some, but most of the great companies are there. But large cap value, if you saw a list, they're not the big performers. And yet the numbers show historically that they produce a better return over the long term than those high-powered, great growth companies as a group. But you took more risk. So it's not magic. It's the reward for taking more risk. It's the reward for being in stocks rather than bonds. And it's the reward for being in large companies. And it's the reward for being in some companies that are out of favor. And I don't mind having both of those in my portfolio. The next one is US SCB. U.S. companies, small cap blend, some growth, some value, just like the S&P 500, some growth, some value. Again, a better return. And now the $100 grows to $4.6 million. And then you go to the next one. It's U.S. small cap value. Forget about the growth in the small company. Just own the out of favor small companies. And don't think that every year small cap value does better than the S&P 500. I don't have time to go into this today, but I will tell you, we have studies that show that you'll have 20-year periods that the S&P 500 does better than small cap value. And then small cap value takes off like a rocket. Last couple of years, small cap value has been way, way better than the large cap blend. Over there to the right, those other columns, I'm going to talk about those later. But just pretend for a second you were going to do something for a child, your first child. Put some money away for the long term. Now, I'm kind of a wacky guy. When I say long term, if I have the ability to put away money long term on behalf of somebody, and it could compound tax-free for the rest of their life. And by the way, when you're doing that for a child, you really can't get it into the Roth until they earn some money. But you can have the money there growing for them so that when they do earn some money, it gets in there. And if part of that money
Don't
is,
have people time.
and there are some people who will, part of their money will grow for 100 years. I mean, in theory, you could put away $365 and let it go for 70 years. At 12%, it would be worth about $1 million. Then the next year you put away $365 for the little tyke, and you put it there for 70 years. Don't touch it for 70 years. 70 years later, when they're 71, it's worth over $1 million if it gets 12%. It's worth about $488,000 if it gets 10%. And you do that every year, $365. It's not impossible to have money actually grow for 70 to 100 years. And people will say, well, isn't that an awfully long time? Well, I'm not suggesting that you stop living for the next 70 years. I'm just suggesting that you plan. By the way, I forgot to show you something. Notice, if you will, here, the very best 1 year return. Right here, 54% for the S&P 500. The worst year was a loss of 43. Okay? Now, this is important. When you're a long-term investor, please understand any year could be the worst year. I mean, in theory, your $100 could grow to $13 million, theoretically. And then the next year go down 50%. And there you go. Instead of 13 million, you got 6.5. So you never outgrow that possible risk, which is why for most of us, when we get to be 60, 65, we want to have some bonds in our portfolio. We want to act like old people who don't want to lose a lot of money. But notice, I wanted to go back and pick that up, because notice here when we look at the best 15 years, because now we're talking about 15-year periods, notice the best 15 years for the S&P 500 is 18.9 and compound rate of return. And the worst 15 years is a break even, basically. So as you go out longer and longer, the difference between the best and the worst narrows. So by the time we go out, we look at every 40-year period since 1928, 55 of them. The average for the S&P 500 was 11. The average for the small cap value was 16.2. And what I tell people to hope for is that you get 10 with the S&P 500 and you get 12 for small cap value. But again, notice how the compound rate of return, just looking at the one here, the S&P 500, notice how the compound rate of return, the best was 12.5, the worst was 18.9. So you can count, now when I say you can count on, the probabilities are over the next 40 years, you're going to be somewhere between those two numbers if you have some money in the S&P 500, and the same would be true of small cap value, somewhere between 11.6 and 19. So if you want to make more money, does it surprise you to find out that I would like you to add to a portfolio that might have the S&P 500. There are people who tell you to put all of your equities, all of your stock investment, just put it in the S&P 500 and be happy. And I don't think that's stupid. I just think you're leaving a ton of money on the table. And I'm going to show you the risk in a few minutes. I'm going to show you the difference in the historic risk. And I hope it makes an impression. But you can see, you can see the difference. I already talked about these differences between the S&P 500 and small cap blend. 10.2 versus 11.2, 11 versus 13.7. So if you put some small cap, maybe it's only 10%. It will make a difference. Same thing with value, large value, small value. Put some in the portfolio. I'll show you how much in a few minutes. And by the way, I am sorry, I'm not looking at the chat, but at 79, I can't focus on the chat as well as focus on the presentation, but I promise I'm going to look at the chat later. I love this. We have over 160 tables on our website. Remember, I said that the mission of our foundation, we don't earn money. We get donations from people. I put money in every year. I put money in to get it started. I'm trying to build it up so it'll be around after I'm gone and that everybody won't have to work for nothing. We do have the people who take care of our website do get paid, but the people who do the heavy lifting research wise, we are all donating our time. But here is the kind of table I love, a tool. What a tool this is. This table is about the S&P 500. Down the far right column is the year-by-year results. And by the way, I'm not asking you to look at all the results tonight, but when you have time, go back if you will. And in fact, I sent a PDF of this presentation so you can print these out easily, okay? And hopefully they'll be in the chat. So I know I can look year by year and I can get a feeling for what it would have been like. I know it lost money in 73 and 74. I know it lost money in 2008 because I can see the red color and I can see the minus. I also know what doesn't show up is one day in 1987, it lost 22% in one day. So you don't see all the risk here, but you see a lot of it. And down at the bottom of that page, you can even see the worst 3 months, the worst 6 months, the worst 12 months. You can really feel, maybe, I used to call this my fright simulator because it was a way of showing people what Wall Street doesn't normally show you. It's one thing to understand the upside. The sales pitch is always about the upside. But the idea is hope for the best, but prepare for the worst. Because if you're not prepared for the worst, you don't know how to deal with it. Because at your young ages, I promise you will see the worst of the next 50, 60, 70 years. And I can also see the worst drawdown from peak to valley at the very bottom of the page. But notice, it's not just about the S&P 500. It's about the S&P 500 and bonds, because on the left-hand side, you have the year-by-year results of a bond portfolio that's very low risk. In fact, if you look at its worst drawdown, it was 5%, I think, and the worst drawdown for the S&P 500 was 51%. But what happens is when you look at the return, the compound rate of return, the annualized rate of return, you'll notice every time if you start with 100% bonds and you start adding equity, every time you add equity, more equity, you get a higher return. And you take on more risk. So this is what you need to become an expert on. It isn't on this table. This table is easy to produce. I hope it's easy to understand. What is difficult is what goes on inside you when your life savings is in, whether it's all equities or half equities, and figuring out how much risk you're willing to take. And hopefully when you're young, you will understand that the more risk you take, and I'm talking about smart risk, not stupid risk, you don't want bonds in your portfolio for the first 20 years. Well, I'll talk about that later. But here you can see it, the bottom of that page. The bottom of that page, you can see that 50-50 made an annualized return of 9.4, 50 stocks, 50 bonds. And you can see the losses. Oh, by the way, that's what my wife and I are 50-50 stocks and bonds. We're not all in the S&P 500. We have most of our stock and investments in value, but we have some S&P 500. We have a lot in small. We have more in small than we do the S&P 500, but we do have the S&P 500. And I know that with the S&P 500, when I look at the worst 12 months, I should be ready to lose about 20 to 25% in a really bad 12 months. I guess to be fair, I should have the same periods, but the best 3 months and the best 6 months. I just don't have room on the page. But anyway, I'll do it in the future. Okay. Now, I know I don't have forever to talk to you. I'd love to go through all 160 tables, but let me tell you why I'm showing you this table and the next table. This table is the same kind of table, bonds on the left, equities on the right, but the equities are small cap value. The risk goes up and so does the return. There it is. The risk instead of here of being 51%, the worst drawdown was 61%. The worst 12 months for a 50-50 with the small cap value and the bonds, instead of 20 to 25, it's a little bit over 25. But I also see the return. The return is 14%. And the return for the 50-50 was 9.4 before. Now it's 11.1. And again, I'm thinking, oh, it looks like there's some 0.5% sitting in there somewhere. And this next table, again, we don't have time to look at it deeply, but I'll tell you what it is. The equity is half small cap value and half in S&P 500. For what it's worth, that combination of small cap value and the S&P 500, so some small, some out of favor, and those great growth companies, that is what I have asked my daughter to invest all of the money in this Roth IRA for the rest of her life. Now, when she is 18, she's going to find out about this project. And because I'm not likely to be alive when she reaches 18, she's going to get a letter from me as what the dream was for her grandmother and her grandfather. What we hoped this Roth IRA would grow and be for her, not just for living, but for giving. And maybe being able to be more forgiving. But I know I'm realistic. You don't have to have 10 or 20 or $50 million in a pool for somebody to crawl across crushed glass. There are salespeople who will crawl across crushed glass if you got $100,000. She is going to spend a lifetime, if people know that's there, trying to convince her she should do something else. And my goal for that wonderful little girl baby, she's just a little tiny baby. By the way, 9-pound baby, she was born. She will hopefully have an education that will last a lifetime. And that's what I want for you. That's why when I come here, I could be spending my afternoon relaxing, figuring out if anybody got elected here in the last few hours. But I'd rather be here. And I would rather be making this case to you about what you should be thinking about for the rest of your life. Because this presentation, as far as I believe, and I'm just like your professors, by the way, I am not a professional teacher, and they are, but I am this. I am trying to motivate, to educate and motivate you to make use of the information that I'm sharing with you. The reason I support this class at Western Washington University, I pay $50,000 a year so that class exists. is because I want those young people to come out of there, and when they do their first 401k, they know what to do. They do the right thing from day one. All right. Anyway, you can compare. In fact, you can compare all three of them at one time. Not now, because I'm running out of time and I don't want to keep you any longer than I have to. But I want you to see there's always this choice. You can control the pain. I want you to focus on the gain in the early years. You can take a lot of pain, because when you are investing in equities and when they are going down like they will maybe in the early years of your investing, remember you are buying more shares of great companies. When it's going up, you're buying fewer shares. And I'll talk about, in fact, I'll go right now to that page, just so you'll know what I'm talking about. When you are investing, this is idea number 10. When you're investing, when you dollar cost average, you put $100 or $500 a month into the market, into your 401k, into whatever mutual funds you've chosen. When you're doing that, your $500 is going to buy more shares if what you're buying costs $10 than if it costs $20. That's obvious. But when the market is down from 20 to 10, I don't know if I want to put any more money. It's so painful. It doesn't feel right. I've been losing money. Why don't I wait until later? Because you want to buy all of those cheap shares as you possibly can. Do I wish that somebody could have told you for the next 6 months, hold your money aside, because 6 months from now, this market's going down. Or will be down. And you're going to be smart. You're going to keep your money out of the market. Oh, there's always people who call the future. They talk like they know. Nobody knows. Everybody in the industry knows nobody knows. The reason the market exploded today is because a report came out that people didn't expect. And that was its suggestion that inflation might be peaking out. People got all excited. Future returns of your investments will be based on the unexpected, not the expected. Yes, we expect that capitalism is going to work. We don't know that. We expect that people are going to come to work in these thousands and thousands of public companies and be going to work hard and do their best every day. Well, we probably question that, but we're hoping they're doing their best because they're working for us. I'm going back to buy and hold versus market timing. Number 9, market timing feels so good. I am truly an expert on market timing. I have studied market timing since I was 22 years old. It is ways of being in and out of the market and using techniques. Some people use what they think it's going to do. Some people use mechanical techniques to do market timing. But I'm going to tell you, I have known thousands of market timers. Very few of them are successful because market timing requires a strength of character to withstand what is the hardest of all kinds of strategies that you have to do. Because when you buy and hold, there's one thing you have to do. You have to buy. And then you have to hold. Those are two very easy things to understand. And if you come to the table of investing and you understand that you're going to be in there and the market's going to be all over the place, but that's what it's going to be, but over long periods of time, it's going to be good, etc. But so many people got out of the market in 2009, and 10 years later, they were still trying to figure out how to get back in, and the market had skyrocketed. Really, if you want to deal with the probabilities, I can teach anybody how to buy and hold. I could teach a room full of people to do exactly that. I would show them a system. They would invest their money in equities for 20 years, half in small cap value, half in the S&P 500. Oh, you want to be more diversified? 25% in the S&P 500, 25% in small cap value, small cap blend, and large cap value. That works too. But all the people who do it on the same day, they all do it the same. The result will be the same theoretically 40 years from now. But market timing is driven more by emotions than it is by the math. And the minute we leave the math, we reach to our inner self, and there's this thing called I call it it's a strategy. It is a legitimate strategy to market time. It's the ICSIA strategy. I can't stand it anymore. And so people move, whether it's getting in or getting out. They move because they're looking either for safety. They're so fearful. And I don't blame them. They've been losing money. Don't do it. And I'm sorry. While I can answer your questions, I can't be your advisor because I'm not an advisor anymore. I'm just a teacher. I'm going to leave you with this. Again, I know I've got about 15 minutes. I want you to know about this table. This table is maybe in some ways one of the most important. And we got a whole bunch of them. This one happens to be of the S&P 500. And it assumes you're starting in 1970, you're investing $1,000 a year in the S&P 500 or any combination of the S&P 500 in 10% increments of that and bonds, okay? So it's the results of what you already saw in the fine-tuning tables. I want you to increase the investment 3% every year. Now, there are so many lessons, and I do podcasts. We have on our website 700 articles and podcasts and videos. And we're not asking you to write any checks. You don't have to, nothing to pay us. I'll tell you what we love. I'd love it if you read that book. We're talking millions that you have access to a free copy, and then go to Amazon and write a review, because I can tell you that is worth as much as any, not as any contribution that has ever been made, but I will tell you, it's a huge contribution because it helps convince other people to take advantage of that information. Now, notice if you look under the 100% stock portfolio, that third column from the right, you can see what's happening to your $1,000 that you're putting in. First year, it ends at the end of the first year, it's 1,022. Wow, that's not a very good return, is it? No. The next year, you're up to 2,275, and you keep doing this. You keep adding the 1,000, but it's being increased by 3% every year, and you can see that annual contribution going down the far right column. And by the end of the first 10 years, there's $16,245. You put in over 10,000, and you only have 16. What is wrong? Two things are wrong. One is that your $1,000 a year, I mean, you didn't start with 10,000, you ended with over 10,000, but some of that money didn't come into the last 5 years. But the market did not do very well during that 10-year period, one of the worst 10 years in stock market history. But it was okay. But understand, you were the hero. You are in partnership with the market. You put in the $10,000+ into your part of the partnership. The market is your partner. Benjamin Graham, the father of security analysts, one of the most famous people in terms of finance in the industry, he calls the market Mr. Market. So you're in partnership with Mr. Market. Notice what happened. You kept on doing it the next 10 years. At the end of that 10-year, you had 119,884. All of a sudden, the market's doing, Mr. Market is doing its part. And then at the end of the next 10 years, it's up to 699. And then at the end of the next 10 years, it is down to 6 662. That's because the S&P 500 had a terrible decade. But I want you to see something here. On the next one, we're looking at the small cap value instead of the S&P 500. I want you to notice that where the S&P 500 remember it was down to 662. Let me see if I can gingerly put this over here, down here, 22.6 million. The S&P had, that part of the market had 662. That's the reward for taking more risk. But I will tell you, there'll be periods that the small cap value will hurt, not help. But if you had combined the two, it wasn't too bad. If you had combined the two, that year that you would have had 662, 2009 was the end of that decade. Okay, you got $1.3 million. You got twice as much money as if you had your money in the S&P 500 only. Number 11, taxable versus tax deferred versus tax free. I'll tell you, for your long-term money, I don't care what tax bracket you're in. I am an advocate of Roth IRAs. I want to tell you something that I felt that you haven't felt. I hope you never feel. What I felt was when I first came in, graduated from the University at Western in Bellingham, Washington, the highest marginal tax rate was 90%. When I started as a stockbroker in 1966, the highest was about 70%. We have no idea what tax rates will be in the future. And to the extent that we can get money put aside tax-free for the rest of our life, particularly when you're young and you're not in a very high tax bracket, I want you to be tax-free. Roths. For people who do not know what to do, don't want to have anything to do with me after tonight, because you do not want to be a do-it-yourself investor. You do not want to try to save that $5 million. You do not want to take advantage of some of these different asset classes because I showed you how to do it. But I will tell you what I want you to learn more about. By the way, I've got a whole video and podcast on target date funds. They are an amazing product. Hopefully you'll be in something like the Vanguard target date fund where it's all in index funds. But what happens is you get into a fund that knows that you want to retire in 2070, for example, and you put your money in there and they manage it the way a professional would manage that money. They don't like small cap value particularly. They don't like large cap value particularly. They'll be more oriented to the large companies. They'll have a balance of U.S. and international. They'll add a fixed income. I think they add fixed income too soon for what I would want you to do, but they do it in the way that is very traditional. And they take care of the money for the rest of your life. And remember that 8% I started out talking to you about in that first, where I said 8 or 8.5. Target date funds are built to make between about 8 and 8.5 or 9% over a lifetime. But by the time you are, 50 years old, they'll have you probably 20% in bonds. When you're 55, you'll be 30 or 40. You'll have more bonds sooner than I probably would have you in bonds, but they are super. And Wharton did a study. They looked at 1.2 million accounts at Vanguard, and they determined that people who use target date funds would likely make about 2.3% better per year during their investing years than people who were trying to pick stuff on their own. If you don't really know what you're doing, I don't want you to be a do-it-yourselfer. I think you'll hurt yourself. But if you know what you're doing, that's great. But if you don't know what you're doing, and a lot of people just don't want to deal with this. Now, engineers are pretty good about trying to take on these kind of things. It's easy for them. There's not one thing you're going to learn in the process of investing that is nearly as difficult as what you've gone through to be where you are. I mean, I can't even start to say how little you really have to know to understand the process of investing. I've already made this point. I'm not gonna focus on it anymore. You got it. That first 5 years is so important, because if it turns out that what you would make in the first 5 years of putting away $6,000 a year before somebody else gets started, your first year's 5% distribution would be $112,000, okay? That you should likely get from that. And that was not based on huge returns. This is a page from our website. If you went to paulmerriman.com, there is a link to best advice. The most important information on our website is in that drop down. One of those is sound investing portfolios. These are different portfolios using different kinds of asset classes. For example, remember I talked about the two fund strategy, partly in U.S. and partly in large and value, and for some reason, oh, here it is down here on the bottom. Oh God, these two funds down here at the bottom. This is the 50% small cap and 50% large cap. Then all of these different strategies, we can look back at the last 52 years. We can show you with all these different portfolios, what would an investment in $10,000 have produced? And you can see the difference in different decades. Like the S&P 500 didn't do so well in 70 to 79. It didn't do so well in 09, from 2000 to 09, but you can compare it to the different strategies. And you can look, how many up years did each strategy have? How many down years did each strategy have? If you added up all the down years, how much did all the down years add up? I mean, this is not tough math. And notice with the S&P 500, the worst year was a loss of 37. The sum of all the down years was 141.1%. But if we go over here to the small cap value on the far right, the worst year was a minus 36.8. And the total of all of the bad years, the losing years, was 130. It was actually, by some measures, less risky. And what did it mean that you would have made? With the S&P, you would have made $2.3 million for a $10,000 investment. With the combination of the small cap value and the S&P, $5.3 million. I also want you, we have a lot of what we call quilt charts on our site. They are underneath that drop down of best advice. This shows you, going back to 1928, 1 year at a time, how did the S&P 500 do against the all value? Green in the S&P, yellow is all value. How did the two fund strategy do? How did the four fund strategy do? Excuse me, I said yellow was all value. That was wrong. Yellow is a combination of large and small value. The blue is the small value. I apologize. For 5 years, the S&P 500's at the top. Starts to feel like that's the only place to be. But then when you go into the period from 1938 to 1947, S&P 500 was at the bottom 6 years in a row. Look at the lower right-hand corner. You can look at how often those asset classes or combinations of asset classes were at the top and how often were they at the bottom. And what I love about the two fund strategy, and by the way, I do about the four fund strategy, powerful strategies, how often they're in the middle. I think we're better off if we kind of stay in the middle most of the time. Payoff for getting an education, you're going to retire earlier if you want to. By the way, if you're new to investing, you're going to find there's a whole bunch of people out there in the FI community. It's called financial independence. They want to retire early. They call it the FIRE movement. But you invest right. I think when you invest right, you can retire earlier if you want to, or you can leave more to others, or you can live on more when you do retire. You're going to have more diversification because you understand the process. You're going to have less risk. You're going to pay less in expenses. You're going to own more equities. You're going to pay less in taxes. I mean, it isn't hard to be. It is what Warren Buffett is right. There's only a few things to do right. And I will tell you, he says, as long as you don't do too many things wrong, but for every right thing there is to do, there are at least 100 wrong things. So as I said before, go to Best Advice. Our job is to help you. We are not financial planners. We are not trying to do estate planning. We are not trying to take care of your insurance, anything. We just want to help you invest. And there's our website. And there's a calculator. Young fellow used our site to learn how to invest. And he looked at a bunch of them and he liked what we were doing. He didn't like that we didn't have a calculator to tell people, let people manipulate all those numbers. He developed it, he used it, and he brought it to us and he gave it to us as a gift. It's an amazing gift. And there we are. We hope you sign up for our newsletter. I know you're not going to use this stuff now. And I know you're going to hate the emails coming in once every 2 weeks. That's what, once every 2 weeks, you'll get something from us. But I want to make sure that you don't lose our email for when you graduate and it's time for that 401k. This stuff is important when you're making one of the biggest decisions of your life. I didn't die. So what do you think? I mean, are there any thumbs up at all? Of course, I have not been able to see your faces. I would, how many? We still got most of the people. We got 144 people that stayed. Wow. And how many are napping? I want to know. None, I hope. And so, is there anything I can do that can promote an open dialogue here, McCunn?
We would love to ask you some questions to start off with.
I'm here.
We've actually, Manny Mishoyer has prepared a set of questions for us, for that matter. If
Good.
you could around to answer. But first of all, thank you so much for joining us, Paul. Thank you for spending your time to prepare this presentation for us and for teaching us all of these important tidbits that we can keep with us for the rest of our lives.
You're welcome. And I really do hope it helps.
For sure. But now I wanted to start off asking you, would you suggest that we invest in all small cap value?
All small cap value as for the first 20 years would be okay.
Okay.
Absolutely. Small cap value has never underperformed the S&P 500 for over 20. I mean, they've always outperformed over 20-year periods, but they often underperform. They've had about 3 20-year periods or almost 20-year periods where they produce the same return as the S&P 500. And what I don't want is for people to get discouraged. And one of the challenges is that we've all heard in our lives, somebody said something was going to happen and then it didn't. People say, I promise I will marry you and we'll stay together forever, and they don't. And so when does the pain become so great that you say, I want a divorce? And that happens with what you think is a commitment to an investment that is supposed to treat you in a certain way. So the one of the reasons that as I may have mentioned, I can't remember now, but when I'm setting up this program and why I recommended that my daughter put it half in the S&P 500 and half in small cap value, and it will mean millions and millions of dollars in different in what she'll have to live on but it will smooth the curve. She will, and the neat thing is we're going to be able to show her 18 years of performance. She will see what it was like. Now, we have on our website, when you look at that information, there's another table that shows the year by year performance over the last 52 years of all those different strategies.
Exactly.
So
And,
you'll be able to look at it.
yes, and we see that through the data that you've provided for us, that worldwide small cap value, we have a split 50-50 between US small cap value and worldwide small cap value, provides the best possible return over any length of time, right?
Well, let me tell you the rest of the story. There was a relatively short period of time that gave you the advantage. And it was a period of time that the US market was underperforming. And if you didn't have that period of time, you wouldn't have that. So it was a relatively few number of years that caused that small difference. The main thing to me is have a certain amount of value in the portfolio. I think the all value portfolio, which has some large in it, is also a wonderful long-term portfolio. And what I'm thinking is, in many cases, you're going to have some money later in your life. You're going to have some money, maybe in a Roth, some money in a 401k plan. You may even have a taxable account. You may have a partner and your partner has a different account. You could have a portfolio between the two of you. You got one that's all value. You got one that's a two fund. You got one that's the US all, and you diversify. It's not. It's going to hurt you to the extent that we always know what we should have had all of our money in, but that's because there's no risk in the past. I mean, it's stupid. I just didn't take my money in 1986 and put it all in Microsoft. I wouldn't have to have, maybe I wouldn't be here.
All right. Thank you for telling us that, Paul. But I also wanted to open up the floor for anybody else who has any particular questions that they want to ask Paul.
Were there any in the chat, by the way? Any questions that
Now, I did look at the chat throughout. Oh, we do have one question in the chat.
Good.
Ahmed is asking, do you know any good ways of saving money without accumulating interest on those savings?
Well, there is a mutual fund family. I don't know if this is an Islamic. I mean, there's a reason why they don't want the interest. There's actually a mutual fund company out of Bellingham, Washington. I believe it's the Amana Funds. Now that name may have changed, but they are built to work within the set of beliefs of people who are limited as to what interest they can get.
Thank you for that, Paul.
Yep.
We have another question from Irfan. Is there an ETF through which we can specifically invest in small cap value, or do we have to individually invest in them?
We are doing everything we can to make this all possible for you without you having to dig as deep as you would normally have to dig. We've done the digging for you. There are 7 things that we're trying to do, and one of those 7 is to give you the names of the mutual funds or ETFs to invest in. So there will be a link on our website to our portfolios. And when you end up at our portfolios, you will see the ETFs, and you'll go to the ETFs, and you will see under the ETFs the best in class. And so we have actually Chris Pedersen, the fellow that is retired from NVIDIA. Chris is the one who has done the work looking at all the things we believe in, size, value, there's a whole bunch of things that go into it. There's an article there about how he selects them. And for example, the small cap value. The ticker symbol is AV as in Victor, UV as in Victor. And that is I have that in my portfolio. And every year or two, he updates that. And sometimes there's a bit of a challenge, because if you're inside of a Roth IRA, no problem. But if you're in a taxable account, all of a sudden you have to make the decision, well, is it good enough? I mean, we will have a reason for why, not because we think it's a better fund for the next year. We think from everything we know, it's a better fund for the future. We are never recommending something short term.
All right, thank you. We're going further up. And also, please, if you guys want to interrupt with questions of your own, please go right ahead. I'm just reading straight from the chat. But please feel free to turn on your mic and ask your questions. But in the meanwhile, I will go through the chat. Hannah Schwartz is asking, I was wondering what you thought of robo-advisors, which is an auto-managed mutual fund which doesn't have any fees. For example, Schwab or something similar.
Well, robo-advisors, I'm guessing most of you know what that is, but everything is robotically moved for you. You just put it there. That's what a target date fund is. A target date fund is a robo-advisor. They do the moving. All you do is hang on. Now, some robo, like Schwab, and I don't know the very latest information, but sometimes there are internal expenses. I know, for example, in the case of Schwab, they got into trouble at one point because they were making they were requiring that people hold some money market funds inside of that free account. And so it wasn't really free as you might think as free. But here is the question. Is that robo-advisor going to be diversified for the long term and be in your best interest? So again, the problem is you may not know enough about small and large and value and growth and all of and there are other things that go into that formula. For example, what's the quality of the portfolio? What's the momentum? Do they use momentum in their portfolio as to how they hold the asset classes? There's a whole bunch of things that go into the analysis. The robo-advisor is going to have a portfolio that is likely different than ours. There is a website, it's called, if you look up 243 portfolios, the Einstein portfolios. There are 243 different portfolios. All I want those people to do for you is to do what we've done for you. Show us what it looks like in the past. Show us what the risk is. Show us what the likely return is. Do it with indexes, not with actively managed. But yes, a robo-advisor can be just fine because a target date fund is just fine. But the question will be, when will you start adding fixed income? We actually have a recommended target date, aggressive target date portfolio formula on our website. Chris Pedersen developed that. But we leave a little work to be done. We don't do it for you.
Thanks, Paul. Manny asks, what do you think? What is your opinion of REITs as an investment option?
If you looked at the ultimate buy and hold strategy, all those different portfolios that I showed you, one of them has 10 different asset classes in it. I have those 10 asset classes. I have REITs. REITs are tax inefficient, good inside of a Roth. They have about the same return as the S&P 500. And that's not bad. They are not too correlated with the S&P 500. They go up and down at different times from the S&P 500. And we actually, if you go to that best advice and you look, if you click on the ultimate buy and hold strategy, there's a complete explanation in an article. There's a podcast there as well, and tables that will show you where REITs fit in the total portfolio. I mean, having 90 minutes with you guys is just not enough, but hopefully it will attract you to come check out that best advice, those links. There's an article and a podcast and tables with all of those different discussion points.
Awesome. All right. Thank you for that, Paul. Do we have any other questions at all?
By the way, may I make one comment?
For sure, please.
Before I forget, somebody in this group at some point is going to want to write a financial newsletter. It's not what they expected to do, but if I'm still around, they can contact me. One of the best newsletters in the industry is called the White Coat Investor, and online, and it's managed by a guy who's a physician, and it's a wonderful, wonderful website. So my job is to help people that are helping others. And I'm hoping, by the way, that many of you will take this information and that book, that link to that book, home to show your parents, because I find that a lot of parents aren't exactly doing the right thing.
All right. Thank you for that, Paul. Actually, I've been able to, talk to my parents about all the things that you have taught me through your website and everything. We've had so many lively discussions, actually. So for
Great.
sure, share Paul's website with your parents, guys. It's just really fascinating stuff that can really impact our financial lives. But yes, if you guys have any further questions, email Paul at paulmerriman.com. I will send all of you all the PDF of the presentation, the video of the presentation. I will send you guys Paul's contact information, everything you guys will need, and you can reach out to Paul whenever you want.
Great. Thank you so much, you guys. You guys are wonderful. I wish you well. I hope you don't have to go through the terrible bear markets that I've had to go through. I hope you don't ever have to go through a divorce. By the way, a divorce is the equivalent of a bear market. I just wish you the best. And you are going into one of the great careers. I will tell you, the STEM people are the people who follow our work. And to be invited here tonight, that's really important, because I know that I have high confidence. This kind of information, it may not be mine, but this kind of information at some point is going to be important to you. All the best to all of you. Thank you so much, Mukund.
Thank you so much for this. I really appreciate it. And our HC appreciates it too. So
Great.
Thank you.
Thank you, everyone.
Good night, folks.
Good night, all y'all.
Thank you.
It's Paul Merriman with Sound Investing. Sound Investing, soundinvesting.com, and paulmerriman.com are produced and exclusively owned by Paul Merriman, who is solely responsible for their content. For more information, free articles, mutual fund recommendations, and more, visit paulmerriman.com.
Coming. My name is Jim Hopper. I'm the Executive Director of the Bainbridge Community Foundation in Bainbridge Island, Washington. We are very fortunate to be the community in which Paul Merriman has chosen to call home. And we're even more thrilled to have him here today for one of his fantastic presentations. As is our custom here at Bainbridge Community Foundation, we start all of our presentations with a land acknowledgement. Chief Seattle said, "Every part of the soil is sacred in the estimation of my people. Every hillside, every valley, every plain, and every grove has been hallowed by some sad or happy event in days long vanished." We begin acknowledging that the land in which we gather here on Bainbridge is within the Aboriginal territory of the Suquamish people, the people of the clear salt water. Expert fishermen, canoe builders, and basket weavers, the Suquamish live in harmony with the lands and waterways along Washington's Central Salish Sea, as they have for thousands of years. Here, the Suquamish live and protect the waters of their ancestors for future generations as promised by the Point Elliott Treaty of 1855. So I'd like to start by introducing Paul Merriman, who I'm sure many of you know. Paul is, of course, a nationally recognized expert on investing in mutual funds, asset allocation. He has written 8 books and countless podcasts. I'm sure many of you follow him either through Market Watch or through his podcast Sound Investing, or through one of his newsletters. We are fortunate to have had Paul as a board member here at the Community Foundation, where he really was an incredible mentor and friend to everyone in the Community Foundation. So you're here today to hear Paul talk about smart financial steps in your 20s and 30s. And I want to just remind you that if you go to the Bainbridge Community Foundation website at bainbridgecf.org and click over on the left-hand menu for news and events, you can find all of the remainder of Paul's presentations. The next presentation that we have is called Saving, Investing, and Planning, Getting Ready for Your Third Act. That's where Tom Cock will be joining Paul on April 6th. And then Christine Benz will be joining Paul for a presentation called Making the Smartest Financial Moves in Retirement. And then finally, Paul will be on vacation, but I will be here to speak with Mary Beth Franklin about how to maximize Social Security for everyone on April 20th. So again, you can find all of those on our website, and you register just as you did with this one. So with that, I'm going to turn it over to Paul with our extraordinary gratitude. This is, gosh, Paul, I'm not even sure how many years the financial education series has been going on, but I
think it's 8. I think it's 8. Yeah.
And we are just tremendously grateful. The resources that Paul has been able to share with you and others in our community and the broader community have been really invaluable. So we're very grateful for you, Paul. Thanks.
Thank you, Jim. That's very kind. And certainly we are grateful for the fine and wonderful work that the Community Foundation does. This community, I just think is amazing. I spoke recently to the senior center, and I look up to see where it might be noting what I was doing. I could not believe all the things going on at our senior community center. This is just a remarkable community, and I do feel blessed to live here. I am always excited about helping investors learn more about investing. I am always extra excited if I can get at helping an investor at a younger age. The earlier, the better, in terms of taking advantage of the leverage of time. And as I thought about what could I talk about in the 45 minutes to an hour before the Q&A session, I really wanted to focus on those things that I believe are going to be life changers to these young people. And the one area, and the area that my life really focuses on in terms of financial education, is on the area of investing. And there is no question in my mind that with careful, prudent steps, not having ever to do anything unusual, staying within the guardrails, staying the course, and all those good things that we know makes a more successful investor, I think that the path is relatively easy, and that is what our financial education is focused on, helping the do-it-yourself investor. I think that's important because people who are relying on somebody else to do everything for them, they don't need to know all of this information. But I do think if you're a do-it-yourself investor, you're sitting there at the table, and across from you is your client, and that client is you. And so you have to find out about that client, and you hope that client gives you good, solid answers to your questions so that you can give them the advice. I mean, this is tricky business. trying to be your own advisor. But I do believe that if you get the data, if you get the evidence that shows how investing works, I think that there's a good chance that you can be a great do-it-yourself advisor and client. I do think for young people, it is really important to give perspective to the process of investing. And by the way, at 79, I think being in the 30s is young, but I find even 30-year-olds don't necessarily get it as to how investing works in their best interest. And I have tried to think of it and describe it to young people as starting a business. I've started businesses. You put a little bit of money in, you work your tail off, and if you stay at it over time, a business can grow. And it is no different with being an investor. And so as you establish the business, you are the boss. You are the president. You are the general manager. And you have partners in your business. And what you need to understand as an investor who has this business, that it is the early days of that business that is going to make the difference as to success or failure. Because what you do in building the foundation of that business will create the long-term success. Now, later, your partners are going to kick in and they're going to make you tons of money. And you're going to get up in the morning and you're going to have a portfolio of mutual funds and companies within the mutual funds. And you have millions of people going to work for you in your business. And it truly, that is the way that it does work. You don't have much power over each one of those people, but you are a proportional shareholder in whatever you have in that corporation. Now, the question is, how do you become a really good investor? And I think the key is to start by following the math, following the numbers. When we follow the math, there's a word I can use that I cannot use if we're talking about investing per se. If we follow the math, I can use the word guaranteed, because I'm not talking about owning any particular investment. I'm only talking about the math of investing. And let me give you an example of that. Let's say that you are just starting out. And by the way, lots of people are just starting out in their 30s and their 40s. So this doesn't mean that you have to be in your teens or in your 20s to be just starting out. But as we start out, let's say that we find an investment that is built to make an 8% compound rate of return for the next 40 years. And I'll talk about such an investment in just a few minutes. And let's say that during that 40-year period, you got the 8%, and then you retired, and for 30 years, you took money out of that investment pool. You took out 4% a year, and you made 6% because you didn't want to take as much risk in retirement as you did when you were accumulating money. And at an 8% compound rate of return, what we know is if you put away $6,000 a year, that your $240,000 that you put in over 40 years would grow at age 65 to $1.7 million. Then you start taking the money to live on. And in fact, if you live for 30 more years, taking out 4%, you will, making 6% in the portfolio, have taken distributions of $2.6 million. And during the period of time or at the end of your life, you will then leave something to your heirs, charities, or children, $2.8 million. Now, from my viewpoint, the profit on all of your investing for your retirement and how you did is reflected in how much you lived on and how much you left. And for that effort, given this math, you would have had about $5.5 million in money spent and money left. Now, here is what I want young investors to understand. If we could just find another 0.5%. And instead of making 8, make 8.5 during the 40 years of accumulation. Instead of making 6, make 6.5. And I will share a number of ways that I think you can make an extra 0.5%. But if you did that, I think it's important to understand that the math tells us that instead of making 5.5 million, we will end up making about 7 million, because we will have taken withdrawals of 3.2, and our heirs and charities will be left $3.7 million. That is from a very small additional return. And the fascinating part is that extra 0.5% is really easy to come by. What if we double that? What if instead of 0.5%, we make it 1% more? Well, that's simple. I used to be an investment advisor. I used to charge people 1% to manage their money. If they hadn't hired me, then they could have kept that 1% and they would have made an additional 1%. Now, would they have done the right thing? Well, of course, this is the challenge today. What is the right thing to do? And can you be a successful do-it-yourself investor? But here's what that 1% brings you. It doesn't just double the 0.5%. Remember, that was 1.5 million. Doesn't take you just to $3 million extra. It takes you to $3.5 million extra because you had more money compounding on top of additional money. That extra money, the impact of compound interest, it still is, I think, amazing to a lot of people. But now, by having made an extra 1%, and it's really on your, it's up to you to do this, because you're going to need to know what you have to do to make that extra 0.5%. I've got some ideas. So here we are. We're at the third opportunity for you to do something that impacts this output, this outcome. And so if you do one more thing, this is not about the market, this is about you building your business. If every year you increase the investment by 3%, so instead of investing the second year $6,000, you invested $6,180, $15 more a month. That one step on your part as the business owner will take you, if again we have the 9% and we have the 7%, that will take you now up to a total of $12.4 million, an increase now of another $3.5 million. I mean, this is just basic math and the impact of saving a little more each year. So you might think you're done, but you're not done, because there's one more really good thing you can do, and that is you can start earlier. If you can, and by the way, I can't guarantee that every parent's going to be in a position to be able to help you start earlier, but many of us have taken the step to help our children and our grandchildren get those IRAs started as early as possible. My new granddaughter, my first granddaughter, was born in November. And the first thing we did, other than go and hug her and be happy to have her in the family, but we made a contribution to an account that is there to help fund her IRA when she finally gets there. Now, not everybody can do that, but a lot of times we're in a position that we know someday we're going to leave money to these people. Why not leave it in a way that it gets this huge, gigantic leverage of time and compounding tax-free, which of course is what we're working to be able to do for these early accounts. So we're talking now about the difference between starting early at age 25 and waiting 5 years and starting at age 30. And so the only difference in what these two investors are going to have at age 65 and then at age 95 is what happened in that 5 years that you put away $6,000 earlier than the other, and you increased it 3%. So by the time you got to 30, you were already investing more than the person who's starting at age 30. You got the rhythm, you got the discipline. And because of that extra 5 years, you are going to have an extra $4.7 million just because of that extra 5 years. They'll have 7.8 million, you'll have 12.4. So these decisions about investing, it isn't about picking the best stock, the best mutual fund. It is about arranging your business, taking control, building the discipline to build the foundation to make it flower. And flower, it will. But now we have to follow the history. We start out by following the math, and then we jump into the investing part. Then we look at the history. Then we see what steps we can take as an investor in order to have more money later in life. And by the way, I am absolutely dedicated to the idea that when you are planning your financial future, enough is not enough. I had a wonderful conversation with John Bogle in 2017. I had 90 minutes with him to pepper him with questions about his life and what he believed about investing. John Bogle was focused on getting people to have enough, to save, to have enough. I actually believe, having been around this industry since the mid-60s and having seen so many people that had a plan and they knew what they thought was going to be enough, only to find out that enough was not enough. And so one of the reasons I'm working hard to show people simple steps that they can take to build a bigger portfolio. It is not about having a fancier car or taking a longer trip. It is about making sure that as you do this, you go through this process of saving and investing and accumulating and doing all that you're trying to do to retire and have sufficient money to get along on, that you also prepare for the unexpected, which, by the way, most of the things we think are unexpected, the actuaries think are actually expected, but that's another story. First thing you run into as an investor is the fork in the road that says stocks versus bonds. Now, I was looking for 0.5%. If you want to find a place to find 0.5%, in fact, if you want to find the difference in multiple halves of 1%, the first step is to choose stocks over bonds. And yet 23% of young people, millennials, are not willing to invest in the stock market because it's too risky. It's gambling, it's speculating. It's not prudent, they think. But I want to show you the long-term return for government bonds, whether it be short-term government bonds, intermediate or long-term. $100 over the last 95 years has grown to $2,000 to $12,000. That's what we should expect out of bonds. A return that is somewhere between 3 and 5%. At least that's what it's been since 1928. Now, there have been times much higher and much lower, but that's been the compound rate of return. And here's what I know, that if that's one choice, what is the other? Well, the other choice is, if you put $100 into the S&P 500, a portfolio of large companies only, some are growth, some are value, some are hot dogs and growing pretty fast, and they're exciting and they're a place you want to be, and others are out of favor and not so exciting, but they're still big companies, so they're in this index. And that index has compounded over the last 95 years at 9.8, and that means that it grew the $100 to $750,000. Or if you took the growth out of the portfolio and you held only all the leverage of the large cap value companies, it would have been an 11% or almost $2 million. Or if you had a portfolio of smaller companies, instead of $100 billion companies, more like $5 billion companies, or even less sometimes, that portfolio, that index, that group of stocks compounded at 11.8. And then finally, the gold ring of investing. And I'm sorry that I talk so much about the small cap value asset class, because it isn't normal for people to have much in their portfolios. And I'm just on the hunt to try to convince people that they probably should have some in their portfolio. I will try my best to make the case here today, and believe that that will help you having to have more than enough when you need it. And over here, we have the combination of these different equity asset classes. And by the way, I want to make it very clear, nobody's handpicking the best of any of these. They're owning all of the stocks. These studies are, as you would in an index fund. So if I'm left with the decision and I'm looking for an extra 0.5%, it seems to me the choice of getting 10% versus getting 5%, there are 0.5% differences there. And truly, when you invest $6,000 a year and you increase it by 3% a year, and then you use that investment over a lifetime, it is in fact about a $14 million difference between going the route of the stocks versus the bonds. About a $14 million difference. So, what's wrong with stocks? What's wrong with them is this thing called losing. They lose. They lose badly. In fact, there's one year, calendar year, that the S&P 500 was down over 43%, large cap valued 61, small cap blend 48, small cap value 55. Those years feel terrible. And it just turns out the market loses money about 1 out of 4 years. So there's a lot of pain in the process of trying to get the gain that you're hoping to get. And sometimes people just, they can't stand the idea of losing money. But I can't say guarantee, but I'd love to be able to say guarantee. But I'll tell you what I know about the last 95 years. If you break it up into the 55, 40-year periods, there was never a losing 40-year period. The average compound rate of return of the S&P 500 of all 55 of these periods, that average return was 11%. Large cap value 13.4, small cap blend 13.7, and small cap value 16.2. The worst was 8.9, and that's not a loss. That's the worst gain compounded rate, and about the same for large cap value, and 10.6 for small cap blend, and 11.6 for small cap value. The worst 40-year period. So if we're trying to figure out where do we invest our money that we are going to get the highest return, I think if we are afraid of stocks and choose fixed income bonds, that we are likely going to make almost nothing before inflation, because all of these numbers I just shared with you are not inflation adjusted and have not been taxed. In other words, those returns from the bonds between taxes and inflation are going to leave you with almost no return. Daryl Balls is our director of analytics. He's a volunteer. Chris Pedersen, I'll mention him today, also a volunteer at our foundation. They are both amazing volunteers. Chris Pedersen wrote the book 2 Funds for Life and created our best in class ETF recommendations. Daryl Balls, has put together, we have 200 tables he just finished updating. He actually hasn't finished this one yet, but he's working on them. I'm going to be sharing a few of his tables. His tables are built as best we can to focus on numbers, but still make them entertaining enough that you'll learn something. Because what is this? This is the returns I've just been talking about 1 year at a time with the equity asset classes. So if you see a green return, that's the S&P 500. If you see the electric blue, that's the small cap value. If you see the kind of brownish, that's small cap blend, and the touch of yellow is large cap value, and the purple, I didn't talk about that, it's the average every year of the 4 of those equity asset classes. Now, what does that teach us? Well, the first thing that I remember is that the S&P 500 had the worst return. So I would expect the S&P 500 to be kind of at the bottom most of the time. Well, it is about half of the time, almost half of the time, at the bottom. But in about a third of the years, it's at the top. In other words, just because it might not be very good, relatively lower returns for the long run, does not mean that it's going to be there all the time. A lot of the times it's doing fantastic. And small cap value, the gold ring, as I said, of asset classes, it spends a lot of time at the bottom. About a third of the time, it's at the bottom. But if I had to pick an investment on this page that suggests to me that I have the least volatility, that I can count on that investment more or less year after year, no, never going to be number 1, never going to be number 4 or 5, but mostly just right in the middle. That is nothing more than the combination of the other 4 asset classes every year since 1928 through 2019. And I think that tells a couple of amazing stories about volatility, because even though the S&P 500 is theoretically more risky than the 4-fund strategy, I'm getting the feeling that it is actually the 4-fund strategy is less risky, that I can, in essence, count on a better return. In fact, I also know that if I look at the returns over a long period of time of putting these different equity asset classes together, here's the small cap value, there's a 13.4% compound annualized growth rate, the CAGR. Then if I put a portfolio together that was half in large value and half in small, it would have been 12.5. If I used a 2-fund strategy, by the way, this is what we're doing for our granddaughter. That money is going to be half S&P 500 and half in small cap value. That was a 12.2% compound rate of return. The 4-fund strategy that I just said was so marvelous in terms of volatility had a 12%, and here's the S&P 500 down here at 10.2. Now, the thing I was really anxious for you to do is to get into the stock market rather than having everything in bonds. And I'm guessing most of the people here with me tonight are in stocks. How much will be very different, I guess, but have stocks in their portfolio. But the fact that I could find an opportunity to go from 10 to maybe 12 and not take any more risk. Now, there are many, many ways to judge risk. And I will show you another way to judge risk with the S&P 500 and these different combinations of equity asset classes. You want to be more aggressive? I know how to be more aggressive. Go all value. You want to be more conservative? Well, I know how to do that, but I don't want you, if you're 20 to 40 years old, to be in equities for the long term. Every 10% you have in fixed income in your portfolio, in the long-term 40-year strategy that you're putting money away, every 10% of fixed income reduces your compound rate of return by about 0.5%. And so I don't want you to give up 0.5% for the next 20 years anyway, if you're in your early 20s. But I really want to encourage young people to be all equities until they get to age 40. Now I want to show you one more study. I think Tom Cockett, now Tom's going to be speaking to a different group of people. He's going to be speaking to people from 40 to 65. They have some different kinds of investment challenges. You know, we're pedal to the metal in a sense here. I'm not encouraging people to be all individual equity, buying individual company stock. I'm not trying to do that. I'm talking about diversified portfolios. But we have done a lot of work over the years. In fact, this table goes back to the mid-90s that I started working on this project. And what it did was it simply made the case for diversification of different equity asset classes. I want to do this quickly. I showed, starting way back then, starting with $100,000 in 1970. What did it grow to through the mid-90s? Well, now we're looking to what it grew to through 2022. And it would have grown to about $19 million, not adding any money, not taking any money out, not paying any taxes, but paying a minor fee to be in it. Almost like a regular index fund or an ETF. And then what we did to make the case, we one by one started adding individual equity asset classes. We added large cap value, 10%. The return went up to 20.8 million. We added 10% small cap blend. The return went up to 22 million. We added 10% small cap value. The return went up to 27 million. We added 10% in REITs, real estate investment trust. It went up to 27,600. Now that's not a big deal compared to the others, but it helped keep the volatility down. The REITs have about the same long-term return as the S&P 500, but they don't go up and down together all the time. And then in one fell swoop, we added 10% of 4 international equity asset classes. A large value, large blend, small value. Then it got up to 35 million, and finally we had 10% in emerging markets, and it gets up to $41 million using just the asset class returns. Nobody trying to do any better than own an index. And the point is not that you have to own 10 of them. The point is that it isn't just about diversifying amongst different stocks. You got 500 companies in the S&P 500. And by the way, those 500 companies are not the same today as they were in 1970. Every decade they replace and change about 200 of them. It's an actively managed index. And you can't buy that return. But we can buy the equity asset classes. And all the academic research shows that it is equally important to have diversification among asset classes. Now, you may not want to get beyond the 10. There are 2 funds that you have a very good opportunity to make a 10% compound rate of return. They've been turned inside out, going all the way back to 1928. They are the S&P 500 and they are the total market index. And so those 2, by the way, have almost exactly the same return. The S&P 500 has out-earned the total market index by 0.1% a year. Now, there are cases here where the difference between one and the next was only 0.1%, like from portfolio 2 to portfolio 3, or from portfolio 4 to portfolio 5. So even 0.1% can be important over long periods of time. And if I'm talking to some 20s and 30 somethings here tonight, I hope there are some here, then 53 years is part of your life. In fact, you're probably, which is what this table is about, you're probably going to be around for more than 53 years. All right. All I'm saying is that you can have more than one major equity asset class in your portfolio. And I believe if you do that intelligently, and I'm going to show you ever so briefly how to do it intelligently. Now, when I say how to do it intelligently, I have not stamped the word guarantee on anything, okay? Because I can't guarantee anything about the future. I can say that the academics will tell us the more diversification that you have, the lower the risk. So if you are combining different asset classes, and if those asset classes don't go up and down together all the time, again, you have an advantage. So now I want to look at a handful of portfolios that we've developed. And we tell you exactly the funds at Vanguard, at Fidelity, at T. Rowe Price, and we show the best-in-class ETFs, or ETFs. You can use it if you want to use the Vanguard ETFs, you can use those, or if you want to use what we consider to be better than the Vanguard, but you can buy them at Vanguard, you can use those. But we have built these portfolios and we show people the long-term results. We show them the risk, we show them the return. All I want to do here is to show you in table A2, here we are with $19 million in the S&P 500. Here's 41 in the ultimate buy and hold. If you just own 4 funds, 2 US, 2 international, one of them a large cap blend, one of them a large cap value, one of them a small cap blend, one of them a small cap value, and we tell you exactly the funds we think you ought to be in, you would have made a little bit more and only have to deal with 4 funds instead of 10. Or if you didn't want to go and take the risk of internationals, if you see that the homegrown are more comfortable for you, okay, do the same thing with a 4-fund strategy. It's still a balance of large, small, and value and growth. And the total value at the end of the 53 years, almost the same, 41,500,000. If you want to really take more risk, then you could take the worldwide all value, throw out the growth, throw out the great companies, and be left with the more conservative. As a matter of fact, if you go to Vanguard and look at the large cap value companies, you'll recognize them. In fact, the number 1 company in that large cap value group is Berkshire Hathaway. And you've got oil companies in there, and you've got Procter and Gamble. You've got a lot of great companies. And finally over here, I'll take you right to the last one at 46.6 million. That is half in the S&P 500 and half in small cap value. And why did I pick that? Even though it has a lower rate of return, 12.3, lower than I could have gotten we could have gotten theoretically for our granddaughter at 13. Why would I take this lower return? Because half of it is in this benchmark index that people just love. People think is Warren Buffett, as a matter of fact, even says the only investment you ever need to make is the S&P 500. And when he dies, he has asked the trustees to put 90% of the money he has for his wife into the S&P 500 and the other 10% into T-bills. So I want, when our granddaughter is 18 and she finds out about this account and money is going into a Roth IRA, because hopefully she's working a little bit and we can put some money into the Roth IRA as she starts working. I want her to be able to see the return of those two asset classes. I want her to see the difference year after year. I'm going to show you in a few minutes how different those returns can be. And to see also that there were long periods that the S&P 500 did well and other periods small cap value did well. It will be such a wonderful lesson, real time. So the big risk, the big problem is dealing with loss. We don't want to take the loss of the market. This is a wonderful graphic that shows since 1926, the good times, the bull markets, and the bear markets. The red, those are the bear markets. And with each bear market, it tells you how long it lasted from when it qualified as a bear market and until it was replaced by another bull market. And I'll tell you, when you are going down, I don't care if it's 4 months or for 2 years, it just feels terrible because it feels like you're going to go down forever. But you can see it hasn't been forever. And by the way, the bull markets aren't forever either. But boy, I mean, look at here, this one that ended in 1964 after 181 months, one that ended in 1989 that ended at 155 months, one that ended in 2000 after 155 months. And then we got hit with a couple of years where we had really, in 3 years, we had 2 bear markets. And then the market took off again. And then, I mean, this is the history of investing. And remember, the company that we're building, if we build it and it has the S&P 500 and it has the large cap value and the small cap value and the small cap blend, you have got so much diversification. It does not protect you against the complete collapse. We had a complete collapse in the 30s of the stock market. But what a lot of us may not know is the stock market for the whole 10 years ending 1938, from 29 to 38, the compound rate of return, which was not a return, but it was a loss. Well, the return was a loss, was a lower loss than was sustained in the 2000 through 2009 bear market. That 10 years was a negative 1%. As a matter of fact, if you look at the return inflation adjusted from 1929 to 1938, it was actually profitable because it was a period of deflation. So what I would love for you to do is to build a portfolio. And that conversation I just had about the what we call the ultimate buy and hold strategy, those 10 different funds, I just completed. You can go online and you can see about a 1-hour video just on that one topic. But if you are not going to build your own portfolio, what I would love you to consider is to use a target date fund. It is truly the #1 retirement investment in America today. And I'm talking about if you're in your 20s and 30s, you're putting money into a 401k, you have almost always going to have a target date fund available to you. And the target date fund does something that no other investment does. And that is It allows you to make one decision, whether you're 21 or 31 or 41 or even 51. You can say when you want to retire, and they will know. They will know how old you are, and they will know how aggressive you should be. Now, you can outfox them. You could be a 51-year-old investor and tell them you want to retire in 2065, in which case you'd have a portfolio that's only 10% in bonds. You can outfox them if you want to. But I'm not recommending you outfox them, although I will make a recommendation that I truly think is going to be life-changing regarding the use of a target date fund. But the target date fund has people, the same kind of people who run pension funds. I mean, this is serious conservative money. They do not get aggressive. I wish they did. I'm going to show you how. But it's very conservative. But here is the wonderful thing about these portfolios. Number one, they automatically adjust the amount of equity and fixed income over your life. So even if you retired at age 65, you could still keep them on your payroll working for you because they know how old you are and they will continue to add more fixed income as you get older. Now, I'm 79. If I had a target date fund at Vanguard, they would have me 30% in equities, 70% in fixed income. No way for me. My wife and I have oversaved, and so we feel we can take the risk of 50-50 instead of 70-30 or 30-70. But to have no responsibility for what to do with that money, but have it managed professionally for the rest of your life. If you don't know what you're doing, this is what you should be doing. You have a friend that doesn't know what they're doing. They're gonna, you should tell them that's what they should do. Now understand, target date funds have problems too. Everything has problems. It can't be what everybody needs. And one of the problems, I've got to make sure I mention this 2.3% down here. This is $1 million thing to know. The people at Wharton Business Schools, a project, worked together with Vanguard. They looked at 1.2 million Vanguard accounts that were in 401ks, that were in target date funds or not. So they could see how the people who were not were invested compared to the ones in target date funds. Now, with the target date funds, everybody's got the same thing. So it doesn't mean that all the people who were not in target date funds are going to have the same thing based on whatever age they are. But here's what they found out. That the people who didn't use target date funds, who made all the decisions themselves, they had way too little money in equities for the age. They had tons of cash in their account sitting there doing nothing. And they were market timing. And the end result was they were, based on what they were doing, designing portfolios to make 2.3% less per year than you get in a target date fund. So if you know anybody that doesn't know what to do and you want them to do the right thing, I really would recommend the target date fund. It is true. It drives me nuts. They've got 10% in bonds for a 20-year-old. And the reason that they do that is they just want to train people to understand that a target date fund is there to take care of the bonds and the stocks. So instead of waiting until 40, when is the next time that the target date fund adds any bonds, instead of waiting until then, they hang on to this 10% piece for 20 years maybe. So too much in bonds, too little in value, and too little in small cap. They are driven by funds like the S&P 500. Actually, the Vanguard funds are a combination of the total market US and the total market international. Large cap growth driven. And it's not that that's bad. It just isn't likely to give the return of a more broadly diversified portfolio. And Chris Pedersen came up with a solution. And I'll be offering a free book you can get online that he wrote. And what he suggests, several approaches. One is, let's say you're saving 10% in a target date fund. All he recommends you do to make a difference is to add, let's say you're putting in $1, put 90 cents into the target date fund and 10 cents into the small cap value, or 80% into the target date fund and 20% into the small cap value, or even 30%. And I'm going to show you why in just a few minutes. And all you do then is you just carry on your 90-10. You don't have to rebalance. You don't have to do anything. You will, if you start doing this and you do this for 10 or 15 or 20 years, you're going to get to know your employees, your partners very well. And you'll know the times that you're disappointed and the times that you're very enthusiastic for them. But that 10% could legitimately add an extra 0.5 to 1% over a lifetime. And of course, it even gets better if you go to 20%. He has in that book another portfolio that I just think is marvelous. Basically, you take your age, you multiply your age by 1.5, and that's you're basically the portion that the 1.5 is. That would be if you're 20, that would be 8 years old. That'd be 30. You have that amount in the target date fund. The rest is in small cap value. And as you get older, that 1.5 times your older age will have you owning more and more target date funds. For those of you who are interested, that book covers it. And by the way, the second half of We're Talking Millions is focused on that same subject. That is also available free. I put this in at the last minute. This is one of the most interesting tables that Daryl has ever done. I can't see the exact top, but you can, I hope. And by the way, I'm not going to ask you to be able to see all these numbers. I'm going to show you the bottom line in a few minutes. But here's what this table represents from 30,000 feet. On the far left, 1 year at a time, the return of the S&P 500. On the far right, the return of the S&P 500 1 year at a time without any fees. In the column right next to the S&P 500 on the right is small cap value 1 year at a time since 1970. There is nothing magic here. This is a whole bunch of years. Some years are great for one and not for the other. I can see 1977, S&P 500 was down 7.2, small cap value was up 22.2. I can see 2000 through 2002, and the S&P was down 3 years in a row. Small cap value only had a loss 1 year. By the way, the reason that happened partially is the previous 5 years, the S&P 500 was amazing and small cap value wasn't. So it's not like a small cap value just wiped out the S&P 500. These are different asset classes. They don't go up and down all the time at the same time or by the same amount. In fact, every year, the average difference in return is about 14%. So if one makes 10, the other one has probably made 24 or maybe lost 4%. But what I want you to see that's so valuable here, and that is the bottom of this chart. I want you to see that if you were in the S&P 500 itself only, with an annualized return of 10.4 and a standard deviation, a volatility rating, higher numbers mean a little more risky. For example, over here we have a 17.8. That would be a little more risky, but not much. But let me talk about under the S&P 500. The worst 6 months was a loss of 41.8%. The worst 12 months, a loss of 43.3. This is going back to 1970. The worst drawdown from a peak to a valley before it came back up to the peak was a 51% loss. Warren Buffett and Peter Lynch have both been quoted as saying, if you're not willing to lose half of your money, you shouldn't be in the stock market. But they're talking about for a short period of time, not forever. I know how to lose half of your money forever. Invest in Enron, invest in Washington Mutual. It's easy to do. Virtually half of the public companies since 1926 have either gone bankrupt or either were sold, merged away, and on average didn't make more than 3%. I mean, there are a lot of companies that don't make it, but we're not looking at trying to own just the good ones, because you can't own just the good ones. We want to own them all, knowing some of them will be dogs. This includes the dogs, by the way. Enron was in the S&P 500. Look what happens when you add 10% small cap value to the 100% S&P 500. Standard deviation is still the same. Remember, they don't go up and down together, so that helps keep the standard deviation down. It added 0.4%. And yes, you had to accept a little more risk, a little more loss. Instead of the worst year being 43.3, it's 43.9. And I know you're not thinking, ooh, I don't think I could take that. I can take the 43.3, but I don't think I can take the 43.9. Of course you will, if you'll take the 43.3. And if you believe you shouldn't be market timing and jumping out of the market when it's down. Okay. And by the way, the worst drawdown was 0.6% more. If you added 20%, it takes your worst 12 months to 44.5, a little bit more than 1% down, one time. And the worst drawdown was a little bit larger. And finally, if you went out 30%, it takes your standard deviation to 17.4. That is virtually the same. You would not feel the difference because it was that 0.3%. The worst 12 months, yes, is a little more. The worst drawdown, instead of 51 now, is 53.5. But you have just picked up more than 1%. That is a big deal. That is a huge deal. And not only will I hope you do, I hope your kids will. That's the whole idea, to share this. Now, for our granddaughter, I like the 50-50. I think that's it means there's going to be a drawdown of about 55.8, more probably, who knows. And the worst 12 months was 3% more. But she will have picked up almost 2% more compound rate of return. And if I Of course, I'm not going to be there when she's 18, but I will try to through a podcast to her, a recording and a letter, convince her just this particular investment. Keep it all equities your whole life. The implications of that, and get it into your Roth IRA as soon as possible. The implications of that are not only will she be able to spend a lot of money, but she also should be able to leave money to things she cares about. And Jim, it might not be Bainbridge Community Foundation. I don't see her living on Bainbridge. So, but it will be some community.
Don't sell her short there, Paul.
Okay. Oh, you want to make an extra 0.5%, lower the expenses of your mutual funds. The average equity mutual funds around 0.8. You can get into an index fund or other ETF funds for 0.1. You can save 90 basis points, 0.91% by using a lower expense fund. Be in a fund that has lower taxes. A lot of people don't know, in actively managed funds, Morningstar tracks the tax efficiency of actively managed funds. There's about a 1% higher cost in return to actively managed funds because of taxes. And you can go track that. You can look at your actively managed funds and see how much what is the tax implication of that actively managed fund. And trust, and of course, index funds, that gives you low expenses, it gives you low taxes because there's low turnover, and it gives you massive diversification. And buy and hold. I know I've been following market timing since 1966. I know market timing inside and out, and I have talked to thousands of people who have tried market timing. Market timing is the most difficult thing to deal with, because once people use what I call the ICSIA market timing strategy, I can't stand it anymore. They got out of the market in either late 2007, early 2008, and many of them are still trying to figure out how to get back in. One bad market call, getting out when you think the world's coming to an end. About the time you think the market's coming to an end, more than likely, it's very close to the bottom. One of the biggest challenges to be a good investor, to run a really good business of investing, is to realize that this is not about events. This process is not about events. If you are a buy and hold investor, you are not supposed to be responding to events. You are in it for the long-term journey. That's what long-term investing is about. And with that in mind, every time you see what the press, what TV, what they're pushing events, inflation, political uproar. Go watch Jim Cramer on TV, and he talks about the earnings. An earnings report is an event. It has nothing to do with the next 40 years. Or, by the way, if you're in your 20s or 30s, we're talking about doing this for maybe 60 years or more. It's the long journey, and it takes discipline to buy and hold. And every 10% you add in equities, if you're a fixed income person, every 10% you add is going to add about 0.5%. And of course, I'm hoping, as you can tell, you'll add some small and some value. I'm going to check my time. How bad have I been? Well, I guess I'm okay. IRAs and 401k. Now, see, anything else I talk about is not going to have the impact that I just talked about regarding these decisions you're going to make about your business, your investing business. But there are some things you can fine tune and make a little better. For example, if you work for a company that has a 401k and it has not matching anything, and it has lousy investment options, and if you don't know if they're lousy investment options, it's okay if you ask me, Paul at paulmerriman.com. I mean, it takes just a second to see if they're lousy options. Now, whether I'll tell you exactly which options you should use depends how much time I have, but I will tell you that if you follow our work on the internet, you will know what options you should be using. So that's part of this process we're trying to go through here, is introduce you to these asset classes. But if you don't have good 401k choices, you're better off going to an IRA. In fact, you may not have a Roth 401k inside your 401k plan. And definitely, if they're not matching, you'd want to go use the Roth IRA on your own, because you'll have access to all the different equity asset classes, all the ETFs, all the indexes at low cost and broad diversity. I mean, you can do all the right things. And you can use a target date fund, by the way, with a small cap value inside of an IRA if you want. But of course, after you do that $6,500, you're going to have to go hold your nose and start putting more money in the 401k. Now, I take a little different approach. And there are a few sources I'm going to give you. On our website, we have a page called Truth Tellers. They are sources of information I trust. I do not get paid anything from any of these people. I do not get paid anything from the foundation. When I retired, I promised my wife I would never work for money again, and I've kept that promise. But I will tell you that, oh, you know something? I normally warn people this could happen during the presentation. I forgot to warn you. At 79, from time to time, my mind does this thing where it, what is it called? Forgets. And so I lost the path there for a second. Oh, yes. Oh, yes. The Roth. Why the Roth? When you put money into a Roth, you are not getting a refund. And you are getting lifetime tax-free growth and lifetime tax-free income. That is golden. And when you are young, you're not in a very high tax bracket anyway. And when you do a regular IRA, then what you typically do is you get that refund because you did it and you spend it on something that's fun. Now, I'm not trying to ruin your fun. I'm just saying that when you put money into a Roth IRA, you are in essence investing more money. And you're getting it in there to be protected from taxes. And I can tell you that when I came into this industry in 1966, the highest marginal tax rate was 70%. The year before, it was 90%. And who knows what taxes will be in the future. Now, back to the 401k. You got a match going on in your company? You got to find the money somewhere. You've got to find the money to take advantage of that 401k match. See, it's not just the match, it's that you're also probably really young. I would have no hesitancy. I mean, my kids, my younger kids knew that I had done this for my older kids, so they knew that I was committed to doing this for them. But there are a lot of parents that they just might not think that this is a better way to leave you money. Don't forget those first 5 years. And so not only by doing that match are you getting your money in there, but you're doubling, you may be getting twice as much but from the match. There are companies that literally match dollar for dollar. Some it's up to 10%, some 5, some 3. But I don't want you to miss that match. I know people. There's a thing called the FIRE movement. It's financial independence, retire early. I can't say there are millions of people in the movement, but I can tell you there are hundreds of thousands. And these are people who are trying to retire early. And they're saving money big time, percentage-wise. I know some that save 70%. I know people that are working a couple of jobs, not because they need it to get by on, but because they need that extra money to fund these things early on to take advantage of that first 5 years. So, then of course there's the triple tax treat, the triple tax-free health savings account. Now, I'm going to have you go somewhere else. I'm not going to spend the time to talk about it, but it allows you the tax deductibility, the tax-free growth, and the tax-free distributions, with the money being used to pay for health expenses in your life. And by the way, once you start investing in the taxable accounts, I want you for sure to be investing in something like the S&P 500 in particular, or ETFs, where they're very tax efficient. ETFs are much more tax efficient than regular mutual funds. Here are the truth tellers. I tell you, you come up with almost any question about investing, and they will have at the balance an article that is not only written by professionals, but is peer reviewed. And if you don't get what you want there, go to the White Coat Investor. And if you want me to recommend a book that will address most of the questions you'll ever come up with, my expertise is really about investing. I'm not a tax guy. I'm not an insurance guy. I'm an investment person. But there are lots of other things that you'll want to get into. And that book, Your Complete Guide to a Successful and Secure Retirement, is just terrific. And it's available as a paperback. And if you want to read somebody's work, Larry Swedroe is one of our truth tellers. Here are the 2 books that are free. And you've got a PDF. I think if you go to your PDF that you got, if I'm not mistaken, you can go right to the place on our site where you can order the free PDF. And we make this, both of these books are free for a reason. What we want you to do, one, is read the book and say, hey, that's really good information. Then I want you to send it, because you'll have it in a PDF format, to send it to other people that you might think will benefit. At age 79, I got a lot of goals. In fact, I've got a bucket list. It may not be the kind of bucket list you have, but on my bucket list is I want to speak at the Bogleheads conference before I die. The good news is I just got invited to speak there. I have got some things I want to accomplish before I end the work that I'm doing. I want this little book, and it's a short read. I want it in the hands of 1 million youngish people in their 20s and their 30s. By the way, anybody can use it. And the 2 funds for life, there's also a part about 2 funds for life when you're retired in this book. And the fellow that wrote it is one of the smartest people I've worked around, one of the nicest people, and both Darryl Balls and Chris Pedersen, and one more name I've got to mention, Craig Apple. He created a calculator so that he could take our numbers, our 200 tables that we have, and put them on a computer where people can use them in a calculator format. So you can not only can you put your own numbers in there, how much you have to invest, how much you have in your portfolio, but you could also trick the computer, and you can say, I like those numbers from the last 52 years. I'd love it if I could get that return again, but I'm going to take a 1.25% off of all the returns that are in the calculator, in the database. Oh, I'm going to take 2% off. I'm going to take 0.5% off. You tell it what you want to take off, and it will do that for you. These are all volunteer helpers with our organization. And there's my email address. I'm easily reachable. And I think most of you, hopefully, who are here have not found it too difficult to get a hold of me. I hope this has been helpful. Now, Jim, do we have a few minutes for questions?
Indeed, we do, Paul.
Good.
Paul, I'm going to start out with my own. So if you want to go ahead and close your
I will.
presentation, and we can be right on the screen.
I am so sorry that I did that to you.
Well, that's okay. We're all good. All right, Paul. So I'm going to tell you the story of two brothers, grew up on a farm in Caldwell, Idaho, both of whom in their 20s were working. One was in for-profit companies. He was actually an Enron employee. The other was working in nonprofits. They would both go on to be CEOs of their respective organizations, respectively. But for one, for the for-profit, he in his 20s received a tremendous amount of corporate stock from his employer, and of course the going sort of pressure is, you hang on to that and you believe in the company that you're a part of. The other that worked for nonprofits felt like, gosh, I don't think I make enough money yet to start investing. I need to spend all of my money right now on my house, on my car, on whatever it is that is my basic living expense. So I asked that question. So I'd love, I think a lot of people in their 20s find themselves in one of those two camps. And I'd love your thoughts on how do you keep your head in either of those situations. In one situation, you have a lot of money on paper. You look like you are doing really, really well. In the other situation, you don't feel like you're ever going to have enough money to start to invest. And frankly, when you hear wonderful presentations like yours, where people say, like, start early, that, it's panic inducing, right?
Well, first of all, you could start with very little. I mean, literally, you could start with $100. You could go to Fidelity. You could. We have these recommended portfolios, and we recommend ETFs. And you could go to Fidelity and you could buy those ETFs. Let's say you wanted to buy all 4 of those ETFs, a little bit in those big, small value, all that. You could divide your $100 into 4 parts, and you would be able to buy portions of 4 funds so that you had a $100 portfolio, completely diversified, and there was no commission to buy. When you go to sell, there's no commission to sell, and the internal expenses inside of those ETFs are very, very low, less than 1/10 of 1%, I'm going to guess. Now, so you can start with a little. The other thing that you can do, and this obviously is not easy for everybody to do, but some people are so driven to saving that they will work a second job in order just to earn that money that it takes to meet whatever that you want to put aside. So that's also another possibility. But let me tell you something that's happened in our society. We now count on a 401k that we put the money in. Yes, some companies match, but the heavy lifting is left to us. And we are also left with the heavy lifting of having to decide what investments that we're going to make. And so the problem is that right out of the gate, we're behind the 8 ball, because even if we can save, we're not sure what to do. So what happened was companies gave people a legitimate offer. They would allow them to opt in automatically to the retirement account. And a very small number of people would sign up for the retirement account. And then they changed. Instead of requiring people to opt in, they automatically signed them up and they became part of the program, and they had to opt out. And 83% of the people stayed in.
Yeah.
And it is a mindset. I know in watching what these doctors are doing, who are part of this white coat investor group that I spoke with. I had 4 days there where I was talking to these people about how they feel about investing and how they treat their money. These people are being encouraged after they become a doctor to continue to live like a resident. And a lot of them are doing that exact thing. They're learning to live financially like they were a resident. So I know this is a mindset. And I know that there is the possibility of saving, but it means a dedication that for a lot of people doesn't even feel good. I'm just thinking about this guy who's the nonprofit guy. You know, when you're in the nonprofit industry, generally you're not about money.
Right.
When you're in the broker's business, in the money business, you are about money. That's all you're about. And so I could see where somebody would say, I'm not going to do that. I got a life. I love what I do. And I'm not going to do stuff I don't want to do. Well, I know a man who was a nonprofit guy. And what he did, he quit being a nonprofit guy for 5 years. And he went out and worked doing things he didn't want to do. And he saved like mad during that 5 years. And then after he worked for 5 years and saved like mad, he went back to what he was doing before, but he had put aside enough money that over the years that he would now be working for very little, that he could build his retirement. Now he still has to invest it properly. But yes, there are answers. The problem is that it is really hard to have that discipline if you don't have that kind of a mindset.
Yeah. And how about the flip side? How about the one that's got lots of money, but it's all in his, and it's not diversified, it's all in his own employer stock? How does, what
the
mindset
biggest
do you recommend that person have in order to, they at the time, as you can imagine, don't feel like they're ever gonna lose.
Well, and I thought I heard you mention Enron for a second there.
I did, yeah.
And Enron employees generally were told they should be putting all their money in their 401k into Enron stock. I wonder who that was benefiting.
Right, right.
So here's the problem. If you don't understand the emotional side of investing, you may never beat it. One of the reasons I'm trying to get this thing on automatic for people, that's why I love the target date fund, is because the less you have to think about this, the better off you are. There's a wonderful book entitled Your Money and Your Brain by Jason Zweig. I've probably read it 7 times. And I only do that because it's all about the psychological side of money. And one of the things that we know about ourselves, or the psychologists know about us, is they know that we are overconfident. That's our nature. Now, not everybody is. People who are depressed generally aren't. In fact, people who are depressed, it's in the book, make better investors because they don't believe. There's a book called Learned Optimism by, I think, Gerald Seligman, I believe. He talks about successful salespeople. The reason they're so successful is because they're so optimistic, but they're looking at life through rose-colored glasses. That's why the last person I want trying to help me, because somebody's selling them, and then they're turning around with those same rose-colored glasses and a commission at the end of the month selling a product. I'd rather have you learn how to use index funds and make it and automate it. But that overconfidence could lead somebody to believing that US is the only place you have to invest, or my company is the only place I have to invest. When I sold out my investment advisory firm 12 years ago, or in 2012, I knew I wouldn't make as much money, but it was time to pass the baton of risk to other people. That company is continuing. Merriman Wealth Management is, in fact, I think next week I go to our 40th year anniversary, and I can't wait. It's going to be great fun. I'll probably get a new mug, but what I do know is that these psychological aspects, that's the reason most people need an advisor. They can't beat the psychological problems. We had a couple came into our office one day, retired airline pilot. This is back in like 1999, and his wife was with him, and he had retired. He had all of his money in high-tech stocks in 1999, and all of his money, his complete retirement from the airline, he had rolled it over into high-tech stocks in 1999, and he left to use the bathroom, and his wife literally broke down crying. She had never told him she was scared to death because it was his job to take care of the money. And he was being overly optimistic because not only are people optimistic, but we think linearly. And when we think linearly, we have recency bias. And when we have recency bias, what's been doing well, we think is going to continue to do well. And it doesn't work that way. As people found out, after from 95 to 99, the S&P 500 compounded at 28.5%, and for the next 10 years, it loses 1% a year. And so that being overly optimistic, having recency bias, all of these things can trip us up. And wishing stuff would work does not work. Is very common. Another emotional thing people do, Jim, is the market's been up and it goes down, and things go way up, and then the bear market comes along and they go down, and people just assume that when the market goes up the next time, the stuff that's way down is going to go up, and that's a bad assumption. And most of the things that people believe work are not right. The myths of investing, there are over 200 of them. And the things that work are not offensive. The things that work are defensive. Owning 1,000 stocks is defense against owning one. Low expenses, defense. Low turnover, low taxes, defense. Having fixed income in the portfolio to match your risk tolerance, defense. Putting it on automatic, defense. Having an investment advisor, defense. And people think of investing as being something aggressive, offensive. And that's the wrong attitude, because your emotions are going to tend to trick you. That's why people trying to market time, they don't have a shot being a market timer, because you got to know how to take a loss. You got to know how to take 5 losses in a row. Who's going to do that? So read your money and your brain.
Yes. Paul, we're out of time. There's going to be a couple of folks that I'm recommending reach out to you by email with with individual questions. For everyone else, I just want to thank you all so much for joining us, and again, thank Paul for his terrific advice and recommendations. And please do visit our website, bainbridgecf.org, and look in the news and events section over on the left-hand side for information about the future presentations.
And may I just say one thing? I saw Christine Benz's presentation in Phoenix a few weeks ago, and I said, please just do that presentation for our folks, and they will love it. I guarantee you will enjoy it. It is terrific.
Okay, thank you so much.
Bye-bye now. And thanks to everybody. It is great fun being able to reach out and share information that makes your financial life better. And I'm going to, in just a second, I am going to introduce Christine Benz. And boy, is she going to do a lot to do that here this evening. But very quickly, I just want to tell people, next week on the 15th, we have another presentation. I will be doing the presentation, and it's basically for first-time investors, although I think anybody will learn from it. I want to make sure that young investors and other first-time investors take all the right steps to get the most out of their investments. And so I'll be talking about my new book, We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. And everybody will be able to get a free copy of the PDF of the book who come and join us. And then the week after that, another, like Christine knows so much, Larry Swedrow knows so much too. And these two people have such a rich background in the investment process, and you will love the information that Larry has to share with us. As a matter of fact, I happen to know some ways that Christine and Larry differ on things, so I'll be putting together what I hear from Christine tonight and Larry then, and we'll have some fun with that. Not going to embarrass anybody. And then a week after that, we're going to have one of the true all-stars in the educational process dealing with financial literacy. I don't know anybody else like Tim Ranzetta. Tim Ranzetta started an organization, Next Generation Personal Finance.org. If you want to go to the website, ngpf.org. And if you're going to come join us, or even if you're not, I hope you'll take the time to go on the internet and take a look at his video, The Most Important Class You Never Had. But he is changing the lives of young people like nobody else that I know, and he's going to come join us. So now let's get down to business, because we got some great information tonight. Christine Benz is somebody who I've known, but really I've followed, because she puts out some of the best information. And one of the reasons that she puts out such great information is because she has at her resource, Morningstar. We talked before we got started. They now have some 6,000 people. She was around 200 or so. So she has been at Morningstar since the early days, which gave her a chance to be involved in many different levels there as an analyst, as an editor. But for, I think, 12 years now, she has been the director of personal finance. She has a weekly podcast, The Long View. She is absolutely committed. In fact, I'm going to post a piece she wrote about her journey to becoming a part of the Morningstar mission. And I think if we have young people who like to hear about success stories of folks who work their way up through the corporation, particularly one of those hard-charging, growing, high growth organizations, it really is. It's a touching story, and I am so pleased to be able to introduce you to one of Barron's 100 top women financial experts. And really, I think, oh, by the way, I should mention there's something I know you're looking for because you ask for it all the time. You want model portfolios. You want to know how to invest depending on how much risk you're willing to take and what funds you might have access to, et cetera. Christine has over 20 model portfolios. Christine Benz, thank you so much for coming to help us this evening.
Well, Paul, thank you so much. It's my pleasure. It's really lovely to be here. I have to say that the Washington State area is one of my favorite places in the world. My husband and I have had many good vacations in that vicinity and would love to be there in person. But in the meantime, I'm happy to join you from my home office in the suburbs of Chicago. And I'm going to be talking tonight about retirement planning, which is an issue that I focus an awful lot on in my work at Morningstar. Before I get started, I just quickly wanted to discuss, discuss sounds more in depth than I'll go. I just wanted to say that Morningstar.com has a lot of great information, much of it free. We do have a paid service on the website that entitles subscribers to read all of the analyst reports about individual stocks and mutual funds and exchange traded funds. But I wanted to mention that many libraries are subscribers to a version of that. So if your public library is a subscriber, you can access that same general set of research for free from your home desktop. So check that out, ask your library, because it's a pretty neat service and you would not need to pay anything directly. You're paying indirectly through your library. So I wanted to mention that, but much of what's on Morningstar.com is free, including my model portfolios, including my articles, and my materials are really educational in nature. That's very much my focus at Morningstar. So I'm going to be talking about retirement blind spots tonight. I'm going to share my screen with you here, and we will get started on my presentation. And I'll just give you a quick overview of what I'll cover today. I'm going to start by talking about why I care so much about talking about retirement planning and specifically the retirement decumulation period. And then I'll get into the 6 blind spots. I'll talk about why these are risk factors for so many retirees, but I'll also talk about how you can address them at the portfolio level as well as at the financial planning level. And then I'll talk about, or we'll tackle some questions toward the end of my presentation. So the reasons why I'm so passionate about this area of demystifying retirement decumulation. Well, at the top of the list is what I call the financial complexity complex, that we have a lot of agents, a lot of people in the financial services industry who, unfortunately, I think have sort of a mission to complexify investment planning and retirement planning. They want to make it seem so complicated that it's something they want you to come away with the conclusion that you couldn't possibly tackle this on your own. And I do happen to think that retirement planning is a complicated area where many people could use an advisor's opinion in the context of their plans. But I also think that being empowered, getting knowledgeable about the basics of how to create a successful retirement plan is really incumbent upon each of us. So kind of combating the financial complexity complex is top of the list. I mentioned that retirement planning is, retirement decumulation specifically, is more complicated than accumulating assets for retirement. Really, accumulating assets for retirement, as long as you get started reasonably early, as long as you don't make big mistakes by dabbling in individual stocks, if you use some sort of semi-sane plan, it's not that difficult. But retirement decumulation, figuring out if you have enough, figuring out how to make sure that your portfolio is not unduly affected by inflation, making sure that your portfolio is able to last over a 25 to 30 year time horizon, that gets more complicated. So there's more to discuss in the realm of retirement decumulation. Another reason I like to work on this area is that there are a lot of behavioral issues wrapped up in retirement planning. So a common issue that retirees often run into is that they want to try to subsist on income alone. They want to try to subsist on whatever yield their portfolio produces. Well, as you all know, we've seen a period of dramatically declining yields where that's really difficult today. But that's a common behavioral issue. And there are many other behavioral issues. And frankly, they're just interesting to me as someone who works in this area, trying to help people make smart decisions about their retirement plans. One other reason I like to work on retirement decumulation and educating about it is that people at this life stage, as they get close to retirement, are extremely receptive to getting information about how to do it. I have sometimes been involved in financial education with younger investors, even high school students, where you get sometimes people who are kind of disengaged from the process because they don't have any funds to invest. It's not really relevant to them at their particular life stage. Or retirees, pre-retirees really need to figure this stuff out. So I find that they're incredibly receptive to learning. And finally, on a personal note, I would say that I was a partner to my parents as they embarked on their retirement years. And my dad had been kind of an investment mentor to me as I was starting out in my career. And I was always sort of his investment buddy side by side with him. And my dad experienced cognitive decline later in his life. And I was so glad that I was there with him to be his investment partner and to really manage my parents' finances in their later years before they passed away. I often speak to groups of retirees where perhaps there's not that trusted financial partner. And so part of my mission is just to try to do education, try to make sure that the people I'm talking to are as empowered as they possibly can be. And if they do need to go out and find some sort of external help to help them through their financial plan in their retirement years, that I think they can be savvy about selecting their financial advisors. So those are just some of the reasons why I like to work in this specific area of retirement decumulation. So getting into the blind spots of the presentation, the first blind spot relates to what we call retirement date risk. And what that means is that the date on which we retire, and some of you may already be retired, but our specific retirement date isn't always 100% within our controls. It may be, but oftentimes there's some slippage. And what you can see on this slide is people who were surveyed prior to their retirement were asked when they expected to retire. And then they were later surveyed about when they actually did retire. And what you can see is that there's a disconnect. You can see that many more people expected to delay retirement than actually did delay retirement. So about 60% of people between the ages of 50 and 64 retired. Many fewer thought they would be retiring during that early window. So the takeaway here is that we oftentimes don't have control over our specific retirement date. And there are lots of reasons for why that happens. There may be reasons why people are forced out of their jobs earlier than they might have anticipated. This pandemic has been just such an environment where we've seen older adults being displaced from the workforce more than the general workforce, more than the general population. That stands in contrast to the last financial crisis where we saw older adults being able to hang on to their jobs better than younger adults. The pandemic has forced more older adults out of work earlier than they might have expected. So unexpected job loss. We know ageism is a thing in our culture. In some cases, people might have jobs that entail some level of physical exertion that they're unable to do in their later years. There may simply be health issues, either the worker's own health issues, spouses' health issues, parental health issues. I was someone who was involved in helping care for my parents in their later years, not directly, but helping oversee caregivers. And I know personally that that can take a toll. And thankfully, I work for an employer that was incredibly generous in terms of letting me balance my family responsibilities with my work responsibilities, but we know that many other employers are not quite as generous. So a lot of these issues can conspire against people continuing to work as long as they might hope to. So I'm always a little troubled when I'm out talking to older adults who tell me that their plan is to continue working as late as like age 75 or something like that. We know that forces beyond our control can sometimes cause us to need to leave the workforce earlier than we might like. So why is this a problem from a financial standpoint? Well, it probably seems pretty obvious that if you are forced to retire earlier than you anticipated, you can't continue to make contributions to your retirement plans. You may have fewer years that your portfolio can continue to compound and enjoy returns prior to needing to draw upon it. And another thing that I would point out is that much of the research we have about what is a sustainable withdrawal rate for retirement relates to like a 25 or 30 year drawdown period. Anytime you're looking at longer periods than sort of the standard 25 to 30 year period, well, you need to be that much more conservative about withdrawal rates. So some of you may know people in the financial independence or retire early movement, the FIRE movement. I sometimes hear those folks talk about like a 4% withdrawal rule for their retirements. And that makes me really nervous because we really just don't have retirement withdrawal strategies stress tested over such a long period. And finally, if someone is forced to retire earlier than they expected, they may not be able to do other beneficial strategies like delaying Social Security, which in turn can force them to take more from their portfolios early on in their retirement. And that may in fact impair their portfolio's long-term sustainability. So how do we mitigate this risk, this retirement date risk, if we're still working? Well, an obvious one is to continue to nurture our human capital throughout our careers, even into our 50s, even into our 60s, making sure that we're staying current on technology. And I think certainly the past year has given us all a crash course in getting up to speed on technology, but just making sure that we're continuing to burnish our human capital, attending seminars, attending continuing education, whether it's required or not. I think it's also worthwhile for all of us as we move into our 50s and 60s to think about what our backup career might be if in case we were dislodged from our current career. So to think about your backup plan and then maybe your backup plan to the backup plan. It's just worth thinking through what you would do if you were unable to continue in your current occupation. And I think what people sometimes don't realize is that even if you aren't able to stick with a career that's as remunerative as the one that you had during your main earning years, even if you can continue to pay the bills with some other career and forestall portfolio withdrawals, kind of those hybrid strategies can be incredibly impactful as well. And there's been some great research done in this area of what are called encore careers, where perhaps you're pursuing something that isn't as high earning as your main career, but perhaps it's more gratifying. If that can keep you in the workforce, if that can keep you earning a paycheck that in turn can help you pay your bills, those hybrid strategies can be great strategies as well. Saving more while you're working, obviously, to help mitigate the impact of early retirement is kind of an obvious conclusion to come away with. And finally, giving a little bit of thought to insurance planning, specifically healthcare planning. So for all of us in our 50s and 60s, I think it's worth thinking through if your healthcare is coming through your employer, what is your backup plan in case you were unable to be under that employer's healthcare plan. So perhaps it's the it's COBRA, perhaps it's the ACA, but just thinking through and perhaps even taking the next step of pricing what that healthcare coverage might look like for you is a good step, just so that you're prepared for healthcare coverage prior to Medicare coverage. So the next blind spot that I wanted to cover is what's called sequencing risk. And I'll explain what we're looking at on this slide. This is two different retirement start dates. One would be the mother of all bad start dates for retirement. This would be in the early 70s, early 1970s period. If you embarked upon retirement then, retirement researchers really agree that that is the worst period into which you might have retired, because you had a bear market in equities, and some of you may have been investing during that period of the early 70s. You had a runaway inflation after that. You had a lot of risk factors for retirees. So what we're looking at is if someone embarked on retirement during that terrible period and had a portfolio that was 50% stocks and 50% bonds, during that period, a $500,000 portfolio, if they were spending 5% of that portfolio, they would have burned through that portfolio in a 20-year period. And those of us who focus on retirement research see that as a failure, because you want your retirement portfolio to last longer than that. Unless you wait until age 75 or something to retire, you want to plan for more like a 25 or 30-year retirement, potentially even longer. So such a withdrawal strategy, that 5% withdrawal rate, that 50-50 portfolio would have been out of funds in 20 years. If we reversed that sequence of returns, so if the great returns of the early 90s occurred at the beginning of the period, which is what we're looking at on the right-hand side of the screen, you can see that it's an entirely different situation. So same 50-50 portfolio, same 5% withdrawal rate, same initial $500,000. Well, not only did that person support his or her lifestyle in retirement, but also nicely grew the portfolio. And what this slide is meant to illustrate is that it's really luck of the draw. We don't quite know the specific environment that we'll retire into. And that is why we want to think about planning for the worst case scenario. So hoping for the best and planning for the worst. And my next slide illustrates how the right withdrawal rate really does depend on the specific time period into which you retire. So I've circled on the slide that really difficult period that we were looking at, that it really didn't matter what asset allocation, what stock bond mix you came into retirement with, you would have had a troubling retirement period. And that's where when Bill Bengen, the financial planner who came up with the 4% guideline for withdrawal rates, he really focused on that specific area. And his conclusion was, even if you happen to retire into the worst market environment that we've seen so far in market history, if you took 4% of your portfolio initially, and then inflation adjusted that dollar amount each year thereafter. So you're kind of looking for a stable, real stream of income in retirement. What Bill Bengen's research showed is that that strategy gave you a good shot at not outliving your assets. So that's why oftentimes you still hear the 4% guideline referenced in the context of withdrawal rate strategies, that perhaps that's a safe withdrawal rate strategy, even if the next 20 or 30 years aren't so great, or that maybe the next 10 years. So I've kind of mentioned why sequencing risk, why the sequence of returns that we experience in our retirement matters so much. That ideally you would be accumulating assets when they're cheap and selling them off throughout your retirement. So that's, if you're spending from your portfolio, you're essentially selling off pieces of your portfolio. That's the ideal sequence of return that you would experience prior to retirement. You'd buy stuff cheaply and then you'd sell it when it's more expensively. A negative sequence of return is when you kind of experience the opposite, where you are enjoying really great returns in your accumulation years, then you're having to sell them off potentially when things are headed down. So encountering a negative return sequence can affect one or two things. Either the retiree really has to reduce his or her standard of living when he or she encounters that poor market environment, or you do nothing, you just continue spending away blithely, as we showed on that slide of the person taking 5% out of their portfolio, and then you run out prematurely. So what do we do to mitigate this sequence of return risk, which, as I said, is something that's kind of out of our control? Well, I'm going to talk about that, but first I want to just discuss the current market environment a little bit. This is a metric that's called Shiller PE, which is developed by a Yale economist named Robert Shiller. And it is a cyclically adjusted price earnings ratio. It's meant to be a measure of whether the market is cheap or expensive based on the cyclical factors, based on various market environments. And so one thing, if we look at Shiller PE, we see that it's been flashing a little bit of a warning signal for a while now, where stocks have looked expensive based on this measure. A lot of people who look at this think that maybe it's a little bit overly cautionary because we have had great returns for the past couple of years. And you can see that Shiller PE has been elevated relative to where it's been in history for the past several years, and yet the market has continued to go up. This is a view of asset class return forecasts from our team at Morningstar Investment Management. You can see that they too are predicting fairly meager returns from the US equity market over the next decade. And usually when you hear predictions, I would say run the other way, especially if they're short-term predictions. But all of us, when we're creating a financial plan, we need to have some sort of baseline assumptions about how much the market is going to help us out. So our Morningstar Investment Management team and a lot of other firms do this sort of work as well. They come up with these forward-looking forecasts of what they expect different asset classes to return. So you can see those strongly positive sort of aqua bars there are their expectations for international developed and emerging markets stocks. They're expecting better returns there, but pretty muted returns from the US equity market. And they arrive at these forecasts by looking at starting current dividend yields, looking at their expectation of earnings growth, what we expect to see from earnings growth in these various markets, and also looking at their expectation of valuation expansion or contraction over the next decade. So pretty muted returns from US stocks, pretty muted returns from bonds as well over the next decade. And the green bars, I should just say, that's the change from the previous quarter. So this is measuring the change between the end in the fourth quarter of 2020. So the fourth quarter of 2020, if those of you who are investing through that period, you know it was a great market environment, which is why they ratcheted down their return expectations during that period. We're not alone in terms of being somewhat pessimistic about what the US market is likely to return over the next decade. Research Affiliates, which is another firm that does these sorts of forecasts, and they have a neat interactive tool that you can play around with. They too are sort of in that very low return expectation camp. BlackRock is a little bit more positive. I would say Vanguard is somewhere in the middle. But nonetheless, these return expectations are generally below the 8 to 10% equity return that the market has delivered historically. And that's because we have had a pretty good run in the equity market already. If you've been investing in stocks through the past decade, you've enjoyed really nice growth. these numbers suggest that you probably want to rein in your expectations a little bit for the next decade at least. Beyond that, it may be off to the races again. But near term, I think you probably would want to think about having fairly muted return expectations for US stocks, certainly maybe a little better return expectations for non-US stocks, in part because valuations are relatively better. So how do we mitigate this sequence of return risk? If we're getting ready to retire and we want to make sure that we're not walking headlong into a really difficult market environment, well, there are a couple of ways to think about it. One would be to plan to reduce your portfolio withdrawals if you happen to encounter a really difficult market environment at the outset of your retirement. Make sure that you can potentially live on less if you need to, because all of the work that has been done on withdrawal strategies over the past couple of decades very much points to the power of, if you can take less, if the market serves up very lousy results in your early years of retirement, if you can withdraw less in those years, if you can live on less, that really improves your portfolio sustainability. And the simple reason is the less you can spend when your portfolio is down, that leaves more of your portfolio in place to rebound and recover when the market eventually does. So there are lots of different variations on these strategies that incorporate market returns, incorporate portfolio returns. I've cited a couple. Vanguard has done some research in this realm. A financial planner, Jonathan Guyton, has done a fair amount of research in this realm. If you're interested, you can check out their white papers on this topic. And then another thing to think about, so you're thinking about how much you're withdrawing from your portfolio if it does encounter a weak market environment early on. So you're thinking about your withdrawal rate, but then you're also thinking about the setup of your portfolio. And this is something that I've focused a lot on in my work on Morningstar.com, illustrating what I think sane portfolios are for retirement. So we'll just take a quick look. I've latched onto this, what's often called the bucket approach to retirement decumulation, just because I think it's a really intuitive way to approach a structure for a retirement portfolio that I think nicely addresses the idea of encountering a weak market environment early on. So the basic idea is that you are, with bucket 1 and bucket 2, you're setting aside 10 years worth of portfolio withdrawals in safer assets. So in bucket 1, we've got maybe 1 to 2 years worth of portfolio withdrawals in just cash investments. We're settling for very low returns, potentially even slightly negative returns once inflation is factored in. We're settling for really low returns, but basically we're just battening down the hatches with that portion of our portfolio. We don't want to risk anything because we don't want to jeopardize our our lifestyle in those early years of retirement. And then with bucket 2, we're stepping out a little bit on the risk spectrum. So we're still focusing on safer investments, but we're including some short-term bonds, some intermediate-term bonds, a little bit of inflation protection. So I would include some Treasury inflation-protected securities there. But essentially, I'm building a bulwark of 10 years worth of portfolio withdrawals in safer assets, so that if Armageddon occurs in the stock market at the outset of my retirement, I would have 10 years worth of portfolio withdrawals to spend through before I would ever need to touch my stock portfolio. So how did I arrive at 10 years worth of portfolio withdrawals? Well, one thing I often think about is, what is the probability of having a negative return from stocks? Well, if you have a 10-year time horizon, stocks are actually extraordinarily reliable. When we look at rolling periods throughout market history, if your holding period is at least 10 years, you've been positive like 90% of the time. But once you begin to shrink that time horizon, if you get into 5 years, or God forbid, even fewer than that, Well, stocks are just way too unreliable. The probability of having a negative return over those shorter time horizons is just too great. And so that's why I have latched onto this idea of 10 years. But I think if your portfolio plan is tighter, you could think about having more like 7 years worth of portfolio withdrawals. But the basic idea is that you are building yourself a bulwark that you could spend through, which is not to say you would always spend through your portfolio in exactly this fashion, but you're setting yourself up to, in case your early retirement years feature a bad equity market, you've given yourself some safe assets at the front end. There are environments like right now, if you've been retired for a while, I would say leave your safer assets in place, don't spend through them, spend your appreciated equity assets. But if you are embarking on retirement and you happen to encounter a weak market, that's what this bucket structure is there for. And so this is just a sample portfolio that is segmented by these 3 buckets. This is an exchange traded fund portfolio. So it is focused on very low cost funds. And you wouldn't need to follow this specific framework. My guess is that if you have a well-diversified portfolio that includes some stocks, both US and international, and includes some bonds and maybe a little bit of cash, you're probably already pretty close to having some version of a bucket strategy. But this is really just here for illustration purposes. So we're assuming in this case, a couple with $1.5 million portfolio with a desire to spend $60,000 from that portfolio in year 1 of retirement. So they're using kind of a 4% guideline for their spending. So they're spending $60,000, just 4% of that 1.5 million. And then you can see I've just kind of structured the buckets along the lines of what we've already been looking at. This is a radically simpler version of this. I'm always looking for ways to simplify the number of moving parts in retiree portfolios. While the previous slide features some assets that I do like to include in retiree portfolios, like short-term bonds, like treasury and inflation protected securities, nonetheless, this is a radically simplified version that I think could do I would say a good 90% of what the more complicated portfolio does with fewer moving parts and very low expenses. So on to the next risk factor or blind spot. This is simply the very low yield environment that we find ourselves in today. This is probably something that many of you feel very acutely. If you have tried to wring any sort of positive return out of your safe assets, you know this very well, that we have had to all settle for less and less and less on those interest bearing accounts in the name of safety over the past several decades. And really, truly, this has been going on since the 80s, where we've seen yields decline and decline and decline. And so that creates challenges for retirement planning. I mentioned at the outset that, if you're like my father-in-law, where you very much were interested in subsisting on yield alone and you didn't want to touch your principal, well, this has been challenging. You've had to take more risk in the name of generating a livable income stream from your portfolio. So I mentioned that many retirees do like the idea of living off yield alone, but when we do find ourselves in the kind of very low yield environment like we have today, that forces retirees to either subsist on less income, which of course most of us do not want to do that, or to take more risk in our investment portfolio in the interest of generating the yield that we need. Bond yields have historically been a pretty good predictor of what bond returns might be over the next decade, and we're at a very low ebb today. The 10-year treasury yield is 1.6%. If you want to earn a significantly higher return than that, you need to take more risk in your portfolio. And this is just a slide that illustrates that risk reward trade-off that comes along with venturing into higher yielding securities, especially within fixed income. There's a very neat relationship between higher yields and risk taking. In fact, we have a lot of fancy tools on morningstar.com for drilling into what is the risk in a bond portfolio. So you can see lots of data on duration, which is a measure of interest rate sensitivity, and a lot of fine detail on credit quality. I would say that if you're looking for a sense of whether a bond product is risky or not, just look at its yield. It's a very good predictor of whether a bond product is going to entail risk or not. So what we can see today is that yields, if you wanted to try to wring a 4% yield from a portfolio, from a fixed income portfolio today, you're taking a lot of risk in that portfolio. And I've just provided on this slide, not saying that we are getting back to a 2008 environment anytime soon, but just for a little bit of context of what these investments returned during the last financial crisis. You can see that while their losses weren't as bad as the equity market, I think the S&P 500 lost 37% in 2008. You can see that they were directionally similar, that with riskier fixed income products, you do get more sympathy for what's going on in the economy, and also more sympathy for what's going on in the equity market. So how do we deal with the fact that yields are so low today and really are not conducive to subsisting on income during retirement, especially if we're just getting ready to retire? Well, how do we deal with this? And I would say that there are a couple of ways to think about it. One is to use some sort of a total return approach to decumulation. I would argue that it's all but a must for most retirees today, where you are either using sort of a pure total return strategy, where perhaps even you're reinvesting your income distributions back into the portfolio, and then periodically taking a look at that portfolio and seeing, what should I sell to meet my living expenses? If I were to talk to my colleagues in Morningstar Investment Management who do asset allocation and financial planning all day, every day, they would say that's how best to decumulate a portfolio, because it gives you a chance to optimize your portfolio on an ongoing basis, to take risk out of your portfolio while simultaneously supplying your living expenses. So if you can, at the end of each year, take a step back and look at the most appreciated portions of your portfolio, well, those are oftentimes the riskiest portions of your portfolio that you might want to be trimming back anyway. Some retirees might say, well, I'm not really comfortable with that pure total return strategy. I like the idea of some kind of income from my portfolio. In that case, I think you can reasonably use kind of a hybrid strategy where you're not going out of your way to generate income from your portfolio, but you're simply building a sensible total return portfolio, which today will get you maybe a 2%, maybe slightly sub 2% yield. And then you are using rebalancing to make up the difference. I think that hybrid strategy can make a lot of sense as well, where you got kind of a baseline of your living expenses coming in through income and dividend distributions that are organically occurring from your portfolio. And then you're using rebalancing to make up the difference. I think that strategy can work perfectly well as well. So this is just an example of how this would work in practice. So let's assume that I have a 60% S&P 500, so 60% stock, 40% bond portfolio in 2017. Well, the organic yield from that portfolio was about $20,000. If my income needs were $40,000, if my cash flow needs were $40,000, well, then I would be able to turn to my appreciated equity assets to supply the additional living expenses. So 2017 was an extraordinarily strong year for the market. I would have had my additional $18,500 in living expenses from rebalancing, and then I'd be able to reinvest back into the portfolio, or perhaps set up my cash flows for the next couple of years. by pulling money from the appreciated equity assets. Some years are not as good as 2017, even though 2017 was good, 2019 was good, 2020 was good, 2018 was not so good. And that's one reason why I like that idea of having cash reserves set aside, or at least having some money in safer assets that you could pull from in those weak years. So bond yields were pretty low in 2018, and the equity market wasn't so great. So you would be able to potentially pull from cash assets to leave your fixed income assets and certainly leave your equity assets alone in a year like that. I want to touch on another risk factor for retirement. This is something I've been thinking a lot about recently, which is inflation. And we have had a lot of drumbeating about the prospect of higher inflation. I would say there was also a similar set of concerns coming out of the last financial crisis, a lot of hand-wringing over the amount of government stimulus, that this was sure to lead to inflation. And lo and behold, we went on to have a decade's worth of very benign inflation from 2010 through 2020, really. We had a period of extremely low inflation. We're hearing concerns about inflation again. I personally am experiencing food inflation. I don't know about all of you at the grocery store. Definitely seeing that one come on strong. And certainly people who are in the housing market, who are purchasing homes, we're all seeing a lot of home price inflation going on. So it's a concern, I think, and one that we need to be mindful of when we think of our retirement plans. We want to make sure that we are troubleshooting the prospect of higher inflation as part of our plans. So this slide illustrates what I think is a really interesting look at how the Consumer Price Index is calculated. And if you've ever looked at the Bureau of Labor Statistics website, you can see that they provide a ton of useful data, and they provide a decomposition of how they arrive at that Consumer Price Index. And the main Consumer Price Index you hear cited is the CPI-U, it's called, the Consumer Price Index for all urban consumers. And it's meant to measure how consumers at large are spending their money. So what are they spending their money on? And you can see that CPI-U includes allocations to various goods and services that are meant to reflect what the population at large is doing with their money. CPI-E is another measure of inflation that is meant to measure how older adults are spending their money. And I think CPI-E can be really useful when thinking about, well, how might my spending be different in retirement than it was perhaps during my working years, during my younger years? How might it vary a little bit? So you can see CPI-E, I've included here, just how it varies from CPI-U in terms of the expenditures. So one that might jump right out at you is the very high number assigned to housing. And you might say, well, I own my own home, so inflation probably is not going to be that big a deal for me. And it may, in fact, not be a particularly big deal for your home. You won't have rent, obviously, but you may continue to experience inflation in other home-related items. So your utilities would experience inflation. If you're paying people to do home maintenance for you, if you're paying people to cut your grass or do other work around your house, you may experience inflation there. So even if you are a homeowner, chances are will experience some inflation, even though your mortgage is paid off. Another category I would call your attention to on this slide is the healthcare line. And you'll see that for medical expenses, older adults, not surprisingly, tend to spend more on medical care, on healthcare than the general population. is, as it turns out, over this particular period that I've captured here, which is just the 1 year period through February, you can see that healthcare inflation is actually pretty much under control. In fact, it's been in sort of a good pattern since the Affordable Care Act passed, where we've seen some tamping down of healthcare inflation, which is a really great trend for retirees. But over longer periods, we have seen a negative trend where, as many of you know, healthcare inflation has been running much higher than the general inflation rate. I think it may, in fact, get back to a higher level. Whether we're in a permanent lull for healthcare inflation, I think is an open question. I think retirees would be wise to plan for higher healthcare expenditures, which I'll touch on in a sec, as well as potentially higher inflation in retirement due to healthcare inflating. So how do we mitigate? Well, first, I'll touch on why this matters, why we need to concern ourselves with this. One reason is that while we're working, while we're getting paychecks, we're usually getting some sort of cost of living adjustment in our paychecks. When we are retired, we may still be getting a cost of living adjustment in our Social Security paycheck, where you get a modest nudge up to account for inflation. If we're lucky enough to have an inflation adjusted pension, all the better, but that's a dwindling group of us who will be retiring with an inflation adjusted pension. So the reason why we need to care about inflation for retirement is the portion of our portfolios that we're withdrawing to pay for stuff is not automatically adjusted for inflation. So those withdrawals that we were looking at on earlier slides, where we were talking about withdrawal rates and we were looking at portfolio structures, those amounts that we're pulling from our portfolios, those aren't inflation adjusted. And to the extent that we have safe assets in our portfolio, to the extent that we have cash, to the extent that we have nominal bonds, whether treasury bonds or corporate bonds that aren't inflation adjusted, well, that purchasing power from whatever interest we're able to earn on that environment, on those investments, is eaten away by inflation. So that's why when we come into retirement, we have more conservative assets in our portfolio, but that's why we need to be really concerned about inflation. So how do we mitigate this risk? Well, I think you think about addressing it from a couple of standpoints. One is at the portfolio level. So making sure that you have inflation hedges in your portfolio. So you are protecting your purchasing power to the extent that you have safer assets, that you're earmarking a portion of them for, I like the idea of including like 20% of the portfolio, of the bond portfolio, in what are called treasury inflation protected securities, which give your principal value a little bit of a nudge up to keep pace with inflation. So you think about inflation hedges like those. You might also think about having a healthy component of stocks, because even though stocks are by no means a hedge against inflation, when we look at the categories that have historically been able to out-earn inflation, to have a higher rate of return than inflation, stocks have historically done that. So yes, they're volatile, but they have historically had a better return than the inflation rate. So we think about adding those categories first and foremost, and then we might think about adding a few other categories around the margins. One I would mention would be bank loan investments, sometimes called floating rate investments. This is a really interesting sort of junky bond category, so I'd want to relegate it to kind of the margins of my portfolio. But the nice thing about this category is that when yields go up, you get a little bit of an adjustment in your interest rate. So it's a category to consider, because when we look at categories that have historically had some ability to keep pace with inflation, The bank loan investments do that. High yield bonds, again, kind of a niche category that I would really limit my exposure to, but historically they have shown pretty well as a hedge against inflation. A lot of times people like to own real estate as a component of their retirement portfolios. I know Paul Merriman is a big believer in owning some real estate securities as a portion of a portfolio. One of the features of real estate investments, real estate investment trusts, is that historically the owners of REITs, the landlords that own these properties, are able to push through increases in rents that you as an owner of a REIT are able to benefit from. So that is one reason why REITs are often considered a decent hedge against inflation. So that's kind of at the portfolio level. At the plan level, I think you can think about mitigating inflation risk in a couple of different ways. Delaying Social Security is one, because you pick up an enhanced return on your benefit, and that delay also leads to a higher inflation adjusted benefit. And then also, if you're looking at other products as part of your plan, whether annuities or long-term care insurance, adding some sort of inflation protection may make sense there. It may be overly costly, it may not be worth it, but it may be worth investigating. This slide is, I won't delve into the specifics of what we're looking at here, but my colleague David Blanchett at Morningstar has spent a lot of time researching how retirement spending changes throughout our retirement years. And if we had a live audience, I would ask you to kind of walk me through what we're looking at here, because chances are you've had some experience with this by knowing retirees in your life, or by being a retiree yourself. You know that oftentimes the early years of retirement, the sort of say mid 60s to age 70 sort of period, those are the high spending fun years of retirement, where sometimes there's pent up demand. Certainly coming out of the pandemic, there will be pent up demand to do travel and dining out and all the things that we all look forward to in retirement. Those are the higher spending sort of discretionary years. Then spending trails off later on in retirement before trending back up in the very late years of retirement. And many of you know well why those expenses trend up later on in retirement. That's typically big healthcare outlays later in life, oftentimes unfunded long-term care expenses. So for people who don't have long-term care insurance, they may need to fund some of those costs out of pocket. So David has written extensively about this topic, about how it's not just a flat line of spending throughout our retirement trajectories. It's oftentimes kind of this smile pattern that he has detected in his research. And so I want to delve into that healthcare cost risk. Fidelity annually puts out these estimates of what the typical 65-year-old couple will spend on out-of-pocket healthcare costs in retirement. The most recent tally came in just around $300,000. And so this includes Medicare premiums, it includes supplemental insurance policies, which many of you, I'm sure, know, can be one of the largest budget items for many retiree households. It includes pharmaceutical costs that are not covered by Medicare. So when we tally all those up, Fidelity has come up with this $300,000 lifetime outlay. Importantly, Fidelity's estimate does not include long-term care costs. So those costs, as many of you know, can really stack up as well. I think it's always important to note, though, I think that $300,000 number is absolutely terrifying. But the fact is, for those of us who are employed and those healthcare premiums are just getting deducted from our paychecks, it's kind of invisible, but really we've been paying in many cases quite sizable amounts all along. We just really don't feel it because it comes out of our paycheck before we even see it. So they're not brand new expenses. The baseline premium expenses, they've really been with us in some fashion all along. So how do we mitigate this risk? Well, I think it's worth thinking about your own health care needs. Vanguard has done some further research with Mercer on this topic. And what Vanguard found is just a huge amount of variability in healthcare outlays based on geography. Certainly those of us who live in higher cost geographies can expect to pay more for care. Based on health, our overall health conditions tend to be quite predictive. Coming into retirement, if you've had very few healthcare outlays, you may be lucky and that may stay with you. So the state of our health coming into retirement tends to be pretty predictive about how much we'll spend. And I think it's also important, if you are an early retiree, to be factoring in and pricing in your pre-Medicare healthcare outlays, what those might look like and how those might drag on your plan's expenses in the early years of retirement before you're Medicare eligible. I think it's also just worth looking at your insurance costs prior to retirement. Obviously, some of you, if you're already retired, you're already experiencing these costs. And then I just wanted to make a shout out for those of you who are still in the accumulation years and maybe you're many or several years away from retirement. There are some tax advantaged ways to save specifically for retirement healthcare costs or pre-retirement healthcare costs. And I would just give a shout out to using health savings accounts in this context. Anyone who does any sort of tax planning is usually pretty enthusiastic about health savings accounts. The tax features are unparalleled in the tax code. So if you're someone who is covered by what's called a high deductible healthcare plan, a qualifying high deductible healthcare plan, you're eligible to contribute to what's called a health savings account. And there are contribution limits annually for HSAs, and for 2021, it's in the neighborhood of like 7,000 if you're covered by a family high deductible plan. But the benefits are that you're able to make pre-tax contributions, you're able to enjoy tax-free compounding as long as the money stays inside the HSA. And then as long as you pull the money out for qualifying healthcare expenses, your withdrawals are also tax-free. So it's triple tax advantaged in contrast with, say, an IRA where you're either making after-tax contributions through a Roth and then enjoying tax-free withdrawals on the way out, or if you're doing traditional IRA contributions, you are getting the tax break on the way in and then paying taxes on the way out. The HSA is tax advantaged at every step of the way. So it's a really nice vehicle to consider. And I sometimes get the question about whether you can oversave in an HSA. I would say not really, because worst case scenario and you don't use any money in your HSA prior to retirement and you have more in your HSA than you actually need for healthcare expenses. Well, worst case scenario, those non-healthcare related expenses in retirement, once you're past age 65, are treated just like traditional IRA withdrawals. So they're taxed at your ordinary income tax rate, but you won't have any penalties on those withdrawals. So I'm an evangelist for HSAs. If you have one, think about using it because the tax benefits are pretty hard to beat. I want to touch just quickly, and I know that we are coming up on time here and I want to take some questions, but I want to touch quickly on long-term care risk. This is a topic near and dear to my heart. My parents had long-term care costs late in life. I mentioned that my dad had dementia, and was a big outlay. And thankfully, my parents had been good savers. They had more than enough to get them through that period. But as the person who was writing the checks out of my parents' accounts for them, it was painful to see the outlays for long-term care. This type of care, contrary to popular confusion, is not covered by Medicare. Some level of care may be covered by Medicare if you have a qualifying hospital stay preceding needing rehab care, but mostly this care is not covered by our healthcare system, not covered by Medicare currently. So it's incumbent upon all of us as we're thinking about our retirement plans to make a plan for long-term care. And for a big segment of our population, government provided long-term care will be the answer. Medicaid is the biggest payer of long-term care in the US. So certainly for people who do not have large portfolios, that will be their long-term care plan. But for those of you who have more sizable portfolios, I think you either want to think about insuring against long-term care risk, or at least if you are planning to self-fund long-term care, at least making sure that you are being thoughtful about how much you might need for long-term care, and then also segregating that fund from your spendable assets. So sometimes I think about having like a fourth bucket. We talked about those three buckets, which would be sort of your spendable assets, but maybe a fourth bucket makes sense in this context where you have set aside money to cover any long-term care costs should you incur them, or any maybe extra longevity expenses if you turn out to be a person who lives to 110 or something like that. And then, best case scenario, and you leave money behind, then that's money that's there for your heirs. The costs for long-term care vary dramatically based on geography. If you are living in a large urban center, you will pay more for long-term care. This could be a whole separate topic unto itself. It's a crucial topic. We have had certainly devastating effects from this pandemic for people in institutionalized long-term care. I think a lot of folks are really rethinking where they want to receive long-term care. My mom and dad had care in their home, which was very much their preference. And I think it's a preference for many of us for obvious reasons. One thing I would say is that if that is your plan, just make sure that you have a younger loved one in your life who can keep that whole thing up and running for you, because it really does require a lot of commitment on the part of your children or grandchildren or other younger loved ones in your life to make that thing work for you. So just quickly cycling through the opportunities or the possibilities for covering long-term care: purchasing a policy, purchasing a pure long-term care policy may be an option. We've seen premiums really go through the roof, though, for some consumers who thought they were doing all the right things by purchasing long-term care policies. They've gotten hit with these premium increases. Some insurers have just gotten out of the business altogether, which has not been great for consumers. Increasingly, we've seen some of these hybrid long-term care policies come on strong. And hybrid policies are policies that blend together, typically a life insurance policy with a long-term care rider bolted onto it. So there's a nice level of optionality in that, so that if you end up needing long-term care, it reduces your death benefit that you would leave behind. If you do not need the long-term care, the full death benefit would pass to your heirs. There are also annuity long-term care hybrids where if you need long-term care, you would be able to use it and it would reduce the amount of your payout from the annuity accordingly. So there are a lot of different variations. These products are more complicated. I would say if you're interested in a product like this, get help from a trusted, disinterested observer who's not involved in selling these products. So sit down with a CFP who does not earn any sort of commission from these products. Get a disinterested observer to help you navigate, because they can be super complicated. We mentioned the other options of self-funding or using government provided resources. I want to just touch real briefly on longevity risk. It's often funny to me that this is even a risk, because this is in so many ways a good news story, that we're all living longer and we're working fewer years, but it creates challenges from a portfolio standpoint. Just a quick few stats about longevity risk. If you're a higher income person, and chances are if you're someone who's attuned to investing, probably are a higher income person, you have, you're much more likely to live longer than the general population, unfortunately. Longevity is not equally distributed in our country and correlates very neatly with income, unfortunately. So if you are a higher income person, you need to be thinking about longevity risk. And certainly you also want to think about your own health conditions and your own family history of longevity when deciding how much care you want to put into protecting your portfolio against longevity risk. But longevity risk is a challenge for higher income folks, especially because more and more of us will be coming into retirement with just one source of income that is a lifetime source of income. So for me and many of my baby boomer and Gen X counterparts, we will be coming into retirement with just Social Security as our lifetime income source. We will not have pensions, and it's a dwindling share of the population that will be able to rely on pensions. So how do we mitigate this? Well, we are thoughtful and conservative about withdrawal rates. So if we think we'll live 25 or 30 years or even longer in retirement, that means that we need to be taking less from our portfolio. It also means that, if we are using the required minimum distribution tables to withdraw from our IRAs, as we need to do once we hit age 72, that potentially we're reinvesting a portion of our RMDs back into our portfolio. And then I think this also really argues for holding a healthy component of our portfolios in stocks, because we can't afford to have most of our portfolio in very safe, very low returning assets. We absolutely need the growth potential that comes along with stocks. I am going to skip this because I do want to tackle some of your questions. This is just some thoughts on how to mitigate longevity risk at the plan level. A few of these things you've certainly heard elsewhere, especially the exhortation to delay Social Security if you possibly can. I know a lot of people don't love that idea, but if you are concerned about longevity risk, it can be incredibly impactful because it enlarges your eventual benefit and it enlarges it for life. And it's also really important to think about if you're part of a couple, that you're super thoughtful about Social Security planning, especially on behalf of the younger spouse, because the larger benefit will be the one that will persist with the younger spouse throughout his or her lifetime. So I'm going to leave it there. I've got my email address here. I can't take anyone's personal question. I can't give any financial planning advice to any of you personally, but certainly feel free if you would like a copy of the slides, or if I can help answer any more general questions, I'm happy to do that. And I think we do, I talked for so long, but I think we do have a few minutes to take some of your questions here as well. So I'm happy to tackle those.
Yeah,
Fantastic.
Thank you so much, Christine. I really appreciate that. Sorry to cut you off there for a second, Paul.
No.
Just jumping into some of the questions that we've received. One, which I think is an important question. So, how do the bucket funds work for smaller retirement funds? So, say $300,000 to $500,000, or in that strategy, are there other suggestions that you would recommend? And then following on that, if you use the bucket strategy for withdrawals, won't you have to rebalance after multiple bad equity market years? Otherwise, after withdrawals from just bond funds, your asset allocations would be in all equity and thus risky.
Yeah, such a good set of questions. So I'll tackle the first question about size. So in some of my illustrations, I included some pretty large amounts. At the baseline bucket portfolio that I showed you was $1.5 million. But the nice thing about it is that it's completely scalable. So if your portfolio is $500,000, you would just scale down the position sizes accordingly. You'd keep the proportions the same, but the position sizes would scale accordingly. And I think it's also one reason I like the strategy is that it's also very much scalable based on what your portfolio withdrawals are. So say you're lucky enough to be a retired college professor and you're just pulling 2% from your portfolio per year or in the first year of retirement, and you plan to do that for another decade. Well, accordingly, your investments in safe assets would be really quite low, right? You would have some safer assets because you're spending something from the portfolio. So I like that it's scalable up and down based on what your spending rate is. Then I wanted to tackle the second part of your question about the rebalancing, which is super important. That when I show the slide of what the bucket portfolio looks like, it seems so intuitive. You just think, well, I just spend through the buckets, but you're absolutely right that it would potentially require some rebalancing. But the key thing to note is that it's the bad market environment occurring early in your retirement that's so problematic. For those of you who are later in retirement, where perhaps you have been retired for, I think people are requesting the presentation and my email is chiming, sorry about that. If you are someone who's later in retirement, you've really made it through the danger zone for sequencing risk. If a bad market environment occurs when you're 85, that's not such a big deal for you. You don't have as great a need to have safer assets in your portfolio. But some rebalancing on an ongoing basis does make sense. And I've written extensively about this topic on Morningstar.com. I've also written, and you could probably find it by typing in bucket maintenance in the search engine. And I've also written extensively about tax planning with this bucket strategy because it's, most of us are bringing in multiple pools of money into retirement. We might have Roth assets, we might have traditional tax deferred assets, we might have taxable assets. So unfortunately, it's not as simple as one big portfolio. So I've written about that topic as well.
Fantastic. Thank you so much. So a couple questions around the market currently. So one question, I'm 57, portfolio's done well. However, my deep down belief is that we'll have a sharp and sustained pullback at some time, no clue when. So how do I protect myself? With the massive issues such as debt and Fed will not be effective at some point. I'm currently 80-20 equities. Then another question, given the meager outlook over the next decade, understanding that we can't predict the future, where do you recommend we invest if within 5 years of retirement to optimize prior to retirement?
Yeah, it's a good question, and I can't give anyone any specific allocation. What I would say, though, is that I do like that idea of the bulwark, that you are building yourself kind of a safe portion of your portfolio that would serve as a protective device if the market is weak over the next couple of years or even longer. That idea of building enough in cash, high quality short and intermediate term bonds that you could fall back on if your equity portfolio were just kind of flatlining or even worse in such a period. My team that I work as part of recently completed a research report where we looked at correlations across various asset classes. And the goal was just to show what is the best diversifier. If someone has, assuming that most people have most of their money in equities, in US equities, what is the category that has historically done the best job of holding its ground or maybe even gaining a little bit of value in those periods? And you might not be surprised to hear that US Treasury bonds tended to do pretty well from that standpoint, that they tended to be really effective ballast for equities in downturns. Cash actually also looked pretty good. Gold looked reasonably okay, but treasuries have historically been a really effective kind of buffer asset in equity market downturns. So I hope that answers the question.
That's terrific. Well, we're close to the end of time. I want to give Christine and Paul great appreciation for being a part of this. Paul, do you have any final comments you'd like to make?
You know, I so appreciate you doing this, Christine, because I think you've opened up some ideas for people that they're going to follow up on, and it'll make a difference. I do have a curious question about what you believe in terms of saving rates. What should people be saving? And of course, we're most worried about people who are getting started, where they have the time to have it do its work. But what are you telling young people?
I think 15%, Paul, is a good starting point. Certainly higher income earners, I usually like to tell them to try to shoot even higher if they possibly can. But I think 15% is a really good starting point. Unfortunately, that 10% number is very much out there. And I think people think, well, as long as I'm doing 10%, I'm doing okay. It's certainly better than nothing, but I would rather see people reach for 15% if they possibly can. Understanding that a lot of younger people are really multitasking, where they may be saving for a home down payment or to pay for a wedding or whatever it might be. But I do think 15% is a good starting point.
And one last question. You have 20 model portfolios. We have lots. Lots of our friends have lots. How do you give somebody unbiased advice as to how to pick the best model portfolio?
That's such a good question, Paul. My portfolios are pretty vanilla. So the bucket portfolios are sort of aligned with what I've talked about here. But I think the best portfolio is the one that you believe in, that you think you can stick with. We have so much research on investor behavior at Morningstar, where we see that investors systematically hurt themselves with these timing decisions where they are chasing things that have worked in the past. I'm afraid that's very much going on right now with some of the high octane, high momentum stocks that have been pacing the market. And we see that investors buy high and then they sell low, and it's rinse and repeat. We see it again and again. So I think it's, if you find a portfolio that resonates with you intellectually, that you think you can stick with, that's the winner, based on what you know of your own behavior and how you've fared in the past. I think that's probably a way to navigate.
And let's make sure we've left our viewers with knowledge of the ways you are helping. You have your weekly podcast, The Long View. You have your weekly column. Is that weekly, or do you do that more often?
It's a couple times a week. I usually write one new piece a week, and it's usually a couple times a week. I do a lot of videos for Morningstar.com. In normal times, I love being out and about speaking to live audiences of investors, because hearing their questions gives me a sense of what to work on. And I wanted to thank you, Paul, for being on the podcast too. We've had some wonderful guests, and you were gracious enough to take part in it recently.
Thank you very much. Keep up the good work. We really appreciate your sharing.
Thank you so much. Thanks for including me in this great educational event.
And Jim, thank you, by the way, and Jessica and all the people that worked very hard putting this together. And Kathleen Thorne over at Library U, a whole bunch of you. You made it